traders of all levels and interests. If you're just getting into trading, you will appreciate the education offered by our many built-in systems. In addition to pointing out buy and sell signals, Metastock explains how they work in an easy-to-follow commentary window. Metastock has built-in systems based on popular strategies like MACD, Bollinger Bands, turtle trading, candlesticks, and many more. Metastock even has the very popular and exclusive Rahul Mohindar oscillator system, or simply known as the RMO. And as you become a more experienced trader, Metastock grows with you. Advanced analysts will enjoy the comprehensive list of trading systems and indicators, and the ability to build their own systems. And if you're a day trader, you're going to love Metastock Zenith, the real-time news, data, and analysis package powered by Thomson Reuters. Metastock Zenith is a comprehensive and flexible system with an extremely powerful search tool, which includes fundamental and economic data, and an array of options tools that have never been available to the private trader. Add on the world-class support, and it's not hard to see why Metastock has won the Stocks and Commodities Reader's Choice Award for 23 consecutive years. To find out more about Metastock and how it can help your trading, visit metastock.com or contact the product professional via phone, email, or chat.
Hello, Jeff. Good morning.
Just so you know, you're live. Everybody can hear you.
All right, I'll try.
And I can hear you too, so you sound great. We're going to get going, as you know, in 6 minutes. So I hope you need anything.
Not that I can think of, so.
Well, the attendees look fantastic. So, and just for those of you that are joining us, welcome to the room. I hope you're doing well today. We've got a whole day of really interesting topics and we pick up with Steve here. So, we will be starting here in 5 minutes. See how many of you use the microphones, and we'll see you in just a minute.
Okay, Jeff, you're live.
All right. Good morning, everybody. I heard Bobby say that we were live. I couldn't hear him at all. So hopefully we're live. If not, I'm assuming he'll run in here in a second. I hope you're doing well. Good morning, everybody. Happy Monday. Welcome to the Online Trader Summit. If you can hear me, say hi. It's good to see you. We're going to kick off right away, but first, I'm going to remind you that today's demonstrations are designed to instruct you on using Metastack and accompanying software plugins. They're not a specific recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. Winston, can you hear me? There may be an audio problem in the control room. Bobby?
I can hear you. Clear.
Oh, okay. All right. Steve, can you hear me? All right.
Yep.
So
Can you hear me?
Yeah. Okay. So it sounds like we have audio. It's good. It's good in GoToWebinar. So Winston, hopefully you can hear me. If you can't, oh, good. Thank you for letting me know. If you can't, I'll just type in some instructions. But in any case, I want to say thank you real quick to the CMT Association for sponsoring today's event. They're great, well-reputed. They have a great reputation. You can visit them at cmtassociation.org. I also want to say we're Metastock. We've been rated #1 in our price category for 29 years in a row. And we're going to be doing events. We're going to be talking about why that is all day. So without further ado, Steve, welcome to the room today. I'm going to introduce you officially. Steve and I have known each other for a long time now, decades, I think. We've released one of the most powerful add-ons for Metastock, one of the most popular add-ons for Metastock that does all of his patterns. I like Steve. I like what he has to say. I've had the chance to kind of travel with him. I love his patterns, particularly the Doji Best Friend. And I think that's where I'm going to introduce you today, Steve. Let's go ahead and make you the presenter. How are you doing this morning?
Doing very good. Nice summer day here just north of Pittsburgh. So ready to enjoy the day. Let's show my screen. Here we go. Hopefully we get the right one.
And the one I can see, go ahead. Yeah, I can see your GoToWebinar connection screen.
Oh, okay. So we always do this. How do I share my screen?
Just, there's a little down arrow under show screen. And if you click on that, if I remember right, you were screen 4.
Maybe screen 3. Oh. Darn. I'm looking at my control sharing.
Yeah, where it says sharing.
Yep. Okay.
There should be a.
Okay. Show screen. And now I'm showing which screen. Which screen? How do I get to the screen?
Yeah. Click on the down arrow right there.
All right. Let's see. How does that one look?
I'll tell you in just a sec. That looks like the correct screen, Steve.
Okay, a full screen. All right, great.
Cool. I'm going to get out of the way. Your turn.
All right. Thank you, Jeff. Good morning, everybody. Hope everybody's having a nice summer day. As I go through this, if you've got questions, feel free to ask the questions as we go along. And as Jeff said, we've been working together for quite a few years. So the reason I'm usually put on first is because candlesticks, if you know candlestick, it's like the bricks and mortar or the ABCs of anything else that you want to do, because there's so much logic built into candlestick analysis. And that's where we've put some, and I'll let Jeff go into the formulas that we've put in to the Metastock scanning. But essentially, the basics today is how do we know when there's a trend change? And that's what we can use Metastock scanning for. So right now we can see the logic that the Japanese rice traders have provided for us. I mean, they've been doing this for centuries. But the basic logic is if you see a candlestick buy signal in the oversold area, their logic is the probabilities of a reversal is extremely strong. Same scenario, if you see a candlestick sell signal in the overbought area, the probabilities are pretty strong. You're going to be looking at a downtrend. So the number one element that you want to do as you wake up every morning, if you're a day trader, a swing trader, or even a long-term investor, is which way is the market going? Because that's obviously going to put the stars in alignment. So the other day, or last week, we could see there was a morning star signal, but I will go into this indicator in a little bit. This is the T-line, and the T-line has very strong probability ramifications. As long as you're below the T-line, you've got to still be assume that you're in a downtrend. Friday, as we saw, the markets gapped up and traded well above the T-line. Now the assumption is investor sentiment has changed. We're in an uptrend. Same scenario on the NASDAQ, except on Thursday, it did close above the T-line. That gave us a lot more indication that the bulls were taking control. They're likely to start coming back up to the top of that trading range, and then you see what happens at that point. But knowing this, here is the whole benefit of candlestick analysis. We're looking for a change of investor sentiment. And I always put this on first because my brother, who doesn't think, well, I always have to convince him of how to trade correctly. One day we were sitting, and he said, well, how do I find the ones that are going to have big price moves? And I said, well, that's what everybody's looking for. And I said, look at this one. Today it's gapped up and trading positive. That tells you there's a change of investor sentiment. So we go back and we use what we call our rare evaluation. That's research analysis, reverse engineering. When we see a gap up like this out of a very lethargic trading range for months, the news was at that point that they had some approval in Europe for the COVID virus or COVID vaccine. That sprung a new interest in the stock. So while I was talking, he actually bought the stock. A month or so later, we sold out at 17. He bought it at 73 cents, sold out at 17. Now, I put this as a rhetorical question. Does every trade do like this using candlestick signals? Absolutely not. But the strong point of all this is the probabilities of being in something like this is greatly enhanced when you know what the patterns and the signals are telling you and when the breakouts occur. Another one, same results. This is what we call a fry pan bottom, because the Japanese rice traders said it looks like a fry pan bottom. And this right here tells us there's a brand new investor sentiment or more powerful investor sentiment that's going to give you a strong price move. So anytime we see, and this is where the logic is built into the analysis, anytime we see a pattern setting up, the expectation of a fry pan bottom is that if they break out, you're going to have a very strong price move. Now, this is not because of anything magic. This is because the Japanese rice traders pinpointed what happens in investor sentiment. These patterns work the same way time after time. So anytime I see something like this, we can start what we call adding 2 plus 2. 2 plus 2 is you see a pattern ready to break out. Then you have a big bullish day and a doji. A doji is this little cross type day. That's telling you there's indecision between the bulls and the bears. But there's a doji rule. It's very simple. The price will usually move in the direction of how they open after a doji. And if that's the case, we have a pattern that we call the doji sandwich. You have a big candle, then a doji. If it opens positive, it's going to trade positive. If it trades positive, more than likely, this magnitude of this candle is going to be the same magnitude as this candle with the doji sandwiched in between. So this is all just step-by-step logic that if they do this, what's it telling us about our fry pan bottom? It's broken out. So let me see if I can find a better chart. So if I'm looking at something like this, and you can see a fry pan bottom is just indecisive trading. Seeing you, but not your charts. So Donna, I'll have to have Jeff
I can help with that, Steve.
Okay.
So if you're watching on a tablet or an app, try swiping left or right to switch between looking at Steve and looking at the charts.
But I'm sure you all want to look at me.
I've got your full screen.
Oh, wow. Happy day. So here's very simple logic. If we know what to expect coming out of a fry pan bottom, but you don't want to be sitting waiting and watching it, you just put a buy stop right above this breakout level so that if it does, you're in the right place at the right time. But here's the whole point of a fry pan bottom. This is the expected move when they break out. Let's see. So this one is actually one that we're looking at today. You can see the fry pan bottom. You can see the doji sandwich at the breakout level that everybody else is watching, the 50-day moving average. If you're buying this one on positive trading, I haven't even looked today to see what it's doing. But if you're buying this one, you're buying it on the basis that we expect this to move strong as long, and you can stay in it as long as you stay above the T line. Now, here's the most important frame that I have on here, the T line. The T line is the 8 exponential moving average. It has Fibonacci characteristics. It acts like a natural support and resistance level of human nature. And I tell people, you don't have to take my word for it. Put the 8 exponential moving average on your charts, and anytime we see a candlestick buy signal and a close above the T line, you can stay long until you see a candlestick sell signal and a close back below the T line. Now, the reason that has helped me, before candlesticks came along, I was a stockbroker for 8 years. I got out of the business because I realized that the brokerage firms had no more idea about what made stocks go up or down. But then when candlesticks came along, every time I looked at it, I said, wait, this makes sense. And the more I looked at it, the more sense it made. So because I knew I was one of the worst investors in the world, everything I did was to keep my emotions out of my trading, because that's our biggest bugaboo, is our own emotions. So before we put the T line on our chart, there'd be times that say, well, this looks like a sell signal. Let's go ahead and close it. But the probabilities before the T line came along told us, well, this might not be the time to sell. So what this does is it keeps your emotions out of your trading. And the reason for that is, if you were like me, or if you're like me, very rarely would I have a profit in a trade. And what became my biggest fear? Taking a loss. Boy, would I look stupid if I had a nice gain in a stock price and then I let it go to be a loss. Now I can eliminate that factor by just staying long until I see a sell signal and a close back below the T line. Why I'm here, you can see my charts aren't very complicated. We've got the 200 and the 50 simple day moving averages on our chart. We don't use that to make our decisions. We use those because that's where every major money manager uses, or those are the indexes that are the moving averages that every major money manager around the world uses to make their decisions. All we're doing is seeing what their decisions are at those levels. The 34 works reasonably well. So that's the nice thing about candlestick charts. The number one priority is the signal itself. Everything else is just a confirming indicator. So if it works, somebody says, oh, put the XYZ indicator on your chart. Put it on. If it doesn't help any, take it back off. But here's the most important one, the T-line. With that T-line rule, a candlestick buy signal to close above the T-line can stay long until you see a candlestick sell signal, will dramatically improve your trading ability, number one, and it will keep you from getting whipsawed in and out of positions. So conversely, it works just as well on the sell side. If you see candlestick sell signals and a close below the T-line, you can stay short until you see a candlestick buy signal and a close back up above the T-line. So with that, you can identify the patterns that are prevalent in candlestick analysis, like the scoop pattern. The scoop pattern is you start seeing a pullback and look how it becomes indecisive. Dojis, hammers, and it starts curling back up. Then look at your doji sandwich that brought you back up through the 50 and back up through the T-line. But here's the thing that tells us we're in a scoop pattern. That flat handle. Now, a lot of people say, well, isn't that resistance level? It is if we don't identify this as a scoop pattern. And then when it breaks out, what's our expectation? A strong slingshot effect to the upside. Now, the reason I'm pointing out these patterns is patterns have two major benefits. Number one, they give you a high probability of which direction a price is moving. And two, it's telling us the magnitude of this move is probably going to be much greater than just the normal uptrending stock during an uptrending market. So we recommended Relay as we started seeing this scoop pattern setting up. MXCT just broke through Friday through this level and the 50. We'd be watching that as far as buying it on positive trading. So anything that we can identify as a flat handle, and then you can see the buy signals down here. So this one closed right smack dab on the 50-day moving average on Friday. How do you calculate the T-line? It's all you do is you put it on your chart. It's the 8 exponential moving average. The 8 exponential moving average, yes. So if this opened positive today, and I haven't seen what it has done, what's it telling us? One, that our scoop pattern's working. Two, it's breaking out through a level that everybody else is watching, the 50-day moving average, giving you a high probability now you're in a slingshot price move. Another way to confirm when a sector is moving or a price is moving is when you see your positive trading. The cruise lines on Friday did a doji bullish candle that broke the T-line. Stochastics coming out of the oversold area, high probability they're buying the cruise lines. What gives you extra confirmation? Well, when all the other cruise lines, Nordic and Royal Caribbean, all did these type of patterns, that just gives you added confidence that they're buying that sector across the board. So these are the patterns breakouts that we're looking for. This is called a bobble breakout, where they came up, failed right at a level where everybody else is watching, the 50-day moving average. Then you can see how the T-line was crunching it right back up through that level. Little J-hook pattern. What do we do here? We just stay long until we see a sell signal and a close back below the T-line. So the major benefit of recognizing what investor sentiment is doing, hold on, I got a frog in my throat here, is you see something like this where it breaks out, should you be buying here? Should you be buying here, buying here? Very simple. Candlestick analysis is a graphic depiction of everybody buying and selling during a specific time frame. I used to trade the E-minis off the 1 minute, 3 minute, 10-minute chart combination. Right now, I am mostly a swing trader, which means I'm using the daily charts. And if I am intraday trading, which is usually soybeans, cattle, the dollar, I'm using the 10-minute chart. So they work equally well on all time frames. So if I don't know what to do right here, I just flip to my 10-minute chart. I'd be buying here. I'd probably be buying here. Might not be buying here, but I'd be buying here. And then you can see they held this price up. So the 10-minute chart gives you a much more clear indication of what they're doing. Are they taking it up and pulling it back? Or are they taking it up and then looks like the buyers are still there? So Jeff was saying that one of the strongest signals in candlestick analysis is what we call your best friend signal. We call it your best friend because if you see a doji followed by a gap up, especially in the oversold area, we call it your best friend because there's actually three major factors. One, it's telling you with a high degree of probability you're in an uptrend. And two, the magnitude of that move is usually going to be fairly strong. So you can see there was sell signals in here, but what was our final criteria? They didn't close below the T line. You just hang on to it. Again, this, and I point this out because being the worst investor in the world, my emotions would say, oh man, that looks like a sell signal. I'm ready to take profits. Well, now I know just to wait. If this had opened lower the next day and started trading below the T line, yes, I would have taken profits. The third factor, reason we call it best friend is because of the frequency that these signals occur. These occur all the time. So on any given day, when you refresh your charts and you do your scans, you're probably going to find one or two best friend signals. We recommended Wolf today because there's your doji hammer in the oversold area, gap up. Where's our next likely target? Up here. Same thing on BHC. This is what we call an inverted hammer, which we'll get to, I think, later on. But they gapped up. And where did they gap up? Through the T line. Where's your next likely target? First target right here, second target up here. So I keep reiterating when I do these sessions, this is not rocket science. You don't have to be a sophisticated technical analyst. All you have to do is recognize the signals and patterns that the Japanese rice traders have recognized over the last 400 years that told us there was a high probability there's a change of investor sentiment. So when you add everything together, the kicker signal is the most powerful individual candlestick signals. I guess I should backtrack here a little bit for anybody that doesn't know the candlestick signals. There's 50 or 60 candlestick signals in the candlestick universe. When I first started learning candlesticks, I wanted to learn every single one of them because I was such a greedy son of a gun that I wanted to make sure I made profits everywhere. But as I would go back through and study charts, I discovered out of the 50 or 60 signals, there's only 12 that occur 99.9% of the time, which we call the 12 major signals. And then through all the years, we discovered there's approximately about 8 patterns that are reoccurring. And again, these patterns are reoccurring because human nature works the same way time after time. To me, it looks like SPY had a scoop and breakout on daily on Friday, pulling back now. Yeah, probably it's pulling back a little bit. I mean, a little bit. I see the Dow's down 48 points after being up 800. Usually what will happen is if you're in an uptrend, they usually sell off in the morning and then buy back in the afternoon. If you're in a downtrend, they buy in the morning and sell off in the afternoon. But logic says after an 800-point move in the Dow and big moves in the NASDAQ as well as the S&P, you're going to see some profit taking first thing in the morning. Oscillators settings value, meaning down here my stochastics are 1233 slow. And that's nothing set in stone. Somewhere around 30 years ago, I was sitting in my office, which happened to be my living room at the time, and the normal stochastics at that time was 1455, which was a little bit too slow for me being a swing trader. So I just sat there one night and said, let's try 1452, 1433, 1354, and finally came up with 1233. That seemed to work pretty well. And it was basically just saying, all right, when I see a sell signal, what are the stochastics doing? If I see a buy signal, what are the stochastics doing? So with that, this is a kicker signal. It opens here and closes here. Then the next day, they open it at or above the previous day's open and go the opposite direction. That pretty much tells you that the investor sentiment has been kicked in the other direction. Now, get back to what do we expect coming out of a fry pan bottom? A strong price move. What do we expect after a kicker signal, your strongest candlestick reversal signal? A strong price move. That allows you that even though you're up here toward the overbought area, you want to be buying because that pretty much indicates there's strong investor sentiment coming into this trade. So a very simple analysis. You're trying to buy the candlestick signals when stochastics are in the oversold area. You're usually buying a pattern breakout when your stochastics are up here in the overbought area. So you can see how we had a little left-right combo, which was a indecisive day, bullish engulfing, right smack dab at the 50. We're in the overbought area, but what's this pattern telling us? This little slow curve fry pan bottom. If they open up positive, it's telling us they're confirming the fry pan bottom, number one. And number two, everybody and their brother that's watching to see what's going on at the 50 says, well, the 50's not acting as resistance. They're all still coming in well after we've been buying right there on the open. So all candlestick analysis is just a graphic of what's actually happening in human nature. And it's not a projection, it's not a prognosis, it is the actual buying and selling decisions of investors. So we're not speculating on anything, we're actually seeing what they're doing. So again, there's that little rounding bottom right here at the 50. On Friday, it closed up through the 50. The probabilities are the bulls are in control. Works just as well on the downside. This is kind of a dumpling top. That's the opposite of your fry pan bottom. What do we expect coming out of a dumpling top? A strong force to the downside. This is also a pattern. This is a bearish J-hook pattern. Wave 1, wave 2, wave 3 is usually going to be the same magnitude as wave 1. So the benefit we have, again, is when we see a candlestick sell signal and a close below the T-line, what's our expectations? We can stay short until we see a candlestick buy signal and a close above the T-line. Right there, I might have been getting a little bit antsy about taking short, closing the short position. But as you can see, Carvana failed again and continued its downtrend. So the reason I point this combination out, the T-line and staying below the T-line, it gets rid of that emotion to say, boy, I've got a good profit. I'd hate to give back some of this profits. So I'm going to close out the position, and you lose another major part of that trend. Netflix a while back did a dumpling top, gap down. We stayed short on this. We shorted on this day because what did it tell you? They were confirming a dumpling top, and more than likely there was going to be a lot more downside. So anytime we can see a pattern, Amazon, wave 1, wave 2, going into wave 3 on a bearish J-hook, and what's our additional confirmation that the bears are still in control? Look what happened when they bounced right back up to the 50 and then started, that's what we call a bearish flutter kicker signal, one of the strong kicker signals. Stayed long until it closed back up above the T line. Same scenario. We can recognize the patterns and we can recognize the buy and sell signals. This is called a dark cloud signal. One of your major or 12 major signals. Again, then a dark cloud gap down. Look where they gap down. They gap down through the 50, through the T line. You just stay long. You might have covered shorts here, but then look what happened here. When it rolled over, you could reshort it. This is your bearish best friend. Look where the doji, this is a doji harami. A harami says the buying has stopped. And the doji, then when they gap it down, there's your bearish best friend. And what do we say about a best friend signal? High probability that direction is going to continue, and it's going to do it with a very strong price move. Oops, I'm checking to make sure I'm not going to run over time here. Same scenario on Salesforce. A shooting star harami, again, one of the 12 major signals. When they gap it down, that's immediate confirmation that the bears are wanting to get, or the sellers want to get out of this with great enthusiasm. And that's exactly what we want to see. If we're in an overbought area and we see a strong sell signal, that allows us to start shorting immediately with a high degree of probability that we're going to be heading in the right direction. Let me take a sip here. So I'll still see if there are any questions up until this point. Okay.
We do have a question, YouTube. Sorry, Steve. We have a question coming in through YouTube from Sunil. He wants to know what time frames can you use this on?
All time frames. Remember, the definition of a candlestick signal is the graphic depiction of everybody buying and selling during a specific time frame. It works just as well on a 1 minute chart as it does on a monthly chart. So depending on what trading time frame you're doing, as a day trader, I'd be using a 5 minute, 10 minute combination. As a swing trader, I use the daily charts. And I use the daily charts. I should have said there is one caveat to the T-line rule, that the further away you move from the T-line, the higher the probability it's going to come back and test it. So this is not a good example here. But had this been way up here and the T-line down here and you saw a sell signal, the probabilities would be pretty strong it's going to come back and test that level. So as I mentioned, I used to trade the E-minis off the 1 minute, 3 minute, 10 minute chart combination. Right now I trade soybeans, cattle, that type of thing off the 10 minute charts. And my swing trading is off the daily chart, with the caveat that if I've got something that's moved very strong, it's that far away from the T-line, and it's trading way up above the T-line, then I flip to my 10 minute chart. Because if I'm way too far away from the T-line, I know it's probably going to come back and test it. So if I'm way up above the T-line without a sell signal, that's where I flip to the 10 minute chart and say, all right, let's see what they do on the 10 minute chart. When they start showing a sell signal and a close back below the T-line on the 10 minute chart, I take profits. Okay. How do you find out these high probability candlestick patterns? Winston, Jeff is going to show you how we've got them all set up on the scan or the on Metastock. What if the shooting star Harami is smaller than the previous candle? Smaller than the previous candle. John, I'm going to just kind of say, even if it's a small reversal signal, remember, it's still telling you what's going on in investor sentiment. So like this one right here, yeah, it doesn't, and that it didn't get up above that level. Yeah, that's starting to tell you there's a little bit of, you're in the overbought area, you're starting to see a little bit of doubt up here. Get ready to, if you're long, start taking profits. After a positive candlestick breaking out of a J hook, today some stocks turned bearish. Would you take it as a temporary dip to a further rise? No. Victor, yeah, I don't have live charts that I can see, but today, so there is another very simple logic built into when do you get into a trade. So if you see a candlestick buy signal and you want to get ready to get into a trade, what do you want to see? You want to see they're confirming that buy signal. So obviously, if they open it lower the next day, we don't jump into it because that means the bulls aren't there. Where do we jump into it, or where do we get into it? Well, if it opened lower after a buy signal and kind of hovered around and then started coming back up through the previous day's close, if they open it lower and they're starting to trade it higher, what type color candle is that creating? It's creating another bullish candle, confirming your buy signal. That's when you can be buying. Or if you see something, if you see something that says, oh, I want to be buying on positive trading, and it opens here and immediately starts selling off, what color is that candle being demonstrated? Well, it's red, telling us, well, they aren't buying yet. So if I was going to buy on this day and I saw it open and I'm getting ready to buy, but they're trading it off, I'm not going to buy just yet. Uh-oh, I didn't want to do that. Where would I buy? If it pulled back here and then turned around later in the day and came back up through the open, what was that telling me? The profit taking's over, the bulls are confirming our buy signal. So on our website, or we have a chat room that's open all day long. I do trainings every Monday night and every Thursday night, showing people how to use the candlestick analysis. Monday night is for members. And then we do for members training sessions like how do you improve your probabilities based upon your entry strategy? Where do you set your stop losses based upon the logic of candlestick analysis? How do you scan for the best trades? Anything that is related to the common sense strategies surrounding investing using candlestick analysis. I mean, everything that is built into candlestick analysis is just common sense put into a graphic depiction. Let's see. We'll take a few more questions here. Okay. What kind of rate of return you usually seek, and what's your risk management strategy? Rate of return all depends on how much time you can put into your trading. Now, if I could trade full time, and again, as soon as I say this, disregard what I just said because it's all speculation. But if I was trading full time, not running a website and the chat rooms and everything, I'd be looking for about a 10% return on a monthly basis, which compounds out to, I think, 312%. But the reason, again, the reason you can't say what is somebody's rate of return is because I might be trading options. or stocks and options combinations. Let's put it this way, and this is a very simple way to state it. Before candlesticks came along, I was a major contributor to somebody else's profits in the markets. Now, knowing what the probabilities are on every trade, I know that every time I put on a trade, the probabilities are in my favor. I know when to get into a trade, when to stay in it, and when to get out of it. So if, for example, I had shorted this right here and it traded down, and then by the end of the day, it closed back up here, what'd that tell me about my short position? That signal didn't work, close it out. I know you've all been told to cut your losses short and let your profits run. I've heard money managers tell us that for ever, but I've never in the 40 some odd years I've been investing, have I ever heard them tell you how you cut your losses short and let your profits run. It's very simple using the logic of candlestick analysis. Any consideration about trading volume on by candle? No. First of all, I've eliminated or reduced my trading universe for all stocks that are trading greater than $5 and all stocks that are trading more than an average of 200,000 shares a day. The reason for that is I want to have enough volume that when I make my decision to get in and out, I'm not sitting there for 5 or 10 minutes waiting for them to execute my trade. I want to close out the trade and move on to something else. You can use volume if on, let's say, a big reversal day, there's a volume spike. Don't use that as a criteria, but I use it as a confirming indicator that if on this day there was a huge volume spike, it pretty much tells us there's been a major change of ownership, and it's usually the smart money selling or buying into the panic buying and selling. For stocks and indices, what time frame do you use? Because I'm a day trader, I'm just looking at the markets based on the daily charts. Does the body or the range of a candle count when determining size? Yes, that's what makes up each individual candlestick signal. Obviously, that body right there is a shooting star. This one right here is an inverted hammer. This one's a bullish engulfing signal. So once you learn the 12 major signals and understand, and that's another benefit from candlestick signals, not only did the Japanese rice traders tell us or show us the graphic of what this signal is doing, but it also told you what the investor sentiment was doing that created that signal. So when you have both of that in your head, you've got as firm a grasp of trading as somebody that's been investing for 50 years. I just got called into work. Okay, is this being recorded? Yes. Okay, so the inverted hammer, the reason I'm putting this on is the inverted hammer is one of the 12 major signals, but it's the least frequent. However, there's two major factors involved with an inverted hammer signal. One, it's going to produce a relatively strong uptrend. And two, again, this is my statistic of studying the everything over the last 30 years. If you see an inverted hammer and it opens positive the next day, you've got a 95% probability or greater that it's going to be trading positive, which also makes that very small probability factor of when it's not working very simple. If this traded up and then all of a sudden came back down through this level, that's part of that 5 or 3% that it didn't work, close out the position. But anytime we see an inverted hammer, especially in the oversold area, and they open up positive, we're buying immediately. Kind of the same thing with the kicker signal. I don't have one on here. If I see a kicker signal where they've gapped it up above the previous day's open and start going the opposite direction, buy it immediately. So this is why knowing what the factors are. This one's still working right now, MGNX. There's your inverted hammer. There's a gap up through the T line. high probability you're going to be in an uptrend. United Health, inverted hammer in the oversold area, and look how far away you are from the T-line. Again, the further away you move from the T-line, the higher the probability it's going to come back up and test it. So if it opened positive after an inverted hammer, where do you think your first likely target's going to be? Seeing what happens when it gets to the T-line. When it goes through, where's your next likely target? Up in this range. Whoops, I'm running out of time here, aren't I, Jeff? There's your best friend signal. Kind of a doji hammer gap up. And where did the gap up? Right through the 50, as well as the 200, and through this resistance level. What's that indicating? There's probably a lot more upside. Do you wait for a close above the T-line before entering? Yes. Unless, again, you're too far away from the T-line or a good, let's go back to, if I know I'm a good distance away from the T-line and it opens positive and I'm watching this, I know it probably at least is going to come back up to the T-line. I can see what it's going to do at that level. If I'm pretty close to the T-line and see a buy signal, yeah, I'm going to wait for it to close above the T-line. I'd rather be a little bit late, but have a much greater probability that price move is going to move in the direction as we expect it. I'm not trying to buy at the absolute bottom. I'm not trying to sell at the absolute top. I'm trying to make that high probability fat part in between where I'm dramatically improving my correct trade ratio. The blue line is the 50-day moving average. Okay, so here's one that's working right now, the scoop pattern. Now, how can we see a scoop pattern? It's kind of a flat handle. And notice what the nature of these signals are down here. When you get into the oversold area and you start seeing dojis, what's the doji represent? Indecision between the bulls and the bears. That's where you start looking for the next price move. Notice what started the uptrend. Again, there's our kind of our doji sandwich indicator or signal, closing above the T line. And what do we expect from a doji sandwich? More upside. If there's more upside, what's that telling us about our scoop pattern? It's still in progress. There's your kicker signal. Opens here, closes here, gaps up the next day, closes here. We're buying on this day because we got a kicker signal that closed above the T line. Where do you think your next likely target is going to be? At least up here. So again, this is not rocket science. A lot of people say, well, how do you pick out stocks or good trades like this? Do you use fundamentals? No. We're looking at what everybody else is deciding based upon the fundamentals. They're doing the fundamental work for us. NIO, kind of a little wedge, flat handle. And then it broke out on Friday. Now, why is that important? Because we're looking at the pattern. Most people are looking to see what happens once it gets to the 50. So when it opened positive coming out of a scoop type pattern, that told us we could be buying immediately because it's not resistant at the 50, which is what everybody else is going to be looking at. Roblex, same scenario. This is a bullish Harami gap up, kind of a wedge scoop, broke out through the 50, out through this area. The assumption is there's still much more upside. We recommended HCAT. You can see the hammer signal, the bullish confirmation, kind of the scoop pattern breaking out through the 50. So all this is not, or let's say it this way. This is not where you have to be a very sophisticated technical analyst. All you have to do is recognize the patterns that have worked over the last 400 years. And I always reiterate that the Japanese rice traders did not become wealthy. They became legendarily wealthy in Japan. They were the financial powerhouse on one simple premise, that human nature works the same way time after time. And that's essentially what candlestick analysis is identifying the reoccurring signals and patterns that are produced by human nature. So I'll take final questions, and then I'll let Jeff show how the Metastock scans show you where these signals and patterns are and how to take advantage of them. So, any questions?
Hey, Steve. Yeah, we do have one question for you from Sunil. He wants to know what time after he enters should he look to close on a stop loss?
Usually before you even put on the trade. That if the assumption is, if you're looking at a candlestick buy signal and you're looking at it to be a bullish direction, and you're buying on positive trading, the Japanese rice traders have a very simple rule that if that candle was showing you that the bulls are in control, where should it not close? You shouldn't close more than halfway down that candle, because if it does that, that tells you the bears are in control, close out the trade. So there's some very easy to learn, I want to say, strategies that tell you when to get into a trade and when to get back out, all based on what the price move is doing. So does every trade work? Obviously not. So as an important aspect of investing, you want to know when to be buying and staying in a good trade. But I used to sit and say, oh man, I'm hitting so many good trades. Why am I not making as much money as I think I should? Then I realized that there are going to be bad trades. And I would hang on to those bad trades because my initial analysis was, this is going to be a good trade. So, oh, it's pulled back, I'll just wait for it to come back up, instead of saying, this trade didn't work, close it out and move your money to a much better situation. I got way off on a tangent there. Now I forgot what the question was, Jeff.
Yeah, I think you answered it though. And
Okay.
Gabby does say thanks. The other question that we had through YouTube was, what's the T-line? But I already answered that. 8 exponential moving average. So Victor has a good one, and I think it's the last question we'll probably have time for today. But Victor says, when you do enter coming out of a scoop pattern, are you waiting for the scoop to break, or do you want it to break above the T-line and or the 50 MA as well?
That's all based upon your nature, or your risk nature. If I see a scoop pattern just setting up, I might go after it aggressively, expecting it to come back up to the handle. Or if I want to be a little bit more conservative, I just wait for it to break out through the handle.
Okay.
Yeah.
Perfect. Thank you, Steve. I'm
All
going
right, thank you,
to
everybody.
I'm going to address the question about scanning after we get done here. But if you want to visit Steve at his website, he runs a room. Do you want to talk about your room for just a second?
Yeah, we've got 2 trading rooms. One's an option trading room, one's our stock trading room. I put out 2 or 3 stock picks every day and do it in a video format, not so that you have stock picks, but so you can see what the video is showing to say why that was a good trade setup. Basically, you're in a constant learning situation. So even in our chat rooms during the day, we've got people that have been there for years that are very good at finding good trades. So you get 2 benefits. One, they're giving you a supply of good trades. And 2, if you're learning, you can say, well, why is XYZ a good trade? And somebody will come in and say, well, it's doing a fry pan bottom breakout, or that's your best friend signal, or that's a bullish engulfing signal. So your learning process goes a heck of a lot quicker. And as I say, we do training sessions every Monday night and every Thursday night. Every Thursday night is open to everybody. And so it's constant learning. And basically, there's one factor that I always kind of stress to people. that every time you put on a candlestick trade or use a candlestick chart to put on a trade, the probabilities are extremely strong. You're in the right place at the right time. All right, I'll let you show
Steve.
the.
I definitely appreciate your coming with it, and I will talk to you soon. Thank you for coming today, Steve.
All right, thank you.
All right, very cool. And I am going to, as promised, talk a little bit about the CPS, how it works, how the scanning in the program works, that kind of stuff. So Steve always does a great job. Thank you for all the questions. Thanks, Steve. Thanks for coming in. Okay, so just to kind of talk a little bit about CPS, obviously Steve talked a lot about the patterns that he likes to use, like the doji at the top, the doji best friend. And here's a list of all of them, and I'm not going to read all of them, but you have your belt holds and your J hooks and your 5-pad bottom. What we actually look to do is actually create these as a product that you can use inside of Metastock. And this was several years ago, probably a decade and a half ago. But what we came up with has been one of our most successful add-ons that we've had. And I think that's a lot due to the people. In fact, people really like Steve. They like his patterns. They want to be able to find them. So here's a list of the patterns. I just want to show you kind of what that looks like on a chart. I was looking at Amazon a little bit earlier. And what I've done is I've attached the template, which is going to apply all of the indicators that he's talking about, including the T line and the 50 and the 200 and the stochastics at the 12 through 3. But what it also does is you'll notice right here is anytime it sees a doji, as it did right here, you have it marked on the chart. Here you had a doji at the top, which is that doji followed by that gap down, the indecisive doji followed by a decisive move down, which obviously did happen and kind of pushed Amazon in this case to the bottom of this W formation. A couple of days ago, we had a bit of an engulfing bull, and it's been running up ever since. So all those patterns, the indicators, all of those are identified for you as soon as you open the chart. None of them repaint as soon as it's drawn. It's drawn very quickly because I know we're always kind of concerned about like keeping things on schedule here, but very quickly there's also a commentary in here. So if I wanted to kind of get a bit of an English definition about what's going on this chart, I can click on this, I can open up this commentary, which I've done. I can go ahead and move to this doji in the top. And what it's going to do, where is my commentary, is it's just going to give us a bit of a definition in terms of what's going on in the market. So say the doji at the top is doji followed by a gap down. Of course, it's going to not be very cooperative right now, but the idea is it's kind of going to give you a plain English definition. So the question that you had earlier was, how do you find these patterns? And so we do have an engine in Metastock that will allow you to scan for them. So what I'm going to do is just show you quickly how that works. I've got my scanner right here. It's called the Metastock Explorer. Looks like I'm going to go ahead and do this. And what I'm going to do is I'm just going to search for the word CPS. All of the Candle Profit systems start with CPS, and that'll just identify them and list them down here. So these are the different scans that we can run. If I wanted to, and if I hover over them, it'll tell you what it's looking for. So for example, this is going to find your doji at the top, your doji best friend, and your left-right bullish, your left-right bearish. If I want to run an exploration for that, what I'm going to do is actually just kind of go in and I'm going to search for basically I'll just do a real quick search of the S&P 100. So let me go ahead and start that as an exploration right here. It's just going to run through S&P 100 as of right now. It's going to see if there's any daily patterns that exist so far this morning. And you'll notice it's really, really quick. We did get at least one result, which is great. Right here, Merck & Company came up. Now, this isn't a recommendation to buy or whatever, but it didn't have a doji at the top. It didn't have a doji best friend. These zeros means none of these happens. But what it had was a series of dojis followed by a bullish breakout, which is what this series of bulls mean. So I can open up that chart. If I do so, it's going to also kind of give me, and then I apply the template, it'll give me kind of the pattern, tell me what it's doing, et cetera, et cetera, et cetera. So that's how easy it is to scan. Vikash, yes, this is a daily chart. Thank you for that question. So in any case, again, here's all the patterns. Again, it's very, very easy to kind of identify those patterns for you. Very, very popular. In addition, we have all these single day patterns that are going to be noted for you as well. And it's a very, very big package with all the patterns that it identifies. There's 36 different patterns. 6 different explorations, the expert advisor, which kind of goes in and labels and identifies and explains those patterns to you. It's got the 3 different layouts, and it actually does include a 40-minute training session. So as soon as this is available for you on your downloads page at Metastock, right under it is a little bootcamp session where I spend a minute, actually about 40 minutes, talking about here's how you open up charts, here's how you set up your watch list, here's how you scan every day, and it just walks you through basically putting this all together for you. So the normal price on the CPS 2.0 is normally $4.99. That's going to include your Candle Profit Systems. It's normally $4.99. We're going to discount that down to $3.99 here at the event. It's going to include, if you don't have access to our award-winning Metastock program, it's going to include a trial to that if it's needed. If you ever have any questions, if you need help, you're welcome to contact our very, very good support team here. To take advantage of this offer, you can call us. Our phone number is 800-882-3040, or you can go to metastock.com/saleschat to kind of take advantage of that as well. This is also part of our Summit Action Pack. We're going to have a package of all of the add-ons that we're talking about today, which would include the Steve Bigelow's CPS, Go No Go, which is a very, very exciting new add-on. Tyler and Alex are going to show you just in a second here. OVI Traders, the 3S Code, a brand new add-on that just came out. 3 months of a training site called LearnMetastock.com and Unleash the Power of Metastock workbook. So you can pick up all of those add-ons for just $1,641. Normally that would be $3,630. So to take advantage of that offer, you can go online at metastock.com/summit deal. You can call 800-882-3040, or you can visit us at metastock.com/saleschat. So there you go. Thank you again, Steve, for kicking us off this morning. I appreciate that. Before we go to our next 2 presenters, which are great, they also do a great job. I just want to say thank you, first of all, to Stocks and Commodities Magazine. They've done a great job of actually sponsoring our events for the last 15 years or so. That actually, I think it's about 10 years that we've been doing the summits and the online events, and they've supported all of them. So we appreciate that. They've been a sponsor for all of them. If you want to get a free copy of Stocks and Commodities Magazine, go to metastock.com/traders-summit, and I will type this out in just a second. You can fill out a little bit of a registration form if you're watching on YouTube, and you can elect to get a free copy of the the Stocks and Commodities Magazine. So a big thanks for those, for the sponsorship. We appreciate it. I also want to say thanks to CMT for the sponsorship, them sponsoring the events today. So CMT is a very, very well-respected, well-reputed organization. They do basically they do courses around technical analysis and accreditations, and they do a great job with that. We're happy to be associated with CMT Association. You can visit cmtassociation.org to learn more about that. So, and then of course we're Metastock, but we just talked about Metastock, and I showed you how easy it is to scan and that kind of stuff. So our next guest today is Alex Cole and Tyler Wood. I love kind of the interplay that they have. We're going to go ahead and bring them online and kind of get them started today. How are you guys doing today?
Morning, Jeff. I'm here. How are you?
Morning. I can hear you, Alex. Let's see if we can hear Tyler.
Me?
Yes.
Hey, Jeff. How you doing?
Your webcam is working properly today, too, Tyler. Too.
Amazing. I mean, I couldn't do anything about this face, but the camera is working. Yes.
Well, I mean, with that gorgeous beard, why would you want to do anything?
You know, my wife tells me regularly that I have a face for radio, but video conference calls.
So, let me do a proper introduction here. Tyler and Alex do Go No Go charts. It's been a very popular add-on. People really like it. Basically, it tries to simplify the analysis so that you can kind of get very good trend identifications, momentums, look to see if things are squeezing. I don't think that's an adjective, but I just made it up. You can add it to the dictionary now. But there you go. They do a great job. I love these guys. You're going to enjoy this presentation. Let me go ahead and send you the screen share, Tyler. I think you're the one that likes to do the screen share.
I sure am. Thank you very much. Let me know if that's coming through all right.
It is. I'm out. Your turn.
Fantastic.
Thanks,
Jeff,
Jeff.
thanks so much for having us. Everybody who's online watching this, the Metastock Traders Summit, thanks so much for joining us. I know markets have been really volatile, but for right now, I want you to grab a pen and a notebook, fresh cup of coffee. We're going to talk about process and tools. So for the last decade, I've been working with the CMT Association, that's Chartered Market Technicians, that Jeff mentioned. It's a 50-year-old nonprofit on Wall Street, and it's all about advancing the discipline of technical analysis. And Alex and I got to know each other a very long time ago when he was a product manager at Bloomberg, also helping people understand the power and the tools of technical analysis. And we learned a few things. We learned that particularly for folks who are new to using the craft, an overwhelming number of indicators makes your analysis really, really difficult. But we are firm believers in the quality of all of that information. We want to make sure that we are getting as much out of the market as possible with all of that big data, but we need to simplify our process. So let's dive in right now. We're going to talk about not forecasting, we're going to talk about reacting responsibly to what the market is telling us. And we're going to show you how to do that using GoNoGo charts. So to help kick us off, we always start with this quote from John Henry. He might be familiar to many of you if you've read the book or seen the movie Moneyball. This gentleman grew up humbly on a soybean farm in southern Illinois, and he learned the commodities trade. Now, what he learned, similar to what Mr. Bigelow was sharing with us about the rice merchants in Japan, was that human emotion is a real detriment to your trading, but it's also the fuel that makes for outsized gains, that makes the markets somewhat irrational. It's not driven by pure math, it's driven by fear and greed. And so John Henry used that whole idea of quantifying what was happening, removing his own subjective bias, and really gaining some advantage over folks. He went on to be a billionaire fund manager, owns the Liverpool Football Club as well as the Boston Red Sox. And for those of you who are familiar with that story, taking the subjectivity out of player selection and just looking at the stats for players helped them create championship-winning Boston Red Sox teams year after year. So that's the process that we want to go through, is getting a checklist, staying focused on what actually is, and removing our own subjective bias from our trading. Now, if you are like me, you've had a trade that has turned into an investment, meaning you were so convinced, you had such conviction in this trade that you held it all the way down, 10, 15, 25, 40, 60%, who knows how big the losses were. And what we're going to talk about for just a second, we're going to get mathematical. We're going to talk about the expectancy formula and why it is that our behaviors really limit gains. Now, we know from behavioral psychologists like Amos Tversky and Daniel Kahneman, who did a ton of work on the human psychology and our sort of innate bias, these cognitive shortcuts that we all have to help us get through life, they can be really detrimental to trading. For example, we gain a lot more by preserving a loss than we do by locking in a gain. We experience more pain in losses, and those trades become investments because we do not want to recognize when we're wrong. That doesn't feel good. But as trend following investors, we have to love when we're wrong. We got to get out of those shorts as quickly as possible and let our winners run for those outsized gains. So to put that into a chart, let me grab a little laser pointer here. We know that all trading strategies along this efficient frontier are going to break even. This is the point at which they break even. So 50-50, right? Just a coin flip. If you picked half of those trades and they work to your advantage, right? Maybe there's no edge to your process. You just pick randomly, coin flip on a trade. As long as those that are winners can outsize their gains 2-to-1, you stay profitable, right? We know from the institutional community that some of the best research and the best trading edge is not going to get them 100% of the time. They're not always picking winning trades. In fact, when Alex was working with PMs at Bloomberg, they were often quite happy with something that would give them a 60 to 65% win rate. But we know that profitability on those that are winners is critically important. So GoNoGo charts are going to do two things for us. They're going to help us choose stocks with high probability conditions. We want to get into more winning trades, but we also want to manage our risk and reward responsibly. So we're going to talk a lot about process and tools today as we go through some current market views. I know for many folks, it's been a tough year so far in 2022. We're going to talk about what's working here in this sort of mid-year market review. But first, we got to talk about the problem. I've built this chart. I'm sure many of us have. We're looking for that holy grail, adding indicator after indicator after indicator to try to create that better selection for winning trades. But it's a problem because multiple indicators can often be redundant, sometimes contradictory. And we know with enough squiggly lines going on our charts, we can convince ourselves of almost anything, right? This is what creates that analysis paralysis and lets us hold on to losing trades because our checklist is too confusing or too expansive. So right now, Professor Cole is going to walk us through what a responsible checklist for identifying market trends looks like.
Yeah, so we've spent, between us, I think we need to update our pictures that came on at the beginning of this webinar because I don't look like that anymore. But anyway, we spent so many years with people in this space, and it become evident to all of us that having a responsible checklist is the way to go. And so how do people do this? Well, really quickly, we know that if we can identify the trend, we can make money on the meat of the move, right? And that's arguably the most important skill that we can attain in our studies in technical analysis. And we like to say that it's simple, but it's not easy, right? It's a simple process. Is the chart going up, right? From all those retail TikTok 2020 people that got into the markets were just buying things that went up, and it works, right? If you can identify a trend and buy something that's moving up, you're going to do okay. But it isn't easy to actually achieve. So what we then will do is look to technical analysis to try to quantify that process. We might first turn to something like Donchian channels, where we automate higher highs and higher lows. And we can see that the red line, which is the highs, starts to climb higher. We start to see these higher highs as the Donchian channels indicator looks back over a period to see whether or not price is at a new high. We may then throw something like Bollinger Bands onto our chart. If you're familiar with technical analysis, we know that there are multiple ways to view Bollinger Bands, but one way is that when the bands are narrow, we can trade in the direction of a break if a break should happen, because there's compressed volatility, and then a breakout, it tells us that perhaps there's going to be a strong move in that direction. Of course, we'll have a moving average on the chart. We didn't even consider moving average as core technical analysis at Bloomberg. It was too prevalent on everybody's chart, so it couldn't help us identify if somebody was a true technician. It's that commonly used. But knowing whether a price is above or below a moving average can help us understand whether the situation is bullish. After that, you may throw something else on there like volume, right? Volume is not a price indicator, but it's a secondary indicator that confirms what we're seeing in price. And if you see heavy volume on a significant price move, then that might confirm what you think is happening in the price action. And then if you throw an indicator on the bottom panel, there's many that you can choose from, but MACD is a very popular one that combines some elements of trend together. And that you can see when that MACD is crossing its signal line over there on the bottom left of the chart, and when they both come above zero, you're saying, okay, well, that's a positive environment as well, because the shorter term moving average, the exponential moving average in MACD, is higher than the longer exponential moving average. So somewhere over there in the left side of that chart, you can be fairly confident with your checklist, your objective process. You can be fairly confident that you are identifying a new trend. Now, whether you're a sell-side research analyst or whoever you are in the industry, that's when you can be fairly confident in recommending buy or sell decisions, or even in your own process making that trade decision. That's when you should be able to be fairly confident. But the problem you can see here is, as we alluded to on the last slide, is already this chart's getting complicated. And if you add more to this, which most people do, this is a very sort of small, simplified process, you start to doubt what you're seeing because maybe one indicator contradicts, or maybe it just becomes hard to see price levels and you can't see a significant breakout of price above a prior high. So that's what we want to avoid. We want to get all of this valuable information, but avoid over cluttering our charts.
So in the same way that NASA and many military operations use a go or no go sort of checklist, right? Are the conditions optimal to put a rocket in space? That's billions of dollars of hardware. You want to make sure everything on your checklist is the ideal condition before you place that trade. But we know that markets are changing very, very quickly. And the volatility, by the time you get through that checklist, may have already moved past the opportunity to get in the trade. So what we've done with Go-No-Go charts is take all of that information. And in fact, what surprises me every time we do this presentation is the process Alex just walked us through. There is much more computation, many more indicators embedded in the Go-No-Go trend chart that we're looking at right now than there was even on the last slide. So Alex and I are firm believers. The information is critical, but we have to separate the signal from the noise, right? We want a chart that just tells us if all of those checklist conditions are met. So when you look at a Go-No-Go chart, up here in the aqua and blue bars, we know that the weight of the evidence, all of that checklist, conditions are ideal to launch your trade. That's a go. And now over here, where we're in purple and pink bars, these are no-go conditions. We've built some sensitivity into the model so that you know when bullish conditions are strongest, they're in blue. Weaker form bullish are aqua. Strong form bearish bars are purple. Weak form are pink. And then, of course, where we have an amber bar in the neutral territory, Alex and I are big fans of the life and work of Jesse Livermore, who said there's a time to go long, a time to go short, and a time to go fishing, meaning that trend followers have to look for the market conditions that are most favorable. It has to be directional, and it has to have some strength and velocity to that move. When everything is in neutral and all the components in that checklist tell us we can just step aside. Now, we're so proud of this work, so captured by the idea that everyone should have access to complete technical information. We're just giving it away. So for everybody who's watching this online on YouTube, or if you're here at the Metastock Traders Summit, go onto your Metastock account and you can apply the Go-No-Go template. It's as free and as simple as that. We just want to know how you're using it. Send us some feedback, info@Go-No-Go charts. Let us know what you're trading, what your time frame is, how it's changed your discipline, if you're able to stay with trades longer as a patient investor when they continue in go trends, and if you're able to cut some losses shorter when they switch into no-go. Now, Alex mentioned one more really important point, which is that price is the most important indicator of all. And when we saw that do not use chart, right, the price panel was really tiny. We couldn't even see price action. After all, it's only price action that gets us paid as traders. So we really want to keep an eye on that without clouding our chart with lots of indicators. We want to be able to see those clear price levels of support and resistance. We want to be able to identify patterns. If you're a candlestick trader, you might be looking for some of those setups. You can use that with all of the benefit of trend identification behind your chart using a Go-No-Go trend chart. So Mark Abraham says that ultimately it's the dollar-weighted collective opinion of all market participants that determines whether a stock goes up or down. And that consensus is revealed by analyzing price. This is exactly what Steve Bigelow was telling us this morning. We believe in fundamentals. It's fundamentals that drive trends. But we know that the best fundamental investor out there is the market itself. And that collective opinion of everyone's idea around the fundamentals will arrive in the price of the chart. All right. So Alex, let's do a few together, right? Quick review of the colors. Strong bullish conditions are in blue. The weaker form bullish conditions are in aqua. Our amber neutral go fish bar is in the orange amber color. Weak bearish conditions are in pink, and the strong bearish conditions are purple. So let's walk through a few of these together, Alex.
Yes, sir. So the first one I think we're going to look at is the S&P, just as using the ETF, the spider, and we're in a no-go trend, right? We keep getting this question. We keep talking about it in our research. You know, are we seeing the start of something more constructive to the upside, or are we seeing a relief rally and a downward move? And as far as we know, using the weight of the evidence that's blended into the Go-No-Go chart, we are in a no-go on the S&P. Now, today, I think this was taken this morning, but before the market opened, today we're pretty flat. So not a lot of change here for today's price action. But until we see these trend conditions change, we will be on the side of the no-go sentiment.
Absolutely. One important point to note about go, no go charts is that during the day, so each of these is a daily bar, during the day, as price fluctuates, so will the conditions and the calculations, all of the computation that goes behind that color. It could change throughout the day. When the day closes, the color never changes. So when we lock into the end of a period, whether that's a 15-minute bar or a weekly bar, it's there and it's never edited. It doesn't get restated. Price is price. So when we're talking to our clients about, oh, there was such a huge rally on Friday. Well, let's look at it in context, right? On a daily basis, the no-go trend conditions haven't even left their strong form bearish conditions, meaning that relief rally hasn't done enough to construct the S&P out of that damage that's been done. We've got a series of lower lows and lower highs. We also know the technical analysis exists over multiple timeframes, and daily and weekly charts might not be for you. You might be trading shorter intraday, but we do encourage all of our clients to look at a multiple time frame approach to all of their trades. We want to understand the primary trend, and this goes back to the OG technician of the United States, Mr. Charles Dow. Over 130 years ago, he recognized that investors will move in and out of the markets according to what he identified as 3 core timeframes. So that primary trend, when he's talking about very long term, he's talking about economic expansion, the gross domestic product of the company, the fundamentals of the underlying industrials and transportation sectors. Now, the primary trend, we're going to mean revert above and below in the secondary period. This is where a lot of technicians have really made some hay while the sun shines, because you can trade with the underlying bias of the primary trend, but you can capture those mean reversion moves to the upside or downside. Charles Dow was a very nautical man. He talked about the primary trend being the tides of the ocean, and that secondary period being like the waves. And then he identified the minor trend, or that tertiary period, where it's very, very short-lived. And he talked about that as the ripples on the surface of the waters. That's people's reaction to different news headlines. And frankly, in the last few weeks, with these bear market rallies, these relief rallies, we have seen an incredibly overrun narrative machine trying to tell people this way or that. It adds analysis paralysis. We have to remove that subjectivity, right? Just as John Henry told us, we have to focus on what's actually happening. And so when we look at go-no-go charts, we can see the trend very, very clearly, even in those relief rallies. Alex, let's look at a very long-term weekly chart.
Yeah, and like Tyler said, your multi-time frame might be starting with the daily as the largest time frame, going down to the hourly, and then perhaps even the 5 or 10 minute. But we're going to use the daily as a sort of tradable time frame, and then look above that to the weekly time frame to get our overall market bias. So a lot of times when we work with portfolio managers, they're going to have a bias. So they might look at a time frame, one larger than where they are asking their traders to trade, to know what side of the market to be on. So if we look at the weekly chart here, we can see that we're in a strong no-go trend. The market rolled over really sort of towards the end of the year. And this year so far, we have seen a strong no-go trend with lower lows and lower highs. So when we look at the daily chart then, knowing the context of the larger trend, we're going to be more likely to be taking positions in that direction, or at least a little bit more cautious around any kind of rally in price, given what we know about the larger time frame. So then if we were then going down in time frame, which we might, as a portfolio manager talking to a trader, perhaps we're trying to exit a position because the no-go's in place, perhaps we're trying to play to the downside. But would we be looking at the hourly chart, this is, I think, or the 120-minute, and saying, okay, we're going to short this right now? No, because we're in a strong go trend on the shorter time frame. But if we combine our context from the larger time frames, we may be waiting for that no-go on the shorter time frame to get us back in the trade in the direction of the larger time frame. Or if you look back in this chart, the earlier in the chart where we saw that no-go trend emerge, that might have been a good place for us to enter based on what we know about the larger time frame, with the daily being a no-go and the weekly being a no-go.
So Alex and I, when we titled this, Forecasting Follies, right? We're not trying to teach anybody how to trade in one way or another. This isn't the Alex and Tyler trading methodology. What we have developed is a comprehensive technical tool that you can use in whatever trading strategy you employ. So whatever your time frame is, and of course, whatever your asset class is. We're students of the great technicians like John Murphy, who wrote a fantastic book called Intermarket Analysis, and also folks like Marcos Katsanos, who've built off of that to try to quantify what those correlations are between the asset classes. Now, you might be an equities only trader, you might be long only, that's just fine, but there is so much information in a multiple time frame perspective and also looking across the asset classes. So Alex, let's do a little round robin using just the go-no-go trend to get an idea of the flavor of the marketplace right now.
Yeah, and this is where it gets really valuable, I think, for us when we look through that macro top-down approach to get a sense of where the trends are and what asset classes are performing well and are likely to perform well. And you can set this up so easily with sort of a multi-chart layout in your Metastock platform and get a sense really quickly of how those assets are rotating in and out of trend. And so right now, really quickly, we go around these charts. We can see that the equities are in a no-go, treasuries are in a no-go, but they've rallied enough to paint weaker pink bars. Bitcoin is also in a strong no-go, and gold is in a weak no-go. Now, the two charts on the right are very interesting because US oil up there on the top right. This is a very, very interesting moment. We've got one pink no-go bar at the very end of this chart. And we haven't seen a no-go bar in oil really the whole year. So we're going to be watching very carefully here to see if we can regain the go trend, given that if we were to back out and look at the weekly trend, we know that oil is in a larger time frame go trend, or is it going to be the start of a more significant corrective price movement? And then on the bottom right, the dollar keeps surprising everybody. It corrected earlier a few months ago, and now it's back in a go trend and painting those weak aqua go bars.
It is tremendously helpful to understand what's happening across the asset classes and on longer term timeframes before you make your trading plan. Alex and I are going to talk a little bit in the second half about the complete set of tools from Go-No-Go Charts. But right here, I want to congratulate everybody because you made it to the 50-yard line. We're about halfway done. I wanted to take just a second and answer a couple of questions that came in just while we were talking about the concept of Go-No-Go Charts and that Go-No-Go trend simplification. So Alibek was asking about the psychologist. That's Daniel Kahneman and Amos Tversky. Did some groundbreaking work in the 1970s. I highly recommend you checking out all of Danny Kahneman's work since then. And there are many other behavioral psychologists, Richard Thaler and many others who've written about the human nature, the things that guide us that are not always rational. And economists, at least when I went to business school, we talked a lot about efficient markets and the rational investor and how we would always optimize. That's just not the case in today's marketplace. We've got a couple other questions. Go-No-Go on brokerage platforms. We'll talk about that in a minute. And then, let's see here. There were two more at the end. Yearly charge in Indian money. So in rupees, we can do a quick translation, but we'll get to that at the end. So now that we have hit that 50-yard line, we've talked to you about the methodology for Go-No-Go Charts. Now we're going to switch over and we're going to talk about the complete solution, how we've developed tools that look at not just trend, but also momentum, volatility, and volume. We use some really interesting data visualization to help clue us into what's going on. So as we just talked about, we want a simplified price-focused chart that keeps all of that technical information, but without the clutter of multiple indicators. And here in the second half, we're going to talk about this lower panel. This is the Go-No-Go oscillator, and we're going to talk about the concept of momentum and volatility and volume. So Professor Cole, let's talk about momentum for a little while, shall we?
Yeah, we'll roll through this, but I love to talk about acceleration when I'm trying to teach momentum because to me, it makes a lot of sense in the way to think about it. So what we're talking about when we say momentum is the rate of change of price. That's what we're trying to measure. And that gives us a sense of the velocity of any kind of price move, right? And that can tell us so much about the strength of that move. And if you think about a car accelerating, right, what you're getting is, depending on what your situation is, if you're pulling onto a highway, you're going to accelerate very quickly. Let's say you're pulling onto a highway from a very slow off ramp. You're going to accelerate quickly from 10 to 20 to 30, and the speed of your acceleration is going to be maintained. It's very fast. But as you get closer to those highway speeds, you're going to still get faster, but you're going to get faster less quickly. So that's the key concept here to understanding momentum and divergence and all of the valuable information that we get from these indicators, right? So if you are, keep thinking about that car just for a second. If you are driving onto the highway, but you're getting faster more slowly, that tells us we're getting close to the highway speeds. You pull onto the highway, you're most likely going to drive at the speed limit, right?
Not if you're my wife.
And if you're driving at the speed limit, you're not getting any faster anymore. So that decreasing momentum of acceleration sort of tipped us off to the fact that we're getting close to our top speed and we're not going to go any faster. And then the most likely thing after that is probably that we pull off the highway and we'll have to get slower because we're now on local roads. So that decreasing of speed of acceleration, where we got quicker, but we got faster, but at a slower rate, that told us we might top out and then come off the highway eventually. And so that's really the idea of momentum.
And as everybody in the New York tri-state area knows, right, freeways move quickly, and then you hit traffic and you slow down, sometimes even stop before moving on again. We're going to talk a lot about that concept of momentum within trend in just a second. But Alex, why don't you roll through just sort of the idea of the methodology combining and blending multiple momentum indicators?
Yeah. So it's the same concepts are applied to the rest of the go, no go charts. And what we wanted to do was create a chart that gave a complete overview of the technical analysis of any security over any time frame, but keep it as simple as possible. And so I'm a big believer in the valuable information that is within these indicators. And so yes, I look at, RSI, stochastics, percent R, whatever whatever makes sense from a technical perspective. You need that information. But as you add indicator after indicator after indicator, this is just momentum indicators on this chart. Imagine combining it with that chart at the beginning, which was trend concepts. Now you've got a chart with, 12 plus indicators on there. Price gets even smaller, and you end up with a worse problem than we initially outlined.
Absolutely. Now, the go-no-go oscillator works in the same way that any other momentum oscillator that you might be familiar with will work, right? We're going to track highs and lows in an overbought and oversold condition. And what we're looking at here is the aqua line that is oscillating above and below the zero line. Alex, talk to us a little bit about the ranges for a go-no-go oscillator.
Yeah, so the oscillator goes from -6 to +6, and you can think of this oscillator and read it very much like you would read any momentum indicator that you use. But remember, it's got several blended inputs to this that take account of shorter time frames, larger time frames, sensitivity, and things like that. But with the one momentum indicator, then we can get all of the information we need. So you can still look at extremes of overbought and oversold, right? So when the oscillator peaks, those pulls out the peaks and troughs that you see in price. And you can also look for momentum divergence very, very easily. And I talked about that with the example of the car accelerating. When price makes a higher high here, the oscillator makes a lower high in the panel below. So that's a traditional use of momentum in conjunction with price. We've also incorporated volume into this panel. And you can see that on here on Metastock, when the blue ribbon appears, when it goes from black to blue, that tells us that volume is relatively heavy. So if you're seeing a correction in price after a bearish divergence and it's on heavy volume, that might be adding weight to your opinion on what's going to happen next. But if we can think about that oscillator panel below, what we're going to move on and talk about now is how it's very difficult to understand the power of momentum analysis when in trend, and that was a super fascinating part of my studies in technical analysis. And there was a lot of great work done by people like Connie Brown, who wrote about ranges for momentum indicators. So if you think about the RSI, I use that one all the time in presenting because it's the most popular momentum indicator and the most used around the world in technical analysis. When you're in a strong trend, let's think about an uptrend, prices moving higher. The RSI will go overbought, and then it will come back into neutral. Now, there's two things that are going on here. The textbook sell signal for RSI is when it comes from overbought back into neutral. But if the trend is strong, that's not a particularly good place to sell into the strong trend. So we know that sell signals on momentum indicators do not do much for us in strong trends. We actually work with a lot of people that buy overbought when in trend, because that shows excessive buying and market participation in the up move. But on the other side of that, when the market does correct, prices don't move up in a straight line. When they come back, the momentum indicator should not go oversold, right? Oversold suggests aggressive, enthusiastic selling. And if the trend is strong, we don't expect enthusiasm to the downside. So what we found with momentum indicators is that they range from overbought to neutral when the trend is strong. Now, that's incredibly valuable information, but the problem is that these oscillators are very fast moving and that they are subjective in terms of where we can identify those ranges. I work with people in FX and different markets, and they will move those overbought, oversold levels for RSI based on what they're looking at. And so if you're trying to determine a range, and you in the research done, a lot of the ranges given are 40 and 80, let's say, for an uptrend. You see the oscillator coming down to 40. It gets to 42, 43. Now, are you going to consider that a touch of support if it hasn't quite got to 40? Or what if it goes to 38 or 39? Are you going to consider that a break of support because it's gone below 40? Or is it close enough to 40 that you sort of consider it still support at that level? That's your problem. It becomes a subjective game when trying to use momentum indicators in a trend. So to cut to the chase, when we created the go, no go oscillator, we wanted to calculate it in a way that when all of the blended inputs go into their neutral territory, go, no go oscillator goes to 0. And that way, when we have rallies in price, we have momentum is overbought and it comes back to neutral, the oscillator hits a completely objective level of 0. And then that allows us to see those moments when the trend continues having corrected. And that gives people the opportunities to stay with the trend, to scale up their positions, to get that outsized alpha, and really gives you a sort of a less questionable way to see momentum support what's happening in the price panel above.
And so over a decade ago, I had my MBA in corporate finance from Indiana University, and I moved to New York City and found out about this whole world of technical analysis. And Ralph Acampora, one of the greats and a close friend and mentor, took the time to explain some of these things to me. Now, I had read about Wells Wilder's RSI, and when you think about the range-bound market of the 1970s, they were looking for extremes in the momentum oscillators to signal buys and sells. So if it gets to overbought, a lot of early technicians made the mistake. If it's overbought, then you sell it, and if it's oversold, then you buy it. And Ralph said, Tyler, you don't sell overbought. And Ralph grew up in the Bronx. Everything's a baseball metaphor, so stick with me for a second. He said, if you've got the ball in your glove and you throw your baseball up in the air, the point when it leaves your hand, that's going to be the fastest it ever moves. And as it reaches the apex, it'll slow down and then it'll come back down to your glove. But that neutral momentum that Alex is talking about, getting to the 0 line, means the ball came back to your glove. And what do you do again? You throw it back up again, and it comes back to your glove and you throw it back up. Now, if it breaks through the 0 line, you didn't catch the ball. The game of toss is over, right? There's a real threat to the go trend. But as long as the ball is in our glove and it keeps coming back to this 0 line, we know that price is going to continue to move. It's in a go trend. Momentum remained positive, comes back to neutral. Consolidation or taking a breather, digesting the gains of the market. These are all different ways to describe the same thing, which is that price doesn't move in a straight line. But for all the portfolio managers that we work with, they take those small losses, and in order to maintain their profitability throughout the year, they need those large outsized gains. So for all of you who are there, if there's one thing that you take away from today's lecture, it is that being a patient investor and sticking with a trend that's working, or even pyramiding your position, scaling in and getting really outsized on the parts that are working in your portfolio, on the trades that are working to your advantage, That's what's going to deliver those outsized gains. Now, we always have responsible risk management in place for trading with stops, but with go, no go charts, you can identify these buyable dips in the trend because we've got that objective zero line. Now, to make that even easier, Alex is a data visualization junkie, always has been. And we both believe that human beings, part of those mental shortcuts we were talking about, we're very visual thinkers. We can process a ton of information in a picture a lot faster than we can go through tables and tables of just raw data. So to make it even simpler for the go, no go oscillator, when it hits those points at the zero line, we're going to talk about trend continuation. Alex, I didn't mean to steal your thunder. If you want to walk through this, that would be just fine.
Yeah, no, not at all. So it's just the idea that we want to understand that interaction, that interplay between the trend and momentum, and then view it as simply as possible. So when a trend is in place, like in this case, we've got aqua and blue bars. When a go trend is in place, if the oscillator finds support at the zero line, then we're going to show those moments on the price chart with the green circles. And those highlight then return of momentum in the direction of the trend. We can confidently say trend is in place and momentum has come back in the direction of the trend. So those are low risk opportunities to enter that move. Now, the other type of icons that we also throw on the chart are called counter trend correction arrows. And that's because we still feel there is value in using momentum analysis in the traditional sense. So the counter trend correction arrows tell us when momentum has gone overboard, when in a go trend, and then has cooled back into neutral territory. And we can say then that in the short term, there may be some struggle for price to go higher. We can say that they're counter trend corrections. Now, just quickly to be clear, if you flipped this to a no-go trend where you had purple and pink bars and price moving down, the trend continuation icons would be red circles, not green, and the counter trend correction arrows would be green, not red arrows.
So there's an example right there where the momentum oscillator, go-no-go oscillator, came up to the zero line and was rejected, right? So we know the concept of polarity is either support or resistance, and support becomes resistance once broken. So this red circle tells us we got to zero, neutral, and we're rejected back in the negative direction. So the no-go trend continues. So Alex, the last piece of the puzzle, the go-no-go squeeze.
Yeah, in my career working with people that maybe were oil traders, people that were long-only mutual fund managers, maybe people that were the head of research in FX, I needed to be able to give a complete overview of any asset, like I said, over any time frame, with one chart that was easy for me and clients to understand. So the one piece that's then missing is a sense of volatility. Volatility can be very, very helpful in identifying those large moves. And you're probably familiar on the phone with things like the Bollinger Band squeeze or the Keltner Band squeeze. And we want to identify moments where volatility has been compressed. If you think about the Bollinger Bands, when the Bollinger Bands narrow and we break out of those bands, we say to trade the direction of the break, not to mean revert, because we know that that compression of volatility often leads to a significant move in one direction. So what we try to do is identify that on the go-no-go chart by allowing the go-no-go squeeze grid to build for every bar that the oscillator stays at zero. Right? We know the importance of the zero line now from the previous few slides. When the oscillator hits zero, it should get rejected if we were in a no-go, or it should find support if we were in a go. So when it stays at zero, we're calling it like riding that zero line. It tells us that there's been very little direction in momentum for an extended period of time. Now, there might be a lot of trading going on there, a lot of volume. As you can see in the middle of this squeeze, we have heavy volume, but there's no clear pull in one way or the other. Volatility is shrinking, price bars are shrinking, and we aren't getting overbought readings. We aren't getting excessive buying or excessive selling. We're getting a neutral reading in the oscillator for an extended period of time.
Now, I love the idea of visualizing what is happening in the marketplace. So let's just read this chart like we're reading an orchestral score, right? We're in a no-go. We've got selling. We've got negative readings from our momentum oscillator, the go-no-go oscillator. We come up to test the zero line again, And instead of being rejected, we get locked in there. And here volatility shrinks. See the range of price action continues to shrink and shrink, compress, and we've got that tug of war happening between buyers and sellers. We can see it on the chart because the go-no-go squeeze grid has climbed to its max position. It's sustained there. Price volatility is shrunk and collapsed and compressed, and we've got heavy volume. And when it breaks, right, all else being equal, we're in a no-go trend, right? Momentum has been negative. All else being equal, we would expect it to then return negative and the trend continues. When it doesn't, here's our big leading indicator. It breaks positive out of a max squeeze, preceding the trend change, preceding this upward price action. Now we know that the buyers have taken control, right? That tug of war is over. And what happens in the marketplace? When there's a clear direction, everybody piles into that trade. Now, some of us take longer to recognize the move than others, but we all pile into that trade, and that's what creates a long, durable trend. So when we see these breaks of the go-no-go squeeze, it's a very, very important leading indicator, and it can tell us a potential high velocity move in either direction, in the direction of the break of the momentum oscillator. All right, I know that was a lot. I'm sure you all have pages and pages of notes. I want to tell you just a little bit about some of the other things that Alex and I do. If you are a user of Go-No-Go Charts, you probably are also a subscriber to Go-No-Go Research. We started this company specifically just for our institutional clients, and it's been with the help of Jeff Gibby and the team at Metastock that we're bringing these tools to individual and self-directed investors. So we know, right, the pandemic has not been easy on anybody. You've got other commitments, family, work, the rest of life. Trading is not something that you can do 20 hours a day, all day long, right? So we're with you every week. We publish 2 major pieces every week. One is Flight Path that goes out pre-market Monday morning, sort of a top-down research note that looks across the asset classes, into the sector groups, and then down to individual securities. And then on Saturday, because we like to practice what we preach, we send out a chart pack. So when we're not trading during the weekly market hours, on Saturday, we want to just review those longer term trends. We want to go through and see the message of the market without all of our anxieties, fears, and greeds clouding our opinion. So launch conditions goes out every Saturday to our subscribers. In addition to Go-No-Go Research that comes out on the weekly basis, we also have premium research that's going to talk about individual trade ideas and Go-No-Go setups. What we're going to do now in the last 15 minutes of today's presentation is that we're going to talk about the things that we have been writing about in Go-No-Go Research all spring, the entire year to date, and talk about some of those big rotations into cyclical and value-oriented sectors away from the growth equity economy of the pandemic. 2020 and 2021 were banner years for growth equities. We have not seen that here in 2022. So from Flight Path, May 23rd, what we were talking about was the inflection point in the S&P. And then, as I mentioned, with the daily ideas, we're going to look at individual securities every single morning with great Go-No-Go setups or changing conditions. This was just a note about Landstar systems. So, Alex, let's dive into a couple of examples, starting with Snap. This one came out May 24th. We were talking about that continued selling pressure. And as Alex said, right, we know that the data visualization is going to work in both directions. We just changed the color. So for those of you who are trading to the short side, we saw that trend continuation as momentum reached the 0 line and was rejected again. How did that play out for us? That idea came out right here ahead of the gap down for Snap. And we can do a few of these together, right? There's only 3 big things to consider. One being the trend, one being the location of the oscillator. What's our reading on the Go-No-Go oscillator? And then is there anything important happening at the 0 line? So go ahead and shout it out at home or throw it into the chat if you'd like. What's the trend? We're in a weak no-go condition on Snap. We've got these pink bars. Our oscillator is at 0. And we are beginning to build the first line of the Go-No-Go squeeze.
Yeah.
And there it is, Alex. Sorry, the charts were a little out of order this morning. I apologize, friends. These are the 3 things to consider, and let's keep cranking through some examples. Alex, why don't you do this next one on Treasury yields?
So what we were then thinking was we've gone through the way we read them. As Tyler said, I'm gonna just reiterate that it's very, very simple for us to talk to anybody about anything, right? So we can say, where's the trend? We know because the weight of the evidence, the blended trend indicator will tell us. Where's the oscillator? The blended momentum oscillator will give us a sense of where momentum is. And if we can understand what is happening around the zero line, then we have all we need to talk competently about the market that we're looking at. And for the rest of this presentation, what we wanted to do was take some of the bigger ideas and look at what's affecting the stock market and what we're talking about and what we're seeing when we put out our research. So we've been talking about treasury yields for some time. And again, this Monday, we put these charts into research. That's today. Of course, I didn't mean to say this Monday as if it was a while ago, right? This morning going out. And I believe also we've unlocked the Monday's research report for anybody here on the webinar. You can go to the site and you can see our research report that went out this morning pre-market at 9. But treasury rates are so important, and they've been creating headwinds for equities all year. And right now we're looking at the rates again at a critical point, I should say, because we know that the trend is still in place, right? If you're watching this, like we said before, have a go, see what you think. Where's the trend? The trend is a weak go. It's painting an aqua bar. Where's the momentum oscillator? It's at the zero line. And is there anything important happening there for around zero? Well, yes, a go-no-go squeeze is starting to build, telling us that there's a beginnings of a tug of war here between buyers and sellers. And what we would expect, all else being equal, is that zero line to provide support. If it does, then we can look for price to try to make an attack on that previous high. The high we can see there was highlighted by the counter trend correction arrow, that red arrow. But if we find support at zero, then we may well see yields continue to rise, which would affect, of course, stocks. If it was to break below zero out of the squeeze into negative territory, then more of a correction perhaps coming in rates. So that's where we are with treasury yields.
So remember, yields move inversely to bond prices, right? So bond buying last week, a little bit of a rally in the stock market. We saw yields taper off in the wake of the FOMC. Chairman Jerome Powell did the 75 basis point hike. That's what Wall Street expected. There's some good news baked in there. But we also know that that narrative machine is not nearly as helpful as just looking at what is actually happening and then quantifying that. So we can see this is still in a go trend, treasury yields moving higher. And for Alex and I mean, we spend a lot of time with our long short fund managers, with research analysts, folks who are incredibly knowledgeable macro analysts, and they use these tools because it helps them simplify their message to clients, helps them simplify their trading decisions. But we spend as much time listening to them as we do talking to them to get an understanding of what these macro forces mean in the context of what they've seen historically. So obviously, historic move in yields. Another historic move, the U.S. dollar. And you know, when we were looking at these on a quarterly basis, super long-term charts, we're actually breaking out above multi-decade highs. Next level of resistance is actually at the 2002 highs. 20 years ago, we saw the dollar at about 120, the dollar index. And so there's not a lot of resistance between here and there. Obviously, it's not going to take a straight shot to 120, but we know that dollar strength is inversely correlated to a lot of equities. Certainly for those of you who invest globally, emerging markets have really faced some tough headwinds in the face of this strong US dollar. So when we look at the trend on a daily basis for the USD, we've got a weak go trend. Our oscillator is at zero. That's correct. And what's happening? We're starting to build a squeeze. We're testing the zero line from above. And we know that all else being equal, we should see support right here at this neutral level and break again higher. If we don't, and the oscillator breaks to the downside, that's our first indication that perhaps the go trend for the US dollar is in trouble. And again, these are daily charts, not weekly, monthly, or quarterly, where we're talking about the really big picture perspective. For a look at that, here's the weekly chart on the US dollar. Alex, talk to us about the big picture.
Yeah, so to put those dollar moves into context, we see a little bit of corrective action in the dollar, but we see the oscillator at zero, and it's an inflection point. We're going to try to see what happens. But if we look at the weekly trend, then there's no threat yet to this longer term trend in the dollar. In fact, we're close to the highs that we've seen in this move. We've seen the go trend take hold and really continue to paint aqua and blue bars without interruption. And we've seen that oscillator find support at the 0 line throughout the move. So where are we on the weekly chart? We're in a strong go. Where are we with the oscillator? We're at 2. We're on heavy volume. And is there anything that's happening around the 0 line? Not right now, but we recently did just find support again, which led to our climb back to challenge those prior highs. So if you look at the weekly chart of the dollar and then you look at the daily chart, you're thinking maybe we're more likely to find support at the 0 line than break through it to the downside, because the weekly trend we know in the dollar is still strong. Of course, we don't predict, but we just try to react responsibly.
Now, I want to answer just a couple of questions. Forget that this is a US dollar chart. This could be a chart of anything, right? Whatever your favorite equity is. Let's walk through the life cycle of a trade really quickly. Felipe was asking, can you use this to the short side as well? Well, let's just consider, if we are short traders, we're in a strong no-go condition. We've got a short on US dollar on this weekly basis. We use the tools in the same way to the downside as we do to the upside, as Alex was just talking to us. When we're in the no-go trend and we see momentum come back in the direction of the trend, right? So a resumed negative momentum reading gives us these red circles. These are the trend continuation icons. Green circles are trend continuation icons in an uptrend. So we're coming down, we're staying short. We've maybe even added to our position with each of these red circle icons as momentum is negative. Now momentum breaks positive, retests, and stays positive. We have the first reading, amber bars, meaning we're in neutral territory. We've covered our shorts, right? That's the end, as far as we're concerned, of that downward trend. When we hit that amber, we're covering our shorts. We're not levered into that position anymore. And then we see trend conditions change and the fresh go signal is fired. So, right, we want to be open-minded enough to know that this security, whatever it is in your playbook that's been a great short trade, when it reverses, we want to play it to the long side as well. We want to stick with that upward trend as long as it is in that go condition. Again, adding to positions, taking re-entries with each of these green circles. So that's the idea of go-no-go charts, is that whatever your time frame, whatever securities you trade, you can use this technical information to your advantage. And we had one other question from Chalapati, I think, who was asking, these are lagging indicators. How do you make that work? Well, let's just consider trend following, right? The greats, John W. Henry and trend following investment managers. They're trying to profit on the majority of the move. For a lot of our institutional portfolio managers, the mutual fund complex, they're looking at weekly and monthly charts. They want to capture from the big picture move. But if you're a short-term intraday trader, these could be 5-minute bars. Great. You didn't get in at the absolute low right here, but 5 minutes later, your go trend started. Now, the reason it's a lagging indicator is we want all of the weight of the evidence on our side. We do not want to be whipsawed in and out of our positions all the time. That's going to happen sometimes when we're in a really messy range-bound market. But for a proper trend, we know that we can stick with it for the long haul. So I understand for some folks, if you're looking to capture the absolute top and the absolute bottom, you may just want to look at shorter time frames. So in the context of this weekly chart, if we were to look at 1 hour bars, you're going to get very, very quick entries and exits from that weekly trend perspective. So that's why we talked about the multiple time frames. How are we doing on time? We've got just a couple of minutes left. I wanted to answer these questions. Got some interest in KWEB. That's a Chinese internet stock ETF, which has been very beaten down. When you look at daily and even weekly charts, it's just destroyed. But of course, on the monthly and quarterly charts, we're looking at trend line support. So we can pull up some live charts if there's time, Jeff. But really, really quickly to conclude what we're doing here, the team at Metastock has delivered some really powerful tools to help you all use go-no-go charts in your own trading practice. The first is the expert commentary. So they have built into Metastock, if you want to highlight a single bar and just understand what's happening, exactly as if Alex and I are right there at your elbow, helping explain the charts to you, you can see on any bar, what are the conditions? What are the icons telling us? How, just as we did, we walked through trend, oscillators, zero line. It's going to provide that same kind of commentary to you. And then we also know that going through 3,000 charts every morning to find those trade opportunities is not an exercise that most of us have time for. So screening, Metastock explorations are going to help you narrow down your universe by whatever conditions you want, but using that go, no go methodology. So you can find everything that's striking a new go trend or everything that's breaking out of a max squeeze and just distill your list to find those trade opportunities yourself. That's all built into Metastock. It's not additional. It comes with the complete go, no go charts package. We've got a couple more explanations, but I think why don't we trim it right here and turn it back to you, Jeff, for any questions.
Okay, thank you. I don't think we have time for a chart review, but I did promise we'd look at KWeb, and so I have it up.
Awesome.
Let me go ahead and just take the screen over, and we'll just show you what it looks like.
I'll answer the question about the CMT exam. So for those who are
I hope you
familiar,
passed.
Chartered Market Technician, CMT, it's a 3-level exam process. Very, very arduous for the folks who are looking at it. It's an academically rigorous pursuit, a broad understanding of technical analysis. For those of you who took the exams in June, you will find out it was 8 weeks from the end of the exam date. So really by the end of July, we should be looking to have results out. And I want to encourage everybody who's on the line, if you are really passionate about technical analysis, this is grad school. This is the real deal. And Chartered Market Technicians, CMT charter holders that you see on financial news media, they really know their stuff. They've mastered this body of knowledge, and the CMT is a great nonprofit organization that really serves its members. So there it is on the CMT Association. Let's look at KWeb.
Yeah. KWeb, this is the daily chart here. So you can see that the go trend has been in place for a few weeks now on KWeb. You saw the bullish divergence between the oscillator and price, sort of in the middle of that chart. As we struggled to go lower, the no-go sort of ran out of steam. You see the no-go become an amber go fish as the oscillator broke above zero. And right now we've been in go bars with the oscillator finding support at the zero level. I think if you were to back this out to a weekly, I don't think we're there yet in terms of a go trend. But again, the daily could be your large time frame, and you could be going down in time frames to look for entries. But that's just my guess. We might be, but from my internal understandings of the indicators, as I kind of I work with them so much and all the time, I just kind of have a feeling we're still in a no-go there on the weekly. But interestingly, here on the weekly, we have broken above zero on the oscillator. So that's our first sign. If you zoom in a little bit, Jeff, to get the sort of half of the chart, you see how during that no-go, we were finding resistance underneath the zero line all the way through this last no-go in the weekly. And now for the first time, we haven't been able to get that rejection from the zero line. So that's a threat to the no-go. We've got weaker pink bars, oscillator breaking out of the squeeze into positive territory. We know that shouldn't happen in theory in a no-go. So that's some cause for optimism if you are looking to take a bull position in KWeb. Go down to the daily chart, we see it's in a go, perhaps go down to an hourly chart and look for specific entries.
Thank you, guys. I appreciate that. Thanks for coming in. Always so fun to watch you guys.
Thank you so much.
I couldn't think of a better way to spend a Monday morning. Thanks, guys.
Thank you,
Yes,
Jeff.
we'll see you again soon. Take care, everybody.
All right.
Bye-bye.
Okay, here we go. Thanks. Yeah, great job. Let me do this. Let me go ahead and do this. Yes. And we'll just talk real quick. Hey, Guy, I can see you coming in. How are you? All right. Well, let's see. I can't hear you quite yet, but let me just recap really quick. I know we're a couple minutes late. Apologize for that. We'll do this real quick. So the go, no go complete is going to include the trend, the oscillator, the icons, and the squeeze. Been a very, very popular add-on this week or this year since we released it back in January. I love the crystal clear explanations that you get, the trend identification, the explorations, everything. So it is available. Normally, this is an add-on that costs about $1,500. Here at the summit today, we're going to do $9.95. We're going to also include access to training that Alex Cole, Tyler Wood, and myself sat down and we created a training videos to kind of help you understand everything, get everything set up. If you aren't using Metastock yet, will include a free trial to Metastock, and it does have a 30-day money-back guarantee on it. So it is, of course, part of our Trader Summit Action Pack, which is going to include Steve Bigelow's extremely popular CPS 2.0, the Go No Go Complete, the OVI Traders Club that Guy's going to talk about here in just a minute, the 3S Code with Silas Peters, 3 months of LearnMetastock.com, and Unleash the Power of Metastock tutorial videos that you can go through online. So normally the total cost for that whole package would be $3,630. Here at the summit today, we're going to basically cut that price in more than half. It's kind of like a summer special. $1,641 is what you'll pay for it. Give us a call, 800-882-3040, metastock.com/sales chat, or metastock.com/summit deal to kind of sign up for that. So appreciate that. Do want to say really quickly thank you to Stocks and Commodities for sponsoring the event today. We appreciate their long-term support of Metastock. If you're watching on YouTube, after you hit the like button, you can go to metastock.com/tradersummit and you can sign up for just a free issue if you register for today's event. So I'd recommend you do that. They've been making magazines on technical analysis since 1982. So they do a great job, but we certainly appreciate how much support they've been. Our next presenter today is Guy Cohen. Guy has been a partner of Metastock for years now. I knew when we brought him on, though, once I saw kind of the OVI patterns and kind of the OVI stuff that he was doing with options, that I wanted to make it available in Metastock. And so we've actually spent a lot of time making that a possibility and a reality. So I want to welcome you in here today, Guy. How are you doing? I can't hear you. So, okay. Okay. Do you see I can see you. So there's a start there. If you click on the audio button underneath sharing, sometimes it helps. I find it helps to go to no audio and then back to computer audio. Nope.
Now, try now.
Yeah. Yes.
Yeah.
Perfect.
Good. Sorry about that.
No worries. Let's make you the presenter.
I'm good. Yes, I'm recovering from COVID. Actually, I had it about a week or two ago.
It's
But I'm
running
good now.
around. We have some people in the office that are out because of the same reason. So
That's it. No, I know it's all going everywhere. Now, just a very quick one. Can you see my screen, everybody?
yes, we can.
See my
The big
screen,
money
see me?
strategy. Yep.
Very, very good.
Okay.
Okay, yes. So I'm going to do something very strange. I've got to go very quick. I've got a lot to show you guys. Jeff knows the deal here, but let me show you something because I think it's kind of interesting. We were just talking about KWeb, and I'm going to show you something you're going to really recognize later on. I have this thing here called Big Money Footprints. Just give me a wave just so you can see what I'm doing here. But what Jeff's been talking about, and we deploy it on the Metastock charts as well. And by the way, I love Metastock people because you're the cerebral type. I like that. And Jeff, nice to see you too. But I want to show you something on KWeb just because we've been talking about it recently. You see this blue thing here, pretty much from there, it's been persistently blue. We're going to be talking a lot about that today. This is a proprietary indicator of ours, and we've been showing it being reasonably bullish for a little while, especially from the beginning of June, where it crossed that resistance line of the 50-day moving average and started to do something. So it's been on our radar, and actually some people have been actively trading it since that time. So how cool is it to have an indicator? Just give me a wave. How cool is it to have an indicator that shows you that without going into too much detail? Hopefully that's going to be something you're going to recognize this setup by the end of what I'm going to show you. So this is the big money strategy for small account traders, but actually it applies to other traders as well. Quick disclaimer: large potential rewards, large potential risk with stocks. Don't trade with money you can't afford to lose. Past performance is not necessarily indicative of future results, and we're not going to be giving trading advice recommendations here. You know the form. Okay, so in our world, we talk about what the 3 master keys of trading, which include market timing, stock selection, and trade plan. If you think about your trading, this makes complete sense. And today, I'm going to focus on the stock selection piece. That's the most interesting piece, if you like, of it. Now, is this technique I'm going to show you suitable for small accounts? Absolutely. Most people believe they've got a small account, or at least they want to have a bigger account. So it's kind of like a universal perception in any case. And here are some people here who thought they had small accounts. I don't think they did. I mean, making 4,500 in 1 hour or 76,000 in 206 days, I don't think that constitutes small accounts. But these ladies did kind of have small accounts. You know, $3,000 is pretty much what they started with, and they were able to make many multiples of them using the strategy that I'm going to show you. Now, this is what I'm going to go through. First of all, sorry about this, is the dregs of COVID. First of all, why stocks? Because we focus on stocks. I'm going to show you the secrets of growing a small account, why prices move, the mechanics of why a price actually moves and what you should be looking for. Then you'll be prepared for what we call the big money footprints, because what we do is we follow big money. That is our entire strategy. And then I'll show you a case study of how other people have 3x'd or more in a very short space of time, and a quick demo how you're going to find those setups. So first of all, why stocks? Well, so many different asset classes like real estate. The only thing with real estate, obviously, if you've got enough money, you should have some in your portfolio. But you know, it's a lumpy asset, isn't it? Often tied with debt, and often you're handcuffed to that debt for the longer term. Now, bonds and commodities tend to be rather specialized. Crypto and Forex tend to be rather a gambling thing. Let's be honest, it is, and they are. No real empirical edge to the retail trader, which is what we all are. And then you've got the alternatives like fine wines, classic cars, art, all that kind of thing. And that, again, is rather specialist. So what about stocks? Well, here's the thing about stocks. One, everyone pretty much understands stocks, values a company, getting shares in the value of a company. And also stocks are the one area where there can actually be an empirical edge for private investors. And that's why we're drawn to it. It can also be exciting. People want excitement. They go to crypto or whatever. They want to do the leverage of Forex. You don't need to. This is Overstock. Overstock 10x'd in 128 days on the way up and on the way down. So yeah, there are stocks that provide plenty of excitement if that's what you're in for. I like higher probability. That's where I get excited. But with stocks, you can be in and out very quickly in terms of gaining knowledge. It's easy to start. There's minimal cost. You can fast track your progress. You can do it anywhere. It's just as flexible as any other trading methodology. You get quick results, quick feedback, and it's very scalable. You can scale it, you know, with stocks, but you can also use options to scale up your stocks if you're any good at it, if you become good at it, and if you have a simple and logical and repeatable technique. And repeatable is a very big word. So why aren't all traders millionaires? Well, if this is you, raise your hand, nod, say yes. But overwhelmed, so much to learn. Where do you start? If you've had that, put your hands up. I certainly had that at the beginning of my journey. I didn't know who to follow, what to follow, which asset class, so many different choices. It's very overwhelming very quickly, which means there's a big pressure on time, because you're not just talking about one learning curve, you'll probably talk about, you know, half a dozen learning curves, and you're trying to figure out what are you going to do? What are you going to specialize in? Because the key to anything in life is specializing. So again, if that's you, holler out. Now, all of this takes endless amounts of time, so even more of a time hog, because you think you might have got the Holy Grail, and then you go and get that one, and then you get burnt there as well. Again, we've all been there and done it. And then who are you going to trust as your mentor, your guru, your methodology? Again, now professionals demand proof, and I deal with professionals. That's another side of what I do, and they demand proof. So here is one of our proofs. This is a S&P linked strategy that we do with something I'm teaching you about today, with a blue line, which since launch has done 63.52%, and this is the S&P, which has done 20%. So we've more than 3x the S&P in the same time frame, and we've maintained our advantage. Now, most private investors never get past the overwhelm, the time hassles, the trust issue, the proof issues, and they never get past that, and they end up feeling quite deflated. Now, I'm hoping that's not going to be you by the end here. So that's why we like stocks. They can be exciting, but they can also give you an advantage, and I'm going to show you how and why in a few minutes. So secrets of growing a small account, part 2. Well, one of the secrets is to specialize and keep it simple. Trading is basically about people, buyers and sellers, and you've got to pick the right team. Who's winning at the time in the time frame that you're trading? It's as simple as that. If you have complicated charts like this with lots of lines and arrows and angles and other complicated numerous indicators, I think you're going the wrong way. That kind of complexity will lead to inertia, lead to analysis paralysis, confusion, you name it, and you'll end up losing money. Now, if you can systematize, if you can specialize, if you can have a simple, recognizable, identifiable system where you can identify which team is winning, the winners or the buyers or the sellers, then you've got a great chance. And that's what I'm doing. This is George from LinkedIn says, I can vouch for Dr. Cohen's. I'm not a doctor. Magic system, 88% profit in just under a year. That was just last year. So the 3 principles of growing any account, whether it's small or large, but if you are one of these people who've got a small account, you feel a bit like, oh gosh, things are tough for me, the rules might be different. These are the principles: safety, growth, and mindset, and keep it simple. This is Tobias, who literally went from being painful to then being a consistent winner. And if you hang in there to the end, I'll show you how to get this book, which I co-wrote with one of my big, well, it was a report and a video series, which I recorded with one of my very big winning traders, who is now a mentor with us as well. So that I can go into more detail with, and you can get that at the end. So why stocks we've covered, and the secrets of growing account. Keep it simple, and again, safety, growth, and mindset. So why do prices move? This is the mechanics. Very, very important. Write this down if you need to. Let's start with a piece of real estate. There's a beautiful home here, and it's got an asking price of $950,000, which I think is a bargain. And you're going to picture that dream home, and now we're going to go through 3 scenarios, and each of them has an actual trading implication. So scenario 1 is everyone's bidding at the asking price. Asking price $950, everyone's bidding $950. You offer $950. Bob offers $950. Sue offers $950. Jim offers $950, and everyone's offering $950. What happens to the price? It stays at $950. Big money being thrown at this property is not moving the needle. Scenario number 2 is information, public information. Google, or one of the, could be Amazon, Google, whoever you want it to be, but opening up a headquarters, say 5 miles down the road. And with that, they're going to bring in lots of highly paid people into the area. They're going to want facilities. They're going to want homes. They're going to want schools. They're going to want restaurants. They're going to improve the area. Now, Bob, being a smart guy, goes, you know what? I like the fact that Google's moving. I'm going to up my bid from $950,000 to $960,000. Sue says the same. In fact, she's going to bid up to $970,000. You get the same information. You bid up to $990,000. Then Jim bids $1 million. You now offer $1.1 million. What have you got? You're in a bidding war. And that bidding war, it comprises of aggressive bidding. And what's happening is that not just money's being thrown at this property, but it's aggressive. So it's the A word, aggressive. And that's what moves prices. But there is one final scenario, which is even more important than this, because this is about public information. I'm now going to talk about what I call scarce information. So Bob upped his bid from $950,000 to $960,000. And then he's been doing a bit of due diligence. He's walked around the area, and guess what? He's found a nice parcel of land right behind this property in which he could either expand, build another house, make his house better, etc. And he's the only one in there who knows that, because the old couple who own that piece of land have told him privately that, with the right offer, they'd be willing to sell to him on that basis, but they don't want anyone else to know. Now, this is what's called scarce information, because only he knows. It's only privately available. Only he knows about it. So now he realizes by putting them together, he can add value, and now he can be prepared to up his bid to a much higher price, like 1.2 million. And that's what he can do. And the problem is that he's got information that you don't. And if someone else has got that scarce information, they hold an advantage over you. So we don't want Bob to get our dream home, do we? But this is the learning point. Information is valuable, but literally, scarce information is a life changer. It's transformational. Now, what is scarce information? Well, it's any information that other people don't have en masse. So, Diamond Dealer has diamond school information that you and I don't have, and therefore they know they can buy for X and sell for 2 or 3X every time, and that's worth million. They know the secret information of the cut, the clarity, the color, the carat, the source. They have more, and they have much more detailed information than say we do. We have enough to be dangerous. Who else has secret information or scarce information? Well, the Coca-Cola formula, held in that vault in Atlanta. It's worth billions. That's that. And what you get with that is repeatable profits. The diamond dealer makes repeatable profits, Coca-Cola makes repeatable profits, and so does KFC with their secret recipe, makes repeatable profits from scarce information. And again, it's worth billions. So scarce information is transformational, it's life-changing, and what we want to become is the diamond dealer of the stock market, having information that only a privileged few get to have. Now, we've done why stocks, summarized secrets of growing an account, gone by the mechanics of why prices move. Now we're ready for the big money footprints. And what we do is we follow big money. What is the big money? Well, it's, the footprints are where we can see big aggressive money present already in a chart, but also lining up for more, critically lining up for more. Now, 3 of these big money footprints are already available to you. I'm going to teach you how to actually go about them. And then the 4th, we're going to go into some detail as well. If you can identify these, then you will have a natural advantage. You'll have an inbuilt strategy. It's dead simple, dead logical, all about demand and supply, and you'll have a consistent skill to make money consistently. And we're doing this for a while, very successfully. Very quickly about me, I'm a very nerdy type. I like doing things like Rubik Cube. I like developing trading systems, etc. I've made over 7 figures, thousands of % in personal gains. I've done runs from 14,500 to 187,000 in very quick amounts of time, on a number of occasions. I'm also the founder of Wise Traders, which create educational and applications for stocks and options traders just like you. We're very much a family. I'll show you that in a minute. I'm also known in certain areas for my books, which are bestsellers, also being on the TV a little bit, on the radio a little bit, the form, that kind of stuff. Don't make such a big deal about it. Now, one of the big things that happened in my career was when I consulted and provided software for the New York Stock Exchange, and I provided data analysis for the International Securities Exchange in New York as well. And these were important because I got to see the data and I got to reinforce the fact that it's all about people. Don't overcomplicate things. Gave me what I call big money insights. But these have been my clients for many years. Now, what that means is that I've been able to create systems which are used by professional money managers that have outperformed the S&P, that now we're looking at other hedge fund situations as well. So I provide those training systems for money managers. Unlikely that you'll see other people doing that in these kind of forums. And literally my systems are being traded to the tune of tens of millions of dollars every day, which is still only a tiny, tiny pinprick in the market. But in terms of one of the systems that we look to outperform the S&P, it has done so by 11.8 times since testing began, or 11x, or 1,082%. And in the last 2 and a bit years, last 28 months since it was launched, it's outperforming the S&P by 3-fold, and that's what it's designed to do. And that's why I get big fees, from professionals, money management publications, etc. Now, in Wise Traders, we have a community of private investors, just like you, many of which actually are also in the Metastock family as well. It's a lovely family. Between Metastock and ourselves, we have some very high quality, high caliber individuals and also people who are successful at trading. Now, these two are not in that, but these two, the kind of impact that we have for people is like what we've had with Chloe and Roger. Roger in retirement making 700,000 in profits, almost certainly more by now. And then Chloe, who was literally about to give up, got very frustrated, found our method, 15x'd in 30 months. Roger also was about to give up until he found us as well. So we transform people's lives, people's results, and you can do that too. Very quickly, my history, so you get to see why this happened, is I did a finance MBA back in 1996, 97, and my 2 professors from completely different lectures, but both based on stock market and options market. They said, look, if you want to make big money, follow the big money. And we had to figure out what that was. Now, that MBA, the information I'm about to tell you, cost about $15,000 at the time. It does cost $57,000 today. And here's what they said. 1, you need to look at the stock investors, which basically include insurance companies and pension funds. Okay, but these guys are even more important, and that is the options traders, the people who risk more because they think they're going to make more. Then why are they doing that? They're doing that because they have information, or they believe they have scarce information. Now think about it, and we'll circle that loop. Now, it struck me that if I could follow options traders, this would be an entirely logical and sensible thing to do. But in my quest at the time, I realized it was going to take years of research. It would take enormous amounts of market data. It would require highly skilled professional quantitative analysts, specialist programmers, industrial size servers, specialist expertise, and it would end up costing millions of dollars. So that was me hitting my head against the wall at the time. But I did discover 3 other, I call big money footprints, for serious success. We're going to go through those in just one moment. So here's what happens. There are elite investors trading in the markets literally every single day, and they're trading billions of dollars every single day. Now, some of their activity leaves a trail, which is hidden to nearly everybody. It's invisible to the untrained eye and without lots of data. But if you can latch onto that trail, you have an opportunity to be consistent, to remove guesswork, to save an enormous lot of time, and to eliminate overwhelm, and to be totally specialized and focused at the same time. So here they are, the big money footprints, or 3 of the big money footprints. The first, remember also that big aggressive money is what moves prices. The first big money footprint starts with a B, and it is big money, okay? Translated into volume. I'll show you that in a minute. The second one is the A word. Remember we said that earlier with the property? It's aggression. We need to have aggression. That's going to move prices. And then the third is one we haven't touched upon yet. It's called key levels. And what we mean by that is levels that have got a lot of eyeballs on them. And a lot of eyeballs trained on one thing can lead to a very decent move very quickly. If we're looking at big money, we are talking about volume acceleration. So in a crude way, you could look at very large green bars going in with bullish situations, towering over previous red bars, or very large red bars in bearish situations, towering over previous green bars. Okay, very crude, but very effective. Volume acceleration, showing you pent-up demand and supply, which will then affect what happens to the stock price later on. Now, this is GE a little while back, and this is such a great one because GE is dull. I mean, who wants to buy GE? It's a boring old GE. But look at this big volume. Now, if you can raise your hand, be very useful. Raise your hand, see that big volume spike. Now, a lot of people think the volume spikes are reversals, but they're actually not in the right context. So you have this big volume spike here, and what happens is it's the first piece of a big move. It's 83% in just 5 months for that. Now, it's not the only thing that was going on there, but it was part of an overall pattern. Sorry about the cough. I'm just actually going to go on silence just a minute. Got rid of the COVID, just can't get rid of the cough. Anyway, give me a wave if you're here still. Thank you for your patience there. Okay, so big money footprint number 2 is that aggression. And what I've got here is this big set of eyeballs, because when you have a move that has gone up, a big move, especially after earnings is a particularly sensitive time, what happens is eyeballs are trained on that. It's getting alerts on all kind of trading desks, from professionals to amateurs, and people are watching. And if you get a jump up and then a sideways move, that can then be, it's obviously a consolidation or a flag in many cases. That can be the basis of another move. Again, all in context. So you see here this with ATER. This stock pretty much doubles. And you think, oh, that's got to be the end of it. But it wasn't. It was only just the beginning. Doubles, goes sideways, and then more than doubles again. So this often happens, and the whole setup is there and higher probability. This was 124% in just 4 days. And these are all stocks that we had on the day, actually were looking at and trading at the time. The third big money footprint is this concept of key levels. And there is my set of eyeballs again, because lots of eyeballs are trained on this. You see, when a stock goes through a key level like a 200-day moving average, made famous by Paul Tudor Jones, for example, then alerts go sounding on all kind of trading desks all around the world. And when that happens, people are watching. They're watching for the next move. And if it does make a next move up in a decent market conditions, then you are likely to get a bigger move as well. And that can be the 20, that can be the 50, can be the 200. I typically prefer the 50 and the 200 as more important levels. Now, this is a firm, and this firm had a few little flirts with its own 50-day key level, but because of a couple of other factors, it then just went bananas, particularly at earnings. That's that bell here, the earnings, and it just went nuts when it finally got over and stayed over that 50-day key level. Again, 71% in just 12 days. But if we go and now put all these three big money footprints together in one hit, here's what we get. We're back to GE. Remember boring old GE? Well, here's big money footprint number one, the big money, big volume spike. Then you get the aggression. It's had a pretty big move in recent times. Then you've got the key level being crossed and held, and that's really what's behind. There's something else, but that's a lot of what's behind the 83% move in 5 months. And that's what happened with ATAR. Three big money footprints present there. And the same what happened with AFRM, Affirm, as well. So you see the same kind of setup all the time. You're actually seeing that whole setup now with KWeb, which I showed you earlier, obviously because you were in discussing that just a few minutes ago. Now, can it work the other way around with bearish? Yes, it can. Here's TAL last year. It goes through the 20. There's a few other bits and pieces going on here, but the big money, the aggression, the key level, all done, and then it leads to a 64% drop in just 32 days. With Bill, does it work with high ticket stocks? This is a high ticket stock in the hundreds of dollars. Yes, it does. And you'll see this same setup over and over and over again. It'll get like, wow, you'll literally be dreaming about it. But again, you've got a decent move up. You've got the big volume recently in the last 30 days or so. You've got a decent move up in the last few days as well, 30 days or so. And then you've got the cross and hold of that key level, almost like a consolidation. This led to an 87% move in just 3 months. Can it work also with low ticket? Yes, it does. This was bit mining, obviously out of favor now, but at the time you see the big money footprints there. There's big money footprint number one, the big volume. There's the big move from 4 to 8. That's a huge move. And there's the cross and hold of the 50-day key level, then moving up another 53% in the next 3 days. They're good rooks. This happened to be a short squeeze as well, which is a nice one. Funny, but look, you got the big move, you got the big volume, got the cross and hold, and then you've got a 25% move in 13 days. Big moves these are. And a lot of people love this strategy. I got this sort of WhatsApp message saying, I love when you combine this with a short squeeze scenario because you get a very violent move. Beyond Meat was another short squeeze. Look at it. It's the same setup every time. Big volume preceding it, big move preceding it, cross and hold of the key level, and then boom, up she goes, 57% in 2 days. Now, I've got to tell you here, these are stocks I'm not raising just because they were good and they moved. They are being brought out because we were talking about them at the time before they did. We were alerting people to this. So if you think about what we've just already covered in a very short space of time, you can already go and filter for volume acceleration. You can already go and filter for price surge. You can already filter for the key levels. You can do that with Metastock, even. You're all Metastock members. Now, there's a couple more things that are really important. One is that concept of scarce information, and the second is the trade plan. Now, scarce information, again, is a transformational thing. This, again, is another setup. It looks pretty much exactly the same, and it led to a 25% gain in just 7 days. And again, there's another WhatsApp message from my group saying, oh, thanks for DIG. Looking forward to this and that. So scarce information I'm going to cover in just a few minutes, and then a robust trading plan. We won't have time for that, but I do cover it in one of my specialist programs. Now, the trade plan is very important because with a trade plan, you need to establish control from the very beginning. So you enter with control, and then you are in control for the rest of the trade, whether it ends up being a profit or a loss. And I have a proven 4-step formula for that. It's very, very simple, and boy, it's worth its weight in gold in any case. Now, when we look at this, what we've already covered with those 3 big money footprints, you can pretty much already do this. You can filter for, say, let's just say the top 1,000 stocks. You can filter for that pretty easily. You can filter for recent volume acceleration. You can filter for a recent price surge, bullish or bearish. And you can filter for recent hits of those key levels, 20-day, 50-day, 200-day moving average. You can then look through the charts manually. You can verify those. You can select a stock for a trade. You can apply a trading plan to it as well. Now, the only disadvantage with that process is it's kind of long-winded. It'll take a lot of time, hence the little icon there. Ideally, we want to automate as much as possible so you can get to a fast track. You can really get this thing moving quickly. Now, we do this in my Flag Trader program. This is where literally in one button, we can filter not only the entire stock market, but literally into a little handful of stocks that have these high probability setups with the big money footprints present. I provide the tools, I provide the training, critical, and the support to start generating that consistent and profitable income for you. And what will happen is that within a few days, depending on how quickly you do the course, it's only a few hours or weeks, whatever that might take, it's literally you'll discover a specialization, a simplicity, which will lead to confidence and consistency, and then you'll be doing it all the time, and still have the time to do other things other than trading as well. Now, it's an innovation. We're in an innovation business, a fintech innovation kind of business. How to trade better, how to create more automation. But this is what it's like for you. Basically, we will log into a members area on a mobile device, a tablet, that sort of thing, or a PC or a laptop, doesn't matter, Mac, it doesn't matter. And then you can click on a button, a fast filter button, that little orange button with a magnifying glass on it. And that button can literally, with a couple of clicks, bring you a bunch of stocks that are conforming to big money footprints, where you can pick the best setups and trade safely. This is just one endorsement we got from a guy called David. He's a long-standing member. I'm blown away by all the constant and continuous updates, developments, ongoing ways making the system more intuitive and easier to use. I love you guys, but of course you know that. This is what it's all about. You have to keep on improving, but you don't do it by revolution. You do it by evolution. You make little progress over over lots of little progressions over a period of time leads to very serious innovations and very serious improvements for you. This was CRISPR. This is just, you should recognize this already now. This was all the big money footprints there. You've got some big volume there, you've got a big move there, you've got a cross and hold of a key level being the 200-day key level, and then you've got the big move afterwards, the 30% profit in just 7 days. So this is how you found it just by one button. Now, this is a guy who came to one of my events. He says, thanks to the gift pack, because we gave a gift pack, because the greatest gift is your software. It saves so much time, and combined with your trading plan, which I talked about, the 4-step plan, I finally started making consistent profits, which is really the aim of the game, repeatable, consistent profits. And when you look at Pat, who took an account from 3,800 to 33,000 in just 9 months, if you look at each one of these charts, we don't have time to look at them in depth, they all look the same. And that's because they all were the same. They all exhibited the big money footprints. And she started with a small account, which means if you have a small account, you're okay. If you have a large account, you're doing the same thing anyway. Now, we talked about scarce information. It is critical because it literally is transformation. Information is great, but scarce information takes everything to an entirely different level. Why do I get paid the big sums? Because of scarce information. Why do we consistently outperform in our automated systems? Because of scarce information. It happens over and over again. Now, when I did my MBA, I talked about there, it would cost $57,000 for 1 year now. What were they talking about when they talked about those options traders? They were talking, in fact, about scarce information. Those options traders risk more because they think they're going to make more because of the scarce information they have. And that's why they gravitate to the world of options for that simple, easy, nice leverage. And scarce information, remember, is about, it's a bit like the diamond dealer who has scarce information, Coca-Cola who has scarce information, KFC who make repeatable profits out of scarce information. And when I said that I was hitting my head against the wall, because it would require years of research and billions of rows of market data and all those quantity analysts and programmers and servers and expertise, all that stuff, it did. That was the issue. It has required all of that. But when we look back to Roger and you ask, how did he transform his retirement after 6 years of frustration? Because he uses scarce information, and that transformed his retirement life in his own words. And this is what scarce information is. The OVI indicator, which is the options volatility indicator, is a patented indicator, patented by me, you can look it up, is scarce information. By definition, being a patent, it's scarce information, and obviously no one else has got it, that too. And here's how it works. It's ever so simple. When it's in the positive area, it can go to a maximum of +1. and you're looking at bullish areas. When it's in the negative area, it can go to a minimum of -1, and it signifies potential bearishness. Now, when you see it on a chart, it's dead simple. Here's Overstock, which I told you earlier, can jump up and down like anything. Goes down from 22 all the way to 10 and then back up to 26 again. So it's making some big moves in a very short space of time. On its way down, we would potentially expect the OVI to be more red than blue. And of course, it is. And when it's going up, we would potentially expect the OVI to be more blue than red. And of course it is. And when it's doing that, when the stock is trending and forming big money footprint type setups and the OVI is conforming, you have a very high probability chance. And the OVI is seen, has been estimated to improve performance by 71% and sometimes a lot more as well. If you look at Chloe, her win rate was 40%, went up to 76%. Remember, she's 15x her account. With Kyle, with him, another retiree, with him, he went from a 3 out of 10 win rate to an over 8 out of 10 win rate. And now his trading with us has exceeded his social security, which is a very big deal for him, of course. So it's a transformational thing here. Let's go back to GE. Remember boring old GE? Well, here we go. Look at it. It was staring us in the face the whole time. We've got big money footprint number 1, big volume. We've got big number 2, big move up. We've got number 3, cross and hold of a key level, being the 50-day key level here. But all the time that we were talking there, the OVI has changed from red to blue and stayed there. Give me a wave if that makes sense. And that is the juice behind the move that made 83%, or that went 83% in 5 months. With GE, remember, GE, this is not a tech stock, right? So with ATER, you see that 4th big money footprint there, that big move up. You see it again with Affirm, the 4th big money footprint there, and you see it again in the opposite direction with Roku. So let's look at that. Big volume there, big move down there, crossing and holding the 200-day key level on the way down, goes sideways for a bit, and then down by another 50%, because guess what? This OVI is deep red at the time, so preceding the move with those other big money footprints. So scarce information again. Scarce information even with the likes of Amazon on the way up, leading to 75% in 5 months. Scarce information again with CRISPR and the other big money footprints here as well on the way up, 30% in 7 days. This is Kirkland's. This is cracking. This was at 150 when we found it, and it went up double in the next few days. You can see the big money was there. You can see the other big money footprints were there. Now, what happened then was it did a bit more. This is someone writing into me on Twitter, Paul, saying, he's made his first profit. Now he's going to set his second profit target. He would have been a bit surprised to see it would have gone up to $13, $14 in just 2 months. Probably even more surprised to see it went up to almost $30 in the next 8 months. So that's a 1,200% improvement in price. And in fact, if you look at Kirkland's now, it's come all the way back down again with negative OVI. Legg Mason, this is fun. So Legg Mason, this is a cool one. Again, you see all 4 big money footprints present over the last month or so. And what happens is it moves up. It moves up 34% in 3 weeks, thanks to a takeover, a buyout. And this will often happen as well. You happen around earnings. You'll see these things end up being buyouts as well. Very cool. Indeed. This is GoodRx, a short squeeze again, but remember we talked about it. Here was earnings, the big move happening in earnings. Pop, there it is. And look, the OVI, the scarce information that no one else gets to see was there doing its job, and that led to the 25% move. The same with Beyond Meat, that 57% move. With that one, OVI was there as well with those other big money footprints. So hopefully you can see now that we're really tapping into something that is as simple as demand and supply, except for one little detail. And that is the demand and supply that we see is scarce information. No one else can see that because it's shrouded in massive amounts of information that needs deciphering and decoding, as it were. Look at a case study now. We'll look at Chloe, who did 15x, and how you can follow her kind of trades. So, if you look at each chart here, all I want you to do is just see, can I see the big money footprints? Can I see the OVI, the fourth big money footprint, the scarce information. And of course, with Adobe, which leapt by 33, 34%, yes, you can. With Advanced Micro, of course, you can see it again, 41.85%. Look at that fourth big money footprint down there. With Marriott, you can see it again. You go, Guy, this all looks the same. And it is. It's at different times, with different stocks, but all exhibiting that same setup. Now, it's exciting when you know that you can just be patient and look at one setup. Now, there are some variants, of course, I'm going to teach you about. This is IWM, up almost 24%. That's the Russell, that's an index. This was Alibaba. Again, it looks identical. And there it is. Now, this was in bullish market, but you can see how it works in both markets. And you can be very patient because the returns can be very big. And if you end up using options as well, which we teach you to do, then you can really accelerate those returns and be really, really patient about only the best setups. So quick demo, how would you go about doing this? Well, we talked about the manual way earlier, but we also said that it would be better if we could automate and fast track this whole process. Well, we have a button that does it pretty much for you. You find the big money footprints, stocks and options, literally in just a couple of clicks. Then you use my trade plan within my program to manage for ultimate safety and low risk, but also for opportunity on the upside as well. It's exactly what I teach in my Flag Trader program. And then you've got something repeatable. Remember, you have a scarce information and leads to repeatable profits if you have a system in place, which is obviously what we do. So you can use it on a mobile device, and you can do all that. And you just literally can log in, and you can click on the fast filter, and it doesn't matter what account size you have, you can do this. And literally, you can find those filters in literally a single click. Now, this was Vertex Energy. If you look at the chart, it looks somewhat recognizable, doesn't it? You've seen it over and over and over again. There's some other thing going on here, which I'll teach you about as well. But there it is. You can see the setup, and you can confirm the chart visually. This came up in one click, and it's a move of 73% in literally less than a month. On that one, you trade it with my trading plan, you protect your profits very quickly with that. Now, this is what other people say. This is Henry. He's a really cool guy. He says, look, he set himself some very optimistic income goals, and he's easily meeting those. This is an older one here. In fact, actually, he's got, sorry, not an older one, but this was the $38,000 in profits from 3 trades: Palo Alto Networks, CrowdStrike, and Pfizer. So, you know, big names. These aren't little penny stocks. You're talking about big stock names here. We work with quantitative analysts. We work with professional money managers. Here's what they say. They say, using institutional standards of financial modeling, OVI stands up to rigorous scrutiny as a valuable, logical, robust indicator, highly valuable in predicting broad market sentiment from an index point of view, but also in identifying individual stocks that subsequently performs. That's pretty good endorsement from market professionals. Newbies love it too. Then let's have a look what Bernard says here. First and foremost, using the OVI has increased my confidence. That's pretty nice. It feels like unfair or cheating. The downside risk feels very low. I've learned to take my profits. That's my trading plan. And, you know, he's made from 70% to 550%. Pretty good in gains there. Here's what professionals say. This is recent. Says, hi, Guy, I'd just like to share something with you. This is an email chain. Just by adapting to your methods and putting some basic controls in place, that's our trading plan, saved me millions in losses. That is an email I got just recently in May. Really excited about the total system we developed. Cannot wait to master the process. Saved me millions. So we've got the big guys there as well as the small people as well. This is what one of your fellow members said. The OVI is by far the best program I've ever done so far. I love the personal relationships with everyone. That's pretty good. And the beautiful thing is you can have it on a laptop, you can have it on a tablet. You can be anywhere doing whatever you want. You don't need to be too intense about this. That's not to say you do nothing, but it just means that you don't need to be watching charts all day. And if you look at these charts, whether it's Boeing, Halliburton, Chubb, Boston Properties, don't they all look familiar? They've all got those big money footprints present, particularly the scarce information one, which is again unique to us in this program. So here's what the entire program looks like, a special for Metastock people. You get the automated software to find those big money stocks. Has a value of 1997. You also get done for you watch lists. Watch lists are already pre-prepared for you. Watch lists and also fast filters for you. Again, 1997 value. So just click on a button and see those stocks in your charts or your Metastock charts if you like. We also have training videos, but they're bite-sized. They're, we split them into the optimal way of reviewing the method, so you don't have to watch entire sections. You can just go to the bit that you want. We include the 4-step trading plan as well. This trading plan is phenomenal. Even on its own, it's worth everything. 997 value, but worth a lot more. Support, we're bigger. Like Metastock, we are really hot in support. We care, it shows. These are people who are writing in saying, thanks to your team for your hard work, thanks to your diligence and persistence, and also someone says exemplary follow-up when we followed up with him very, very quickly. We really care, it shows, and it shows in everything that we do. Now, I have a limited number of seats available, 25 seats, and all that, what you see there on the screen now, has a total value of just over $8,000. The normal price, if you go on our website, you will find it at $2,997, but we're going to do better than that. Because you're Metastock members, we're going to offer this at just $997 as a Metastock member special. The link to go to is ovi.to/growth. Just type that in. Don't type anything else in. ovi.to/growth. There are bonuses, though. And here's one very big bonus. The scarce information filters, the OVI filters, are embedded within your membership. So you get all the filters you could possibly want with those, not just a few, all of them. And that has a value of 1997. There is a second bonus, and that is why we're limited to 25 seats, because you will also get a one-to-one coaching session with my lead coaches, and that has a value of almost $1,500. And that'll get your routine and your particular routine. You are an individual. No one's walked in your shoes. We're going to just make the adaptations to make it fit for your lifestyle, your time frames, and your particular requirements. So again, that gives you a total value now of $11,643, but it's still just $997. You can go on the website and get it at $2,997 if you want. I wouldn't do that if I were you. Go and copy this link, ovi.to/growth for the Metastock special. There are a couple of extra bonuses though. The third bonus even is the Ultimate Earnings Blueprint. In the charts, I made reference to the fact that earnings is sometimes the catalyst for a big move, that little red bell on the charts. Now, this is the starting gun of sometimes some beautiful low-risk moves, and we can find them in a click. And also, there's a particular plan that you use for that, and we call that the Ultimate Earnings Blueprint. Has a value of $497. And the fourth bonus here is, well, look, don't you want to follow someone who's gone there and done it, and actually not just gone there and done it, but blitzed it and now become a mentor for us as well? So it's Chloe's 15x watch list. What you'll realize about her, she's very focused on a few, on a few stocks and only 1 or 2 setups. That's it, and that has a value of $597 of value. But that now gives a total value of $12,737. It's still available at $2,997 if you want it, but I wouldn't do that. It's still here at $997 just for you, just for Metastock member special. And again, you've got to go to ovi.to/growth. I'll put that in the chat if I can find how to put it in the chat, that is.
I gotcha.
Oh, well, look at it. Oh, he's just so efficient, that Jeff guy. He's so efficient. I can't believe it. Anyway, when you do it, you'll also get this little mini course and manual called Growth Secrets for Small Accounts, for small trading accounts. And even if you have a large account, go for this. It's a beautiful thing. And it's co-written with, guess who? Chloe, 15x, so probably worthwhile. So do it. It's a written guide, manual, and video tutorials, and it gives you what her experience of this has been as well. There is a guarantee, and unlike many people, I don't mess about. It's a 30-day guarantee. If you don't like it, money back, no quibble, all fine. We have so much belief in this. The belief is, and Jeff will tell you, that most people who enroll will stay, and we have a relationship with Metastock as well. And it's like them. You have a relationship with them over the long term, and the same with us. And we love working with Metastock and with Metastock folks as well. So That's it. No kind of what they call the impossible guarantee, where we just keep on giving you stuff. If you don't like it, you don't have to keep it either. It is available at $2,997. If you want to go onto my website to get it at Wise Traders, I wouldn't do that. Get it here. That there is a strict 25-seat limit because of that personal one-to-one piece, and you can get it at just $997. A couple of other people, Mike from Minneapolis. Again, look at this chart. Doesn't it look familiar? These setups that we find in one click. That got him 150%. Very happy with that. We got big players making 53,000 on LinkedIn, 600%. Then we got the other people who are consistently making 7 out of 10 winning trades. Here's another big one with Apple. There's Vinny. We know him very well. 34,000 on Apple. Then we got the 8 out of 10s with Doug, 5xing on BA, making 10,000. There's Kyle again, getting to 8 out of 10. Kedsy's a fun one. Kedsy is a hoot, really. He's a real character. What I thought was kind of fun was that he's made over 200,000 in profits with us. And he goes, "Oh, I've made 21,000 since January the 1st." This was writing, on the 7th of January, and probably look how casual that is. Another $4,000 to $5,000 in the next hour or so. How nice it is to be that casual. But she's fun, and we know we have a community, much like Metastock. We have a community of members, and we're here to help you become one of these established people, focusing on 1 or 2 strategies and really making your mark in that way. Again, the link's ovi.to/growth. Before we go to Q&As, I'd like to not give you a motivational quote. As Jeff knows very well, I don't do all those kind of things, but I'm going to give you something I think more valuable than a motivational quote, and it's not a ticker symbol. TWYS is not a ticker symbol, but let's go through what it actually means. And it is, and lots of other people I've been doing this for years, and now everyone else is doing it. But I'm going to show you the difference. Trade is the T, W is for what, Y is for you, and S is for C. Now, of course, everyone's saying that nowadays. Oh, trade what you see, trade what you see. What are they talking about? Well, here's what we talk about. Do you see big money? Well, we have a way of seeing that. We can see it instantly. Do you have a way of seeing aggressive money? Do you have a way of seeing key levels being crossed and held in a particular way? And can you see the scarce information? Well, most people can't see that. In fact, 99.999% of people can't see that. This is what we are looking to see. This is what we trade. And so when we say trade what you see, we mean these big money footprints, and we wrap it up in a beautiful trade plan. So that's it for now in terms of the what we're gonna talk about. I know we've got a few minutes for Q&A, and Jeff's gonna hit me with it.
All right. So Reginald wants to know, that's a 1-year subscription. Does it renew at the same price?
Yeah. Oh, yes. And that's the other thing. One of the other things we do is we don't raise. So, and if you're in and you renew at the discounted rate. So it's called grandfathering. I heard that's a bad word now. I can't think how or why, but maybe that's because I'm an old fuddy-duddy. But anyway, we grandfather you. So yes, you can renew at that price, and obviously you can understand that people like to do that.
Okay. Another question that we have, and we don't have a lot of questions. If you have some
that's
questions,
Reginald, that was for you. I saw that.
Okay. Question about whether it will work with futures markets.
It's very interesting. I mean, obviously, the stock futures or an ETF which has got futures, which is aligned to a futures, it would work. So if you're trading a futures, and you can take your signals from ETFs, which we do cover, and if you talk about stock futures as well, then that would apply as well. So you'd look at the spot chart of the stock, and then you could apply it to the futures as well, because there's going to be very serious correlation there. But yes, I mean, to an extent, the answer is to an extent, yes.
Okay. And then the website to sign up for that is ovi.to/growth.
I saw that John had a question. What is the difference between 2 and 3? John. Well, I'll tell you what. So big money footprint 2 and 3. The big money one is about volume, and that's number 1. Big money footprint number 2 is about the aggressive money going into it. So it means there's been a spike in the price recently. And then number 3 is the cross and hold of a key level. So you've got the eyeballs going on there. And by the way, if this happens at earnings, it's even more powerful. You get the big pop at earnings. Some people think, oh, that's the end, but it's more often than not, just the beginning. And then you don't have earnings in the way as the gamble. So 2 and 3, obviously, John, I hope that's something for you there, an answer, but they're very different. One's an aggressive move in price, and the other is a cross and hold of a key level. Sometimes you get a very aggressive move in price. So let's look at recently, had very aggressive moves, 4-6 weeks ago in oil stocks, but they were way past their key levels. They became overbought, and now they've gone smacking down the other way. So that's the difference. Hopefully, John, that's made that clear for you. We don't look to chase overbought issues.
Okay. I don't see any other questions. Do you see any other questions?
I'm looking, but no, I don't see it on there. I know you got a bunch of people on other platforms. Again, there's the bonus. Here's the whole thing here as well. And we do actually, I know someone's asked about options in there, and I can also put in here because I love options. So number 5, we put in options 101. I can stick that in there as well. It has a value. But again, if you want to learn how to apply this with options, very simple. We call it smart leverage. Very, very simple. But if you want to do that, I will put that in and I'll arrange for you guys to have a tutorial. It's an options 101 tutorial in there as well.
All right. Very cool. Thank you.
Thanks,
and
Jeff.
I
Good to
want
see you.
to
When are you
add,
coming over?
well, probably next year. It's time to start traveling again. Now that
Absolutely.
now that you're recovering, you can't give me the corona. So
No, I don't want that again. No, it is very. It's okay. Luckily, I got the mild version, right?
I've heard that it's I've heard it's not fun. So in any case, fingers crossed I won't get it. Thank you guys. Appreciate it. So it's ovi.to/growth. Thank you again, Guy.
Thanks, guys.
All right, very cool. Okay, and let me go ahead and do this. One of the things I'll add real quick too, as I'm kind of just getting back over the presentation, sharing my screen with you, is it is actually not the full offer, but 3 months of that is included with the OVI system. And one of the things I really like is as part of Metastock, you can actually pull the OVI values in. There's an expert advisor that's accommodating with that. And it's one of the only platforms, aside from the OVI website, where you can actually get the OVI indicator values. I love it. In fact, if you have the OVI Traders Club, you don't even have to pay extra for the add-on. It's just included as part of the thing. So Winston asks, is options easy included? Yes, he's going to throw that in as well. And you can get that at ovi.to/growth right there in the link for you. So in any case, it is also, we are going to include 3 months of the OVI Traders Club as part of our Summit Action Back today. That's going to include the Go No Go add-on with Alex and Tyler, the Steve Bigelow's Candle Profit Systems 2.0, Go 3 months, like I said, of Guy Cohen's OVI Traders Club. You're going to get the 3S code, which is our brand new add-on that just came out last week. 3 months of a learnmetastock.com website. Unleash the power of Metastock with a workbook, online workbook, and an online videos that you can go through. Normally, the price for all of that would be $3,630. Here at the event today, it's only $1,641. It's more than half off. So most of that does include a 30-day money-back guarantee. Give us a call, 800-882-3040. Chat online with us at metastock.com/saleschat, or you can also do it at metastock.com/summitdeal. So great job. I think today's going well. I hope you guys are enjoying everything. Let's go ahead and kind of just go to our, let's talk about Stocks and Commodities, one of our sponsors today, Stocks and Commodities Magazine. I want to say personally, we really appreciate all the sponsorship work you've done with us over the last decade. Stocks and Commodities Magazine, they've been making magazines since 1982. They have 1.2 million subscribers, 17,000 trade articles that are available. If you're watching this on YouTube, or if you registered for the event today, you can go to metastock.com/Trader Summit to register for today's event, and you can just get a free magazine. If you buy the Trader Section Pack or subscribe to Metastock, we're also going to give you a 2-year subscription. As long as you spend $300 or more today at metastock.com, we'll give you a complimentary 2-year subscription to Stocks and Commodities magazine. So anyway, it's been super great to work with those guys. We really appreciate all the work they've done in helping us support the event and market it and promote it. Great group of people, great magazine. One of the things I always say is like, and you know this, you're here watching an event today, but I always think you're either getting better at something or worse at something. And I think what a great way. I've been getting the Stocks and Commodities magazine every year, I think since 1994. And they're always full of good articles, good things that you can read, some things that you can learn, and what a great way to kind of improve your education. So you can get a free issue again at metastock.com/tradersummit. And I recommend that you do that. Our next presenter today is Jeff Killian. Jeff is somebody that we haven't had in the room in a little bit, but I want to welcome him here. He does have one of our most popular videos that we put on YouTube. Like it's like our second or third most popular video. And he does a really, really good job. The thing that I'm really looking forward to with Jeff today is the fact that he looks at a lot of price action. I had a chance to look at a video that he was doing just like I think it was Thursday or Friday of last week as we were getting ready to go. And I'm really excited to see him. So I want you guys to give a warm welcome to Jeff, welcome him back into the channel, and let's go ahead and get him going. Jeff, how are you today?
I'm pretty good, Jeffrey. How you doing today?
Awesome. We're doing well. The audience is great. I just turned over the screen share to you. So.
Okay, let me know if you've got my camera okay. You can see me fine?
See you. Yep, and we can see your charts as well.
Great, thank you.
I'd like to get out of your way. So that's what I'm going to do right now. It's yours. Let us know if you need anything. I'll be right here if you need me.
Great, excellent, thank you. My name is Jeff Killian. In markets for over 20 years, started studying about 30 years ago. We originally, when we were partners way back, probably 10 years ago with Metastock, we were the InsideTechnician.com. Now we are VectorTradersConsortium.com for a good reason. We had to step back for a few minutes and really think about what we were doing and the services that we were providing. So we decided, after a long period of time and a hiatus of about 5 months, to really get into what smart money is doing and be able to provide that information in the form of real trading intelligence to the informed public, for information hungry people who really want to learn how to trade for a living. Trading for a living is not easy. Everybody knows that who's tried, and there are many who have succeeded and there are many who have not succeeded. Now, in this case, I want to focus in on how to find, track, and trade these people. And this is going to give a decided advantage for those serious students of the market about how to actually pull this off. If you're with me and you're looking at the price action of ESNCM, that's near contract month 922, you can see over the past 9 months or so, the volatility has been fairly high. And this is good for traders who know what they're doing, because there's a lot of money to extract out of the market, book a lot of profits, keep risk low, and learn how to choose only the true high probability trades. And so when we look at price action, we need to figure out what's going on behind these prices. How can we get inside the market and identify with the true mechanics that actually move prices from one level to another? This is what the smart money is all about. The smart money is the largest institutions, the richest families in the world who do for sure manipulate the market. They do move prices from one level to another on a pre-planned, undisclosed manner that is actually initiated by back-coded orders that have special preference to get filled first, and everyone else gets filled second. So what we need to do is we first need to identify with major market turning points. Now, to inject a lot of validity here and really look to cut through the chase about what we're trying to accomplish here today, what we will accomplish today, is that when I started this 30 years ago, There wasn't shared webinar rooms like today. There wasn't a lot of people out there who were willing to disseminate this type of information. And so this was really, really hard for me. It took me years. And then for the last 9 months, I was up all night, every night, exhausting one indicator after the other until I came up with the indicators that actually showed me where the smart money is, where it's headed, and then the prices, how they follow after the fact. So let's get into major market turning points first. And they are identified by pivot point lows, pivot point highs, and then base formation lows or base formation highs. Everybody knows what pivot point lows are. Everybody knows what pivot point highs are, but there are occasions when they don't stand out. So what do? How to identify with the possibility of a major market turning point? There may only be 2 bars that are present. So we look at the first 2 bars that are in a high area, and we determine out of those 2 bars, can that be as high as the market's going to go or as low as the market's going to go? A 2-day pattern of open to close, close to open, close to close, or close to open, right? 4 different setups. Sometimes this is as little as you're going to get, but it's enough to be able to determine a starting point of where things can turn back around. So that's open to open, open to close to close, or close to open. It can only be 4 combinations. And this is what we're looking at right here. So we're not going to get every major market turning point in here on this particular demonstration, but I think that everyone will understand visually where I'm going with this, right? And we'll do our best to make sure we get it right. Now they're starting to stand out, aren't they? Okay. Every trader who's been trading even a short period of time knows that the largest amount of money to be made is when the market turns around and moves in the other direction, because there's a series of 3, 5, 7, 9 days, depending how strongly the market sells off or trades up, where we can make an incredible amount of money on a real-time basis within those days. Now, once we have this established and we know how to do this, because we have to make sure we get this right, then we can move into learning about the relative comparison of the volume to the prices. Because if you're not a high volume trader, you're just working off of the action, you don't have any idea what's going on behind the prices. So let's take a look at that and see what we can come up with. You might have to move around just a little bit on these prices here. Bear with me 1 second here. Okay. Getting there. Okay. The volume as compared to the prices is critical to be able to identify at the major market turning points that I just laid out. So please listen carefully. You can clearly see the relative comparison. It's always a relative comparison of one thing to another. The prices, how they're moving up with price chart pattern uniformity as compared to this here, okay? The volume as the prices are moving up is moving up on inflated highs because the volume's drying up. You get some volume here, a little tap out here, and then the larger contract sizing comes in here, right? Which was basically anything but what we saw here. There wasn't that kind of volume to all the way back at this point. And this is what acts as a catalyst for the prices to trade back down to here. Now, this doesn't maybe look like a lot of money here because it's a daily chart, but I can guarantee you between here and here, there was well over $20,000 that could have been made trading in real time. The prices, they get stabilized here by this volume, and then you start to trade up again on inflated highs because there's a dry up of volume here. Eventually, a sell comes in here, which creates this low. Then the larger contract sizing comes in again to create a major move to the downside that was worth well over what I just quoted. Now, after that, here we have it again. The market starts to trade up on stronger accumulated volume here, and then trades up again on inflated highs. Larger contract sizing comes in to drive the price down, and this time much further. Then again, prices trade up on some volume here, turn back around and trade back down to where they are trading basically right now at around 39.11, 39.15. Okay. Now, the relative comparison of the volume to the prices, again, is critical because the volume is the engine behind what moves the prices. If you don't have a lot of volume behind, I mean, you could as well be looking at a 1 minute chart or 5 minute chart or 15-minute chart, right? You're looking at the actions compared to the volume, the lack of it, the excess of it, right? If you don't have a lot of volume behind your trades when you're getting into real time, and we're going to talk about that because it was a great trade that was taken this morning I want to identify it with, then the likelihood of the prices moving in the anticipated direction that the smart money is pushing the prices gets increasingly decreased. So what are the real chances that the move is going to follow through? We'll get to that. Food for thought. Now let's look at this and try to determine where the market was going to stop. Points of control. Largest amount of contracts traded at a certain place and time, the intersection of price and time. That clearly, logically, was one of the best areas for prices to tap out. See the larger contract size in here? Okay, then you have some breaks volume that comes in here. What's this level? This level is drawn from March 3rd all the way back 2021. If you had had this laid out like this here, forget the arrow on the right-hand side for a minute, right? And you knew that that level was associated with major volume at a pivot point low, right? Then you would have expected the market could halt at that area. And what would you use that for? You use it as a price profit target on an end-of-day basis, no matter what you're trading, because that's where the market at a high probability of halting. Does everybody understand how simple that is once you know what to look for? Can I get a raise of hands? Yeah, good. So now, points of control that exists on daily charts also exist on 15-minute charts, 5-minute charts, and 1-minute chart, which I use for execution. So first, we're looking at the relative comparison of the volume to the prices. Next, we're taking a look at the divergences, which is the second thing that most traders still struggle with today. I can't tell you how many traders that I've met who say that they know about divergence analysis, positive or negative divergence compared to the prices. And at the end of it all, we basically have to start over, which is interesting, but fine. So let's talk about that for a moment. And let's get into some of the most important information that we need to cover here. We're talking about getting behind the prices, like the company was called the Inside Technician before, right? Yeah, okay. Okay, so basically a negative divergence is where we have a higher indicator peak as compared to a lower indicator peak, right? As compared to a lower price and a higher price. It's basically that simple. The strength of the negative divergence in this case is directly related to the slope of the line, the disparity between the upsloping trend line and the downsloping, in this case, chicken money flow, right out of the box. Metastock's program has it, 21 period, right? And then the after effect of this here, when you saw on the previous chart, the additional volume come in here to drive the prices down, was that all the while the prices were trading up here, up and up and up and up and up and up and up, right? And then we got to our connect point number 1, point of origin, connect point number 1, right? The negative divergence becomes complete right here. This indicates clearly that there's a lot of pent-up selling pressure. Listen to me carefully, traders. This clearly, case evidence presented, shows that there is major pent-up selling pressure that has not yet taken place in the form of future directional price movement. And now we're talking about identifying high probability market turning points, not just market turning points, because now we get a chance to see what's going on behind the Iron Curtain. And this is what empowers traders to act on the intelligence that they're getting, because now you know it and you're seeing it. So regardless of what a possible system may say, now you have information about what the short-term or long-term smart money is really doing. And this is critical to nail that major market turning point so you can capitalize on this kind of move here. More than, trading S in real time, 2-3 trades a day, standard contract sizing, you're talking about the possibilities of, close to $50,000. So your greatest positional advantage, listen to me very carefully, please. Your greatest positional advantage as a true professional is patience and waiting for the major market turning point, high probability market turning point to come to you. Your greatest positional advantage as a true professional is then waiting for the real-time trades to come to you. You don't have to prove a darn thing to the market. The market has to prove to you that it's worth your monetary capital, your emotional capital, so that you trade with confidence and conviction, knowing that you're on the right side of the probabilities of a major market turning point, what we call a smart money bias market trading call, right? Once we're at a net neutral here and starting to move down, as the strength of the trend increases to the downside, now we're at a net neutral and we're short level 6, 7, 8, possibly 9. Why? Because short level 6 at a net neutral, where you could go short or long depending on what the real-time trades give you, indicates that now, if I'm going to trade, I'm really interested in trading short, not long. And as the number increases to the downside at a net neutral 6, 7, 8, possibly even 9, like 2020. What do? We increase our contract sizing because that's what we've been waiting for. Because we've been waiting patiently for the high probability market turning point. Does anybody understand that? There are times to be trading with more contracts and there's times to be trading with less contracts, because at the end of the day, literally, the week, the month, the key to longevity is not the biggest winning trade. It's risk mitigation. Once you understand that you need this wind at your back and you understand how to identify with this, it changes everything. So now we have, this major market turning point that actually happened out. Were there other indicators? Absolutely. Was money flow in it, MFX? Absolutely. And surely enough, oddly enough, here we have a positive divergence here. So as the market traded down to where the major POC to the downside, all the while the long-term money was starting to come back in, because the lower through as compared to the higher through here, as compared to the higher price and then the lower price, clearly signals that as these people are moving down, the long-term money, when it got to that level, shot right back up. And for those of you who have questions about when will these, for example, this positive divergence, if it does cancel itself out, the indicator line will have to pass through the bottom of the upsloping trend line and will have to close below that on a closing basis to be officially canceled out. It's not to say it won't have a secondary or a third positive divergence before prices continue to move up and more volume comes in on a positive side, it simply means for that day, it's canceled out, officially, technically speaking. Long-term money. Long-term money is one way to view the market. But what about the short-term money? Can we take a look at that too? What does that mean? Here it is. Most traders are using one money flow indicator, whether it's short-term or long-term. At the VTC, the Vector Traders Consortium, VTCtraders.com, if I forgot to announce it earlier. Now we have multiple divergences and multiple time frames with two completely different mathematical calculations. So innately, the odds of the market turning point following through for the short to the downside now become greatly increased, because we have both short-term money on a 14-period look back on the MFI as compared to CMF on a 21-period look back, saying the exact same thing, only with different configurations. It's critical that you understand the importance that adds to the increased probabilities of the market moving in a certain direction when you understand how to do this 100%. I don't know anyone, and I don't mean this egotistically, I mean from the Borovic days way back 25, 30 years ago, right? Borovic was an elementary school teacher, and I studied divergence analysis with him. We took it to an entirely different level. I really don't know anybody who has it down as good as we do. And I can say that for fact. I can declare that. I feel very confident about that. Now here again, we didn't have this laid out on the other chart. I mean, we did have this laid out on the other chart, excuse me. So let's just hammer it home here again. And I'm going to rough it in, so don't hold me hostage, okay? Here we are again. Two positive divergences as compared to where the price tapped out at the POC. So both long-term and short-term money are now on the same page again for this high probability market turning point. The best possible moves, whether you're an end of day for the major market turning points, right, looking for the pent up selling pressure, in this case, that had not yet taken place in the form of directional price movement, or here, for now, price is moving up. The best case is that we're able to not get behind the prices, like the Wizard of Oz pulling back the curtain to determine what's really going on. And the thing is that we're not following, and I have nothing against systems. We're not following systems that are based on price movement. We're based on the daily end result order flow of institutional traders coming in and out of the market. That's exactly what we're doing. We haven't even gotten into order flow yet in real time. We haven't even gotten into divergence analysis in real time. We're not even getting in yet to a real-time trade that was taken this morning, identified by the VTC model. So now that we understand all this, and is there more? Yes, there's more, but because of time constraints, you know, we have to move on somewhat here. So let's just show one indicator here, which I use. This is my personal workspace, by the way. I use all these charts every day on a daily basis to determine what's my current smart money bias market call for this session. Am I net neutral? Can I trade long or short? Am I short? Am I long? So now that we have a stamp on it, and we get a stamp on it every single day, we find our levels and we go to work. Here's another one before we go and get out of this. Same thing. On a price-based indicator, there's nothing to do with prices. Stochastics Momentum Index, the indicator fires here after the crossover of the overbought zone, after the negative divergence, clear to go short. Let's go. Doesn't stop till here. It moves up when the prices start to move up. Excellent indicator. Very, very powerful when we're talking about price action. Oh, and by the way, people, we are basing our decisions on indicators, right, that worked 75 years ago today. 75 years ago, 50 years ago, 25 years ago, 10 years ago, 5 years ago, and worked today. The videos that are on our YouTube channel, 160 real-time trades, unedited, taken in the moment as they were, okay? All within the last 10 years, right? Nobody has that count. So there's a way to go back and look at the validity of what I'm saying here. That's as far as we could have gone back. 10 years is we were just on a radar screen, right? As an educational service. But the fact of the matter is, we want to focus people on things that cannot cancel themselves out, that cannot be the flavor of the day, and then in a different market environment, right? They don't work anymore. We need to focus on things that have direct application to trading successfully, profitably every single day. And if there's nothing in there on that particular day in real time, it's a high probability trade, and at the last minute, you can see it's going to turn out to be a shakeout when you get to the trigger area, don't take it. Nobody ever went broke by standing on the sideline. Nobody. You don't have to chase any trades. We talked about this earlier. Let them come to you. Let them prove to you that they're worth your time. How about flipping it over the other way for a change? There's no reason to take more than 5-6 trades a day, unless the market is opened up, you know, and you're almost going around the clock, like we have, my team, right? But it's not necessary. And then again here, just to finish it up, right? There you have it. Okay. I was going to do the slides, but I want to get as much information in as I can. I don't want to tie up a lot of time with slides, if it's okay with you, Jeffrey. They're only from our end anyway. There's nothing else to tie us in on that. So how about if we just get some real-time information here, and let's talk about how everything we just covered has direct application to trading in real time, because that's essentially what's happening here. Everything that we just went through, everything that we teach within our trading course, right, which later on you're going to be able to take advantage of at a very special price, and only in this Metastock webinar, an hour of personal mentoring time with me, because it's the Metastock kickoff at no charge. You're going to see. So let's close this layout, and then we'll go back into here for the real-time information. Okay. Okay, so I have one daily chart within my real-time workspace, so I can look at the levels that I need to look at. Again, here you're looking at what came back in from 3/4/2021 right here, as we talked about earlier, right? Okay. So I need to take these levels, in many cases, the opens and the closes, and I need to extrapolate these over into my one-inch chart in real time, so I know where my major support and resistance levels are in real time, to use them as price profit targets. For example, the next target to the upside would be here. The gap was already filled. So in the case that we are very clear about, you know, where these levels are and how to deal with this, right? We want to be able to take advantage of the free and clear areas where we have enough distance to go, for example, from here to here, if enough real-time volume comes in to be able to benefit from this size move. Obviously, we'll set up a 50 between these 2 points. But again, for example, between these 2 areas here, outside of these highs, if the market's going to move up and that gap's going to get closed, because more than 75% do get closed, that's my free and clear. And that's the trading session information that was laid out for yesterday's trades. When and where do we have any real business trading? How are we going to trade it? Most traders, they have no idea where these levels are. They have no idea where to find the major daily levels based on opens and closes, the incremental levels that are drawn from the past based on highs or lows, and how to play this. We do. So incorporating your daily levels inclusion before we move on into your real-time trading are critical. If you don't know where these levels are or how to find them, or are connected to data points that are off, you're not gonna wind up with the same profitability. You're gonna get shaken out left and right. And the most important thing is when you get in real time, you know exactly where you're gonna get in, and you know exactly when you're gonna get out. Oh, by the way, as an honorable mention, how much positive volume is coming in here after the market stopped to be able to push these prices through today? Not much. Maybe that's why we were net neutral today. Could trade long or short, right? But knowing there's a major POC here within this bar, right? Point of control. The first third of this bar here is when the largest amount of contract sizing came in to continue the move to the downside, right? The volume came in, the after effect of it was that followed through all the way down to the close. We knew that we're trading up into major upside resistance from the smart money. So now that we have covered that, let's get into looking at a few other things. I mean, just based on the price indicator here, right? Quick overnight stuff even. Look at the positive divergence out of the SMI here. As compared to the higher price, lower price. Here's your earliest entry, here's your second preferred entry, and look at the size of this move. Possibly getting out here, right? Possibly riding it up again. Possibly getting out here and taking a second move in here and see how prices react at this level, which was drawn from the past, from where the market tapped out right here. Okay. So basically, 3 a.m. Eastern Standard Time, European session open, and says we're coming in strong. See the volume? Again, large institutional contracts coming in as compared to all of this to drive these prices up and follow through to the upside. People, I cannot stress to you enough how important it is to make the relative comparison of higher contract size and accumulation in this case as compared to the prices as to the reason why we should bother trading, where we have a real high probability trade setup that can follow through, right? Right, exactly. These are 1 minute prices. This is what we're trading off of the levels to get in and to get out, predetermined price profit targets. Let's get rid of this here for a minute. Over here, the best preferred entry right after the market open, right? Here we are. Here it is, 6/27/2022, 9:32 a.m., 9:33, 9:34. My clocks are married up, are parallel to Eastern Standard Time. I know this is ETH. I know this is coming out of Chicago. But if anybody wants to make the relative comparison of how the equities market opens and how the futures market parallels with that or not, should have those dates and times lined up to be exactly the same. So here we are at around the 8:30 mark, right? And this was the lowest price as prices moved up before the market opened. Volume is dry, there's nothing there. Some sells that came in here and the major market volume after the opening one, 9:31, they're all sells. They're all sells. So as we look at this, we can clearly see, and we're going to get into the 15-minute chart level here, that this was the place to get in, and this was exactly the place to get out, right? Predetermined price profit target to lock in profit here, all levels identified and laid out ahead of time. The 15-minute level was right there. Could you have taken it off after the pivot point low was complete? Absolutely. You picked up 5 points. Could you have gotten back in again when the market turned back around and traded to this level by a couple ticks? Absolutely. Picked up another 5. It would have been 10. But the fact of the matter is the move was identified and was traded by most everyone on my end. So the profit on this trade is 18 points. 18 points times $50, a full point move on ES, because every quarter point is $12.50, is $900 a contract. $900 times only 5 contracts is $4,500 US dollar gain on the trade, all based on using the VTC model for trade selection. Notice how after the preferred entry was hit, the prices followed right through. No shakeouts, no look back, no waiting. Now the prices have moved on some since this morning. Let's look at a 15-minute chart, for example, right? All right. Let's take these out for now. And take this out. Okay. These are the 15-minute levels that you just saw. Here's the negative divergence that exists on the money flow index. Okay. See what time this is? It's 4 a.m. Here we are, 4:45. Here we are. What time is this? 9:30. Things turn right back around. Where's your target? It's right there. There. Possible in below here, but a better in right there. And that's exactly where we got in. Here's your free and clear. Look at the price chart pattern, uniformity, low volume. Can't compare it to open equity session volume on futures. The path of least resistance was to the downside, and there you are, bang, out exactly at a predetermined price profit target. This is the way a professional views the market. I've trained a lot of institutional traders. I've trained floor traders in New York how to identify with these levels. And as Jeff knows, I have mentored a lot of people who came through the system that was 12 years ago on how to become professionals, and they still are, like Steve Lawrence, right? A lot of guys. Dusty McClung, Beamer, who knew how to trade. You just didn't know how to figure the rest of it out. Let's see if there's one more chart before we get into something else here. Okay. By the way, here's a 5-minute chart for the up move. See the positive divergence compared to. This is when the prices traded up earlier. Now you may not always have negative divergences, especially on the 5s, as compared to the prices before they move to the downside, but you will have a straight move from above to below, right? Like you had here. So as long as your indicator's peaked out and moves down while the prices are moving down, right? As long as your indicator's peaked out and moving down as the price is moving down until it stops, right? And then things turn right back around. That's the most important thing. And that's money flow index again. And in real time, I'm looking at a 12-period look back. In CMF, I'm looking at a 19 as compared to 14 and 21. I don't know if I'm moving too fast for this audience. I would hope not. You know, you can play this tape back as many times as you want. There's a lot of people in this room. Can I get a raise of hands to see how many people understand what I'm laying down so far? So now that we have accomplished this, I will move into one slide here, excuse me. What we need to understand is that a true professional knows the current state of the market every day. You have to know what your bias is, long, short, net neutral, because you have to figure your contract sizing. Then you're looking for the real-time trade setup and trying to put a number on that so you know exactly how many contracts you trade ahead of time. And then you have to know exactly where you're going to get out before you get in. A lot of traders have a pretty good idea where to get in, but they don't have a solid idea for price profit target number 1, 2, or 3. PPT1 is the easiest one to get to because the first moves are the easiest to capture and profit from. PPT number 2, if the 15s still look good to be short and the 5s are still good, you can stay the trade when you have more experience. When the market has opened up significantly, you know, like the last major sell-off or maybe 2020, right? Then you could get out at price profit target on leg 2 and then get back in just below where you got out by a couple ticks and take it down to the 3rd leg. We need to be able to trade with a lot more confidence than just following a certain indicator that tells us we could be long or short. We need to get behind these prices to determine, you know, what's the reality of the smart money getting behind me or me behind them? What's the number on the probability for the trade that I want to take that has the real ability to follow through or not? This is what behooves a lot of traders and makes it something that, you know, they find difficult to attain. But in this case, it becomes much more clear. Comments, Jeffrey? Anything you want to add? Amy stepped away. Okay. So we've covered how to identify major market turning points. We've covered the volume analysis compared to the prices and exactly what it signals. We've covered divergence analysis where prices are saying one thing, but the money flow index and the money flow indicators really are revealing where the market is really headed soon enough. We have identified the true high probability trade this morning that was taken by a lot of people. And we've learned how to be fully prepared to enter and exit a trade from a setup to the execution of deferred entry price, right? To getting out at your predetermined price profit target. So at the end of it all, we have to trade in the same direction as these largest institutions, the richest people in the world, because they're controlling anything. Once you get your head around the fact that the entire market is manipulated, you say to yourself, okay, so what? It is. It's a rigged game. Let's go with it. How do we nail it? And this is the tip of the iceberg. This is the tip of the iceberg. You know, visual analysis is technical analysis. Technical analysis is visual analysis. It's basically a roadmap, you know. In many cases, I want to say, forget the charts. Look at what, you know, the smart money's doing. We can't forget what the prices are saying either, because we need to roll a comparison of the prices to the indicators. But these are all mathematical formulas that are based on price and time. And they're not based on highs or lows, volatility bands, so forth and so on. They're based on hardcore closing prices. Every time that 1 minute bar closes, the 5 minute bar, the 15 minute bar, the end of the day bar, which is not closed, it's actually settlement prices and futures, right? It's all based on that price. Why? Because anybody who will tell you who's been trading a long, long time, the closing price is king. Why? Because that's where the sum of all market participants have decided that that is what this instrument is worth at the end of the day. That's it. So, what else do we need to cover? What else is important? I think that it's time to get into who we are and what we can do. I mean, the VTC has been in the educational business from the inside technician up and until now for 12 years. 12 years nonstop. We're fully transparent. We believe, we honestly still believe that words like commitment, accountability, transparency still hold water in today's world. It's the way it should be. It's the way it is, because otherwise it's not real. But people, you know, they ask me, well, if you trade and you've been trading this long, why do you teach? And it's a valid question. And the answer is, does anybody out there have a reason for being alive? Do we have a mission with our lives? Right? What's our purpose in being alive? Right? My mission, decided a long time ago, about 15 years ago, was to become a mentor. And I do it because I love to do it, and I do it because I love to see the lifestyle change in people, the people who apply themselves, who put in the work, because it's not easy. It's important to understand there's choices out there, people. You don't have to settle for what life's given you. You can go out there, apply yourself, and accomplish great things. I'm not going to get into a big motivational speech, but I knew that 30 years ago that I couldn't work for anybody. It was impossible, not for a long period of time. I had to be in charge or I couldn't do it. It wasn't going to happen. And so I had to come up with a way that I could make as much as I needed to make, live anywhere in the world that I wanted to live, and have a good lifestyle. And I did it. I live in the Dominican Republic. I have several locations here. I haven't been back in the US for probably 10 years, right? And I have access to beautiful beaches. I work a lot. Don't kid me, I still work a lot. So this is something that I love to do. If there can't be mentors, then who's gonna really learn how to get something under the belt, right? No. Jeffrey, are you there?
Yes, I am. We
Okay.
got a question from James in the YouTube, or not in the YouTube room, in the GoToWebinar room. He wants to know, what's your YouTube page?
What's my what?
YouTube page. What is your YouTube page?
Okay, it's vtctraders.com, Victor Tango Charlie Traders. That should be good enough. Get onto YouTube and type that in, you'll get there.
Okay. Let's see. James says, I found it. So, John, and you might have addressed this earlier. My apologies if you did. He wants to know if it works for stocks as well. And do you have any information about dark pools?
About dark pools?
Mm-hmm.
Okay. Yes, everything that I have just presented has direct application to trading stocks. You can trade stocks, ETFs, mirror funds, index funds, right? Futures. I'm not going to get too far into commodities because I don't like to go in that direction because of the illiquidity. But at the end of the day, in conclusion, any instrument that has enough liquidity, meaning enough participation, enough price chart pattern uniformity, right? Anything that can be analyzed with the most important indicators, the way that we're doing it here, can be traded. For me, I'm ES, I'm YM, the Dow E-mini futures, and NASDAQ E-mini futures, NQ. Because out of those three different markets, I can pull enough in to make more than enough. Dark pools. I'm not an expert on market dark pools, so I understand the basics behind it. What are the richest people doing, behind the scene when nobody really knows? I would imagine the same thing they're doing here, but in a different way. So I wouldn't even consider trading in dark pools. I would wait till you're out of that time frame and you're back into Eastern Standard Time for stocks. But I would definitely be looking at ES and YM in real time before the equities market opens, so you know whether the market's going to gap up or down. And if you have a stop in or you're willing to take a trade at that time that you've been looking at, you understand where the market more than likely is going to go, because the market's trading up on the equity side strongly. Futures are trading up strongly, for example, and gapped away, right? The equities market's going to gap away to catch up, so it can find its equilibrium. That's the best I can say to John. Go ahead.
Perfect. And then I just sent out the link for the course you're doing on your S&P 500 E-mini course. Did you want to talk about that a little bit?
Sure. Let me pull that up on my screen for just a moment. We'll get that in. Just give me a moment, please.
Oh, take your time. Take your time. No.
Okay. Yeah, here we are. Okay. Maybe I can even grab it out of your chat area. Let's try that. That won't work. Okay. I know what I have to do.
If it's easier, I can share it. I've got it loaded right here.
Yeah, this is the offer, right? The actual page for the special price you're going to show, right?
Correct. Yeah.
Okay, go for it.
Okay. Let me go ahead and just take over here as presenter.
Sure.
And then here's this. Can you see it now?
Yeah, I've got it now. Could you scroll down some, please?
For sure.
Okay, there's 7 modules in this course. Each one run about an hour. And this is essentially the culmination of 30 years worth of accumulated knowledge and going through the markets, going through the testing, going through the indicators. And module 1 is all about the critical nature of volume. Module 2 is about the key indicators that you're going to use. Module 3 about advanced trendline analysis. 4, the largest institutions again. Module 5, divergence analysis nailed. 6, putting the puzzle together, right? And then module 7 is how to cross the bridge from your end-of-day analysis into real time. Now, there is no, let's be clear here, there is no one single course who will teach a person how to become a highly profitable real-time trader. Okay, it takes a lot of work. It takes a lot of due diligence. But there is information that exists that can get you 80% of the way there, and this is it. I know because I presented it myself, and I took everything that I had at my disposal, all my accumulated knowledge, my experience, not just with trading, but in life, what it means to be a life of a real trader. And what I'm really looking for, you're in my head, and you can hear my thoughts as I'm talking out loud. I'm not just handing over information saying, look at this and look at that, and this is what you do, and that's what you do. Like, sorry, 90% of the talking heads that are out there, right? Come on, let's admit it. This was a very well thought out, very structured, learnable, and repeatable course that can teach new people, beginning people, advanced trader things that they had no idea about. And if for nothing else, 20% of the information is new to advanced traders. The rest is a confirmation that they're on the right track. They're doing the right thing. Because sometimes they need to know that when they're going through difficult periods. The price originally was $2,500 a couple years ago. The price on the website is $14.97. The price through this link that you're looking at right now is $9.97. It's never going to get any lower. And today, because of the reestablishment of the Metastock partnership, getting off the launch pad, I'm going to do something that I've never done. I'm going to offer everyone who's in this room here now 1 hour of mentoring time with me, additionally, in addition to the course. So we can even record that through GoToWebinars program, and you can have it without an additional charge. My mentoring fees are somewhere around $500 an hour, so that fee's been reduced too. So, when you look at what's available, this course is the most comprehensive course presented by a real trader, myself, who not only has the information, but as I hope and I believe you can see through this short presentation, trying to keep it as simple as possible, that I know how to deliver this information over to other people in a very structured, learnable, repeatable, and comprehensive way. So this is what we're willing to do today for anybody who's in this room right now. And we're only going to take 15 people. And the reason why we're only taking 15 courses, we're only going to sell 15 courses is for good reason. I have a son who's 6 years old named Peyton, right? I have a business that I have to run, right? And I also trade almost every day in the morning. So 15 courses means 15 hours of my time. I can't do any more than that this month or in the next 6 weeks. I don't have it. And this is why the deal is honestly limited to 15 courses that will be sold today, right? It's a good reason. It's good to have a family. It's good to love what you do.
I would agree with that. I'm just totally agree with that. All right, so let's just to reiterate, and the link is right there in the description. But normally this course would be about $2,500. It's $1,497, but if you do it as part of the Trader Summit, you can get it for $997. So click on the link in the description to get that. And in addition to that, you're going to get an extra hour with Jeff Killian. So
yeah, that's my promise to everyone. Yes. I think we have the website is 20 minutes or something like that. And we're going to do a special deal today for an hour. Yep.
Good. Very cool. Let me jump back on here. Jeff, that was great. Welcome back. It's been too long, my friend, but welcome back.
Yeah, it's been my pleasure to present to the world today. I hope that, everyone understands that anything that's worth having is worth working for. Nothing's changed. The world has changed a lot, but nothing's changed according to this. It wouldn't matter, whether you want to go to Wall Street, whether you want to become a restaurant owner or whatever the business is. You're going to have to put in the work. You're going to have to apply yourself. But it sure is a hell of a lot better when you're working for yourself and we don't have to answer anybody. We don't have to travel. We don't have to put up with anybody. Only the people we have to deal with are ourselves. That's it. And that's what makes all the difference. All the difference.
I love this testimonial with Larry. I know Larry well, and I just wanted to point this out on the site right here. Larry Jacobs is the editor of Traders World Magazine, and it just says, I recently spent 8 hours of training one-on-one with Jeff. He is by far one of the top technical analysts in the world, and clearly showed me how a trader or investor must first become an expert market timer in order to trade profitably. That coming from Larry, it's a pretty good endorsement.
Yeah. Yeah, I spent a lot of time with him because he wanted to make sure that I was real. So I said, okay.
All right.
But so we did.
It looks like we're out of time. Jeff, thank you. That was great. I really appreciate you coming in and spending some time with us. And
okay, how can these people, what do they do? Click through and then they're going to bookmark this link in order to get access to it?
Correct. So they'll just need to visit the link on the site right here. So, and it's right here. If you click on it, you can go ahead and do it right now. There's no reason to wait.
Okay. And then when we go to another participant, is this going to disappear, or do we need to ask them to please open this up and bookmark it so they can have it at their disposal quickly?
This should stay, but if anybody wants to get any of the links at any time, they can always contact us and we'll be happy to get them, or ask again. If you misplace the link, we'll make sure that it's there.
Okay, once again, thank you for joining us today across the globe. Jeff Killian for the Vector Traders Consortium. Thank you, Metastock. Thank you, Jeffrey Gibby. It's been a pleasure to come back and be here today. I really mean it. And the VTC, Vector Traders Consortium, VTCtraders.com is here at your disposition for whatever you may need. Enjoy your day out there.
Yeah. Thanks, Jeff. Lori says, hey, that's been real. And it's extremely important. So great job today, Jeff. Really appreciate it.
You're very welcome.
All right, let's go ahead and try to get over here. And we do want to talk real quick about the Trader Summit Action Pack as well. Let me go ahead. I am. Let me turn on my microphone, but it's already on, so don't need to worry about it. I do want to kind of mention that the Trader Summit Action Pack that we're doing today, all day, is going to include that Go No Go Complete, the Bigelow Candle Profit Systems 2.0, 3 months of the OVI Trader, the 3S code from Silas Peters, 3 months of Learn Metastock, and Unleash the Power of Metastock, the workbook and videos. Normally, individually, you could buy all that. These are some of our most popular add-ons of the year. I'd actually say if I was to make a list of the popular add-ons of the year, this would be the one. Normally, $3,630 is what you would pay for this. Here at the session, you can get it for $1,641. So to do that, go to metastock.com/summit deal. You can also give us a call at 800-882-3040, or you can chat online with us at metastock.com/sales chat. So Sean says, thank you. Sean, I'm glad you enjoyed the event. I appreciate that. Lori says, thank you. I hope you guys are enjoying today. I'm really, really happy with how well things are going today. So before we go on to our Serge, our next speaker, I do want to say thank you to CMT, one of our sponsors today, for sponsoring today's event. Tyler spoke a little bit earlier about Go No Go, but CMT has been a big sponsor of the Metastock Trader Summits and conferences that we do online since November. They've been great. CMT is such a well-respected and well-reputed organization. We're happy to be part of them and sponsored by them and be working with them. So if you're interested in some accreditation, if you're interested in trading as a business, a CMT accreditation can be very, very important. In fact, Tyler comes in and he talks about how it can help you actually get more responsibilities and more money under management and land a job. We had a guy earlier who is waiting to find out if he passed the CMT exam. I wish you the best of luck, sir. But if you want to find out more about that, go to cmtassociation.org. So there you go. Our next presenter is, I already did that. Our next presenter is Serge Berger. Serge is such a great presenter who we've had some great presenters today, and we really have another one coming right up for you. Serge and I worked back in November to kind of code some of the stuff that he was doing and the methodologies, the Vertical X Pro that we worked on. So very, very cool. And he's going to show it to you. So Serge, let's go ahead and bring you on here. How you doing?
Hey, how are you, Jeff?
Good, and I can hear you. And you're looking
That's
good.
helpful. Yeah, I was just gonna say I was gonna quickly apologize for the home office look. I got in very late last night, and so I'm gonna have to do this from the home office because I just had too much stuff to get back to the office today. So,
well, everybody that's been watching for a while knows what my home office looks like, and yours looks way better and way more professional than mine.
All right, let me share my screen here. Let me see if you can. That looks about right. Can you see that? Oh, there you go.
I can see it. All right. It's all yours.
Perfect. Awesome. What is it? Does it say the title of the presentation? Oh, yeah, there you go.
And it's in yep.
Cool.
Yeah, it's looking good. It is the correct, it's not like the presenter view or something. We're seeing the proper screen. So I will get out of your way. It's all yours.
Thank you, Jeffrey. I really appreciate it. Let's see here. Well, welcome everybody. Thanks for joining us here today, and thank you to Metastock for putting on the event. As I was telling Jeffrey just now, I got in very last night from a sort of a long extended business trip, and so I've got the home office look here today. Couldn't make it to the office, but hopefully that's not too distracting for what we're going to talk about here today. I need to bring up the questions box as well so I can see that. There you go. Perfect. Let me just see where that went. But what I would like to talk about today is a little bit about the broader market, and then specifically what we have been able to do very successfully. Everyone says that, I know. But I think it's going to be quite interesting for you guys to see kind of a very different way of doing things. Very simple, nothing complicated, but very different. So what we're going to look at here today is essentially kind of doing the opposite of what many people do when it comes to the markets in terms of directionality. And I have to give you a little bit of context first as to where we think the market is and why this is kind of why we think this is the proper way to operate through this market. We've come out of a very long bull market now. We had a 12-year market, and that's essentially gone straight up with almost no volatility, and we think that era has essentially come to an end. And so that is going to require a bit of a different way of thinking. So that's what we're going to talk about here today. This is yours truly. I come from more of an investment banking background and then moved on to the portfolio manager side. I'm also the head trader and chief investment strategist at thesteadytrader.com, and also a managing partner and then the chief investment officer at Blue Marlin Advisors, which is an investment advisory company. So just a little bit about what I kind of do. I think to kind of talk about the broader seasonality pattern, just for some perspective, we're obviously rounding off the month of June here this week, and then we're going to head into July. I think we're going to be in a very choppy period this summer. We could certainly see a little bit more near-term upside, but I still think we're very much in the grips of this bear market. And I don't think, personally, our research indicates that this bear market isn't going to be over anytime soon. We'll get sharp bear market rallies. We're experiencing the latest one of which here over the past few days. But I do think it's going to continue to it is going to continue to play out in a very choppy fashion. The most important thing for me to kind of bring about first, before we look at a specific strategy that we are deploying right now, is just to kind of talk about the nature of the market here. And as I alluded to a minute ago, I think it's just critical to understand that this bull market that we've had is really, it's gone. And we've got a bear market now, and I think we're going to have a challenging market going forward. So I guess a question I would have for all of you is whether you think that the S&P 500's, sort of 15% gain per average year over the past 12 years is going to continue going forward. And you guys can answer this out loud or in the chat box, or you can just kind of think about it yourself. But we think that the market is likely in for a prolonged period of much lower returns. And I've got a couple of charts on that in a minute. This is what the S&P 500 looks like through the lens of a long-term view. Obviously, we've retraced about 20%, a little bit more so far in 2022, but we really think ultimately we're in for a very different market for a long time. And that is important, as it relates to the broader market going forward. We know that it's a great thing to have a stock market mania because everyone can make a lot of money very quickly. The trouble is when it ends. And we do think that 12-year bull market of 15% a year is very certainly over in our view. And that makes things very different. So to kind of show you what this looks like from an expected return perspective, what you're looking at on the screen right now is basically just some research from Morgan Stanley. And if you look at the leftmost column, the one I'm circling right now, that's the 2.4% annualized real return that Morgan Stanley has been forecasting for sort of the next 10 years out. So to give you some context around that, the S&P, as I said before, has returned about 15% a year for the past 12 years. And they think it's going to be closer to 2.5, I'm going to say 2.5 to 5%. Even if it's in the middle, on the way high end of that, you're going to see about a third of the return that we've had per annum. And I think one question that everyone should ask themselves is that whether they can live with a return of 2.5 to maximum maybe 5% in their portfolio. Because the reality is that most 60-40 portfolios and really most strategies are extremely highly correlated to risk assets, such as the S&P 500. So yeah, if you may have noticed, if the S&P does well, the portfolio tends to be okay, right? And if it doesn't do so well, the portfolio probably doesn't do so well over time. And over time, it's not on any given day, but over time. So we think that's a very different environment. And I think it's a question, we've been talking about this and discussing this for more than a year at this point. And I can tell you that 1 year ago, no one cared. No one wanted to hear this thought. And it's now been about 3 months now that people are starting to see that they haven't made money for 12 months. In fact, a lot of people have lost a lot in their trading accounts. They've blown up their trading accounts. I think now people are starting to wake up, or at least to listen to a bit more of a realistic, of course, my own personal view, that's all, sort of return perspective going forward. We have inflation. We all know that. I think it's a bit of a cliche thing to talk about this one, even though it's very real. So I certainly don't want to diminish its importance. And that'll be around for a while, even though we're probably peaking now. The economy is going to slow down. I think it's quite likely we'll see a recession, but more importantly, a severe slowdown in the economy. We may already be in a recession. It's possible. You know, we only know these things looking backwards. So things don't really look extremely rosy from a perspective of using classical retail investor strategies where we just buy a stock or buy a call and let it rip and see what happens, whether that's a trade or an investment. And I think that's really, you know, what this really comes down to. So we're expecting a lot more volatility and a lot more choppiness and a lot of sort of frustration, frustratingly low returns with very choppy markets. And that's really going to be a source of frustration for a much longer period of time than I think people think or can even gather right now. So we still see a lot of people trying to buy the dip, and that'll work for a trade, but it's probably not going to work, you know, so some sort of more systematic fashion. And so what I think I certainly do, and we've done for a long time, is something that I think a lot of people should start looking at now. And that's essentially, it's a small adjustment to the way we express our views in the market. It's not anything drastic. It's not difficult. One can still basically use the same analysis, even the same tools for the most part, but it requires a little bit of a different way of thinking, a bit more realistic and less sort of chasing shiny objects syndrome, and more realistic. What are the odds of actually making money in a trade, as opposed to what are the odds of me hitting a home run in a trade? The latter of which that works in raging bull markets with central bank providing liquidity. Now we have the opposite. So that's kind of what we're looking at here. So essentially what I did here is I took sort of a random year in the S&P 500, and I broke down the individual months, not so much in sequence. It doesn't really matter which month is January and which month's June or whatever, but just to show that in any given year, the S&P 500 can have great months, it can have really bad months, and it can have anything in between. And the sequence there is very random. There are some seasonality patterns. For the most part, it's random. And the reason this is really important, in my view, is because of the following fact. Most people have it as at least part of their goal to achieve some sort of steadier stream of positive returns in their portfolio, meaning they're trying to make money like every month or every quarter kind of thing. Like, I'm going to call it an income. It's not the correct term, but they look at it as income. How many people have that goal? How many people would like to make money every month or every quarter to kind of from your portfolio, or at least more steadily? Show of hands. This is really important exercise because we've noticed that a lot of people have that goal, but a lot of people actually not even aware that that's their goal. And so they're using strategies that are extremely ill fit to achieve that goal. Does that kind of make sense? So if by definition the S&P is essentially a random walk throughout the year, and an investor has a goal to make money every month or every quarter, but risk assets simply don't work that way, then by definition, one needs to do something differently. I think that's really crucial. So again, if you are in the boat of trying to achieve more steady income, whether that's monthly hypothetical or quarterly, something more steady, right? As opposed to this, again, think about that. Maybe type a yes in the chat box. This is it's an exercise for yourself, really. Just become aware of that, because a lot of people actually not consciously aware that that's their goal, but it is their goal, and they're using strategies that are very ill fit to do that. So in fact, more specifically, what the average retail trader tends to do is they kind of have a profit and loss curve that looks a little bit like this mountain range, where they do a bunch of good trades and then they do one bad trade and they start right back from scratch. They lose it all. And then they do that again, a bunch of good trades, and they have one bad trade and they start right back from the beginning over and over again. And that's a frustrating thing to do because, I mean, obviously you're not making money, you're just trotting sideways. But even more so, it's a really frustrating experience psychologically, because you're putting in a lot of work and you're not really going anywhere. And ultimately, for most people, unfortunately, it leads to them quitting or blowing up the account. And that's certainly what we don't want. So, you go down this rabbit hole, and I'm sure some of you have done that before, where you kind of go into a downward spiral with trades, and you kind of get rid of any rules you had, and then it's really just a big mess. So we don't want to do that. So what I'm going to show you guys right here is not some sort of magical unicorn formula that's going to make you rich tomorrow. That's not what this is, but it's real. And it's something that has been working really well for us over many years. It's low stress, high probability, but most importantly, and this is, I think, something that, again, a lot of people don't focus on, is it's very repeatable. It's very repeatable, and that's really the biggest point. We've had a success rate of about 80-ish% positive trades, so profitable trades out of 10. I'm going to show you guys a tool that you can use as well, that I would invite you to use, that actually helps us find these trades. So let's get into it before the time runs away. But essentially, what the strategy is all about is these phenomena in the markets when slopes go from a steep move, I got this right, like this, from a steep move to like a vertical move, as you can see on the chart. And then when the move goes from steep to vertical, you get to this point where, as you can see on the chart, the asset in question, be that a stock, an ETF, a futures contract, whatever, it'll just get exhausted for a while, and that's the opportunity we're looking at. You can have the same thing at a downside, a very sharp drop in a stock, and then it collapses even more, and then it gets extremely oversold for a period over time where it just can't go lower anymore. And what happens at these junctures is several things. Number one, options become a bit more expensive, and I'll get to that a bit later. Investor fear reaches extremes, so either extremely fearful or extremely greedy. And thirdly, the reward to risk for some sort of a counter trend bounce, or at least a pause in the movement, which is really all we're looking for, is it's a very, very high probability, I should say. And so this gets us to the next quick part here that I think is crucially important. Now, a lot of people trade options. I would imagine some of you, maybe many of you, trade options, and whether you do or not, it really doesn't apply at all. It doesn't matter. But I want to walk you through a couple of statistics that I think are very misleading. And so, because so many people have that goal of reaching sort of a more positive return, monthly, quarterly kind of positive return in their portfolio, they're drawn to strategies where people tell them they have to sell options. And what ends up happening is they will inevitably come across someone who tells them, listen, all you have to do is sell these weekly options because they have a 75% chance of making you money, because if you buy a call or a put, you only have a 25% chance of making money. So by definition, if you were to sell an option, you then have like a 75% chance of making money. Just let it expire. It's probably one of the most riskiest things you can do, in my opinion, in my 23 years in the markets, is that viewpoint. And I'll walk you through why very quickly, and it become very quickly obvious why that's one of the riskiest things you can do. In short, I'll tell you, one of my jobs in the past as an analyst was I was a hedge fund analyst, and almost every fund, I think it was 9 out of 10, that were using an options theta strategy ultimately blew up. It was a matter of time. Sometimes it was 3 months, sometimes it took 2 years, but ultimately they blew up, meaning they had a drawdown of at least 40%, 35, 40%. And we don't really want that. So it's a very dangerous thing to believe that just selling options, because apparently the odds are so high, you make money, as opposed to buying options where the odds are really low to make money. So that's an important concept, and I'll show you guys what we do, and I strongly believe that is the most sane way of doing it, because it has all the risks parameters in it. So let's just talk about this. But very specifically, we're going to do 4 very simple steps together right now. We're going to look for these steep slopes that have gone vertical, give a sign of exhaustion. We'll make sure that the implied volatility is a bit elevated. We'll talk about that in a minute. We only want to use very liquid options. So that's an important part. And then very specifically, what we're going to do in a very specific way, and that is important as well, that we're going to do this in a very specific way, is to sell what's called a far out of the money call or put spread, but using much longer dated options. And there's another huge point to this, so I'll talk about that in a bit. So the details here really do matter to this strategy. Some people say, oh, I've done that before and it didn't work. The details do matter. They're simple, and in hindsight, they're going to be basically the opposite of what most people are doing. So watch this. It's going to be really cool to see. Again, we're going to look for these parts in the market that have gone from a steep move to a vertical move. Like in this case, you can see the stock after that vertical move, it slowed down. It started to relax and take a break. It ultimately even fell, right, over time. Here too, Netflix, very steep rally, it goes vertical, and at some point it just can't continue higher for a period of time that we define as about 2 weeks. So that's what's going on here. So essentially, when steep slopes turn vertical, the upside becomes limited or capped. If that moves to the downside, conversely, the downside becomes limited for a period of time. And it just provides us a much higher probability point to put on a trade rather than chart chasing, which really only works in raging bull markets with liquidity, at your back from central banks. And we're having the opposite right now. So let's have a look at this. So we're going to go through right now, and we'll look at all this on Metastock here in a bit. But just to kind of look at the strategy, because I want you guys to be able to use this later today if you want to. Let's understand the basic idea behind what's going on here. So we're going to just show you a couple of historical examples and then go with Metastock and look at some recent example. This is Meta, the company, not Metastock, the software, and i.e. Facebook. And you can see at the time there, it had a steep rally to the upside within those two parallel lines. And then every once in a while, I had these sort of vertical rallies. And what happened at these after the vertical rallies each time is you can see the stock, yes, it went lower, but more importantly, it stopped going higher for a period of time. You can see after the vertical move, they just exhausted themselves and they just couldn't go higher for a period of time. So let's have a look at this. I'm going to bring over an actual chart so I can doodle on this a bit more for you guys to see. And then again, we're going to go into Metastock right away and start looking at this. But same chart that I showed you a second ago, and you can see we reached the upper end of trend right there once again. And so when we get to the upper end of that steep move I already showed you, there's a couple of things we can do, right? I mean, the stock's overbought, so at the upper end of trend, so maybe we could sell some. If we want to be more aggressive, we could short the stock or maybe buy a put. The problem if we do that is that unless the stock goes down, if I short the stock or if I buy a put, unless the stock goes down, I just can't make money. And that's a pretty low probability bet, because if you're buying a put and it has to go down, but technically it could do two other things. It could go sideways and it could go higher. Since my bet is that it has to go down, if I buy a put or short the stock, I only have a 1/3 chance of making money, all else being equal. And I think once people start to think about that, I've had so many people, that I've mentioned this before and taught this strategy. And sometimes it took them 10 minutes to understand. Sometimes it took them a day and kind of go home and sleep on it. And then finally say, oh my God, really, right? It makes so much sense. Because the problem is if you short a stock or you buy a put, or conversely, if you buy a call or buy a stock, unless it goes in your direction, number one, basically right now, and by a lot, you can't make money. But what if I could tell you there's a way that we don't have to make a directional bet at all, where in this particular case, it wouldn't really matter whether the stock went down, sideways, or even against us to a degree, and we could still make money? Wouldn't that change things? Because again, and this works in any market, or has for us worked in any market, I should say. But I think particularly in bear markets that are choppier and more volatile, it's important to have something that gives us more wiggle room, more forgiveness. And that's really what this is all about. So how do we do that? Well, specifically what we did in this particular case is we just made a bet of where we think the stock is most likely not going to go over the next couple of weeks. So we sold an option up here, and I'll go through the specifics in a minute, and we bought another option against it a bit higher. So essentially, as long as the stock stayed below this line over the next couple of weeks, we can make money. So it didn't matter whether the stock went down, sideways, or against us, let's see, like 8%. Okay, which is pretty cool. You could be totally wrong, you'd still make money. So specifically, the way we do that, or in this specific how we did it, is we used an option at the 125 level, And then we sold that one, and we bought against at the 130 call. We received $1 up front, like $100 per contract, or $1,000 if this was done with 10 options contract. And then a few days later, because the stock in this case did go down, and I'll show you guys examples where that didn't happen. We made just as much money. In this case, the stock did go down, and the spread was reduced to 24 cents. Basically, what that means is that we were able to buy back that trade for $76, i.e. 76 cents, and excuse me, for 24 cents, my apologies, and we made 76 cents or $76 per contract, or if with 10 options contracts, it would have been a profit of $760. But again, the most important thing to understand here is that the stock didn't actually have to go down for us to make money. It could have just as well gone sideways or even against us up to 8%. And I think that's really crucial to understand, right? Are you guys with me so far? So again, all we're trying to do is trying to put the odds as much in our favor of making money, period, and go away, put aside a little bit the chasing shiny object syndrome that I know has been so prevalent over the past number of years in the market. So the crucial thing about this strategy is two things. I'm going to walk through those right now. And again, we developed a tool that we can give you access to as well that actually helps us find these points. So I'll show you that in just a couple of minutes. But the crucial thing that is in this strategy is that, number one, we are not using options that are expiring very soon. That's number one. So you might notice when we put this trade on in February, we used options that expire in April, right? And you can see that right there. Instead of using short-dated options in February, like ones expiring in February, we used April options. So we didn't use February, we didn't use March, we used April options. That's point number one. The reason for that is because if we use very short-dated options and the trade goes against us right away, we still lose quite a bit of money very quickly, and we don't want that. So ideally, what we want to do is have a trade that can go in all three directions essentially. And if it goes sideways, we make money. If it goes, in this case, lower, we definitely make money. And if it goes higher, we can still make money and only lose a very little bit to a certain degree, to a certain point, right? And that's really important. So the second part to this that's crucial, and I hope you guys are taking some notes on this, because this is crucial. So not only are we using options expiring much further out, that's number one. The second point is honestly more important. And the second point is that even though we are using options for this strategy that expire between, let's say, 55 and 85 days, we're still only holding these trades for about 2 weeks. Let me say that again. This is because this goes completely contrary to what probably the vast majority of retail investors do. So even some retail investors who might be doing something like this, they end up using very short-dated options because they're being taught that that's how you do this, and you have time decay and yada, yada, yada. The problem is, if the trade goes against you, if you use short-dated options, you're toast. There's nothing you can do. So we're doing the opposite. Instead of using short-dated options, we use much longer-dated ones, number one. And number two, even more importantly, we're only holding the trade on average for about 2 weeks. So even though we're using options expiring way out, 55 to 85 days, we close the trade after 2 weeks. And that allows us to never be in a short-dated option, not even close. Now, other things are important here as well. We never hold any trades through like an earnings report or through any major economic things that are very sensitive. So those are two little things as well. But in general, what you'll see here is you'll be able to make money even if you're completely wrong. One can make money in a trade like that. And if you think about that, if you buy a put or you buy a stock or a call or whatever, unless it goes in the desired direction by a lot, and basically now one can't make money. So this is the exact opposite. Is this starting to make sense? So what I'd like to show you here is I'm gonna show you this on Metastock here in a minute, just some recent examples so you guys can see how it works. But I'll show you Tesla, for example, as well. This is the same idea. Here we ended up doing a bullish trade. And essentially you can see the stock at a sharp drop and then a vertical collapse. And then instead of buying the stock, we simply said that we don't think it's going to drop a heck of a lot more over the next 1 to 2 weeks. And so what we did at the time in February is we used June options. So we sold a put option way down here. We bought another put option against it a bit lower. And when we do a trade like this, it's called an options credit spread in a very specific way. We actually receive money deposited up front in our broker account. So in this case, we would have received $2.25 per contract. That basically means $225 deposited in our broker account per contract. If one does this with 10 options contracts, one would have received $2,250 up front as we open the trade in our broker account. Remember, this is the debt credit spread, so we receive money up front. We don't pay money. So that's another neat little aspect. Now, in this case, you can see the stock did go higher. So a couple of weeks later, that credit basically shrunk to 43 cents, which meant that that we got to keep the difference. So we made $182 per contract, or $1,820 with 10 options contracts. But again, the stock didn't actually have to go higher for us to make that money. It could have just gone sideways, even a little bit against us. And so, this is really powerful. And just understanding the concept of what if I'm totally wrong? What if I don't have to be dead on correct in my bet on a stock, ETF, whatever? What if I could be kind of correct or even maybe totally wrong and I could still make some money? That is really the thing to think about, particularly as we have a bear market that, again, I think we have a lot more to go. I'll give you another example before we look at some recent trades here on the Metastock platform. This is the S&P 500, the SPY ETF. Now, this is a fairly prominent time in the market, and I'm gonna bring back some ghosts here. But this is basically at the lockdown, first lockdown, first COVID lockdown in 2020. Seems like a longer time ago now, unfortunately, every day, but it's still there. But essentially, what happened is the S&P had dropped about 30% in 3 weeks. So on March 16th, I remember this. It was yesterday. I walked into my office and we were discussing this internally. We said, you know what? We think equities might be oversold here, but we're not going to buy any. It's just too volatile. But we would do and did the following trade, the following bet, if you will. And so what we said to ourselves is that, listen, we are willing to make the bet that after a 30% drop in 3 weeks, that the S&P isn't going to drop more than another 18% on top of the 30% it just dropped over the next 2 weeks. And essentially what that meant is that we could have been totally wrong. The S&P could have gone down, sideways, or higher, and we could have made money. Now, notice on this chart that when we put the trade on March 16th, we used June options. So there's a couple of important things. Same thing I just went through, but here's another real example. So we used June options in March. Why? Because if we use short-dated options and the S&P would have gone lower, we would have lost a lot more money. But we don't want to do that. The whole point of this strategy is to give ourselves as much room as possible to make money, period, and not make the bet on, make a low probability bet on a huge payoff. And I think personally, everyone should have a strategy like that in their arsenal, in their portfolio, particularly when we're in bear markets like we are right now, or likely sideways markets that we're going to have for a number of years, I think. So if you look at this closely, on March 16th, the SPY was at the same exact level that it was 8 days later on March 24th. So the S&P basically did nothing for 8 days, but somehow we were able to take home a profit of 11.4%. How is that possible? Well, it's possible because number one, again, in March, we used June options and we used these way out of money put spreads, and we only held the trade for a few days. And so it's really important to distinguish between strategies that expose us to directionality, where one can only make money if a stock goes in one's direction, versus ones where we can be essentially almost dead wrong and still make money, or certainly not lose a lot. Right? So this is crucial. It's a little bit of a different way of thinking that I think everyone should consider at this point in the market. We know that a lot of people are losing a lot of money this year and are going to lose a lot of money this year, and I really don't want you to be that. And I think being a bit more rational and using a strategy that's a bit more sane, or appropriate to this market. Let me take that, restructure that sentence. I think goes a long way. So how many people could see the sense of putting on trades where you can essentially be totally wrong and still make some money? Now, of course, the point here is that we can put on these trades, but we still need to find opportunities where we can actually find these trades. And so what I'm going to do is I'm going to show you guys what this looks like on Metastock. So just as a basic way of thinking, you know, the great thing about these trades is that we're not looking for winners. It's just a matter of staying out of the losers. We're not staying out because there will be some losing trades. Our track record is about 80% winners, roughly. But when a trade goes against us, we don't lose a lot of money. And that is a complete, you know, a game changer for our strategy. And so we put these trades on at the beginning of every month, quarter, and all, whatever the time frame is that you're focusing on, to really give us that layer of income on a monthly, quarterly basis, whatever it is. And then once we have that, we can still do other stuff. There's, you know, whatever all other stuff you guys do, whether it's a day trading or investing stuff, whatever your time frame is. But I think that income-oriented focus goes a long way because it keeps us sane as investors and traders. So you guys can see those arrows, right? I'll show you guys in a minute as we go into Metastock. Well, you can see at those arrows, the stock stopped going higher, right? It dropped sharply ultimately, which is nice, not necessary, but it's kind of a bonus. But more importantly, to the right of those blue arrows, the stock stopped going higher. You guys can all see that, at least for 2 weeks. Same thing here in Alphabet, or here in this ETF. You can see to the right of that blue arrow, the stock stopped going higher for the next couple of weeks. It ultimately dropped even more. So here's what this looks like. So the chart here is a little bit darker, but this is a Metastock now. And this is United Airlines. So you guys can see that, for example, this was in early March of this year. On Metastock, this tool that I would like to give you guys access to as well told us the stock is oversold. And the stock then ended up rallying sharply. I mean, very sharply. But it didn't have to rally. The point was more what our indicator told us is that the stock is now likely exhausted and it's not going to go a lot lower for the next 1 to 2 weeks. So then what we would do is just below the market where that error is, we would sell a put, buy a protective put a bit lower against that, and then receive that net credit. Remember, we receive money up front. And then 2 weeks later, we hopefully close that trade for a profit. If the stock goes up, we definitely make money. If it goes sideways, we like have a 95% chance of making money. And if it goes against us, we still have a good chance of making money and certainly aren't going to lose a lot if we do this right. So that's United Airlines. There's just another, this is AMRCN Electric. This is one I came across the other day. This, you can see this is a few days ago, like 2 weeks ago at this point. June is going fast. You can see it told us the stock was oversold on, I don't know, the 14th of June, I think. And you can see the stock has then rallied from like whatever, the high 80s to the mid 90s when the screenshot was taken like earlier today. So all we would do instead of buying the stock is we would just sell a put below the market, buy another put against it, receive the credit, keep the trade on 1 to 2 weeks, and get out. In this case, you can see 1, 2, 3, 4, 5, 6, 7, 8 trading days later, the stock had a big move, could definitely close it for a profit. So this just a few days ago, this signal came. CMS Energy, same deal. Look at this. The stock, the indicator told us the stock was oversold. This is a Meta stock on the 14th of June. And you can see 1, 2, 3, 4, 5. That's 1 week, 6, 7, 8. And the stock has gone from whatever, low 60s to the mid 60s. That's a pretty decent move. Could already close this out for a profitable trade. But again, I think more important than anything is that the stock doesn't actually have to go higher. The stock could go sideways or even against us to a degree, and we could still make money. And again, I think that way of thinking is something that everyone should consider, particularly in this market that is a lot more nervous and no longer that sort of easy bull market, if you will, that we've seen for so many years in the past here. Here's our GameStop. I decided to show you this one just because it's a name that I think some people are still watching. It's having a harder time, believe it or not, these days. But this is GameStop. It gave us an overbought signal in the middle of March. Can you guys see that arrow up there? The signal is not telling you that the stock's about to collapse. No signal can tell you that with any guarantee. But the reason why the signal is so high probability is because it's not telling us that. All it told us in mid-March is that, hey, this stock's movement is now likely extremely overdone on the upside. The stock is very likely to either go down, which it did in a big way, or consolidate, maybe go a little bit higher. It's saying that the momentum is exhausted over the next 1 to 2 weeks, right? And of course, the stock dropped from 180 down to 80, shaved off $1. Right, this is GameStop. GME is the ticker symbol. So again, what we have done here, we would have sold a call up above the market, bought another call against it, received the credit, and keep the trade on 1 to 2 weeks and move on. I mean, the stock collapsed dropped like a rock. So again, are you guys starting to see kind of what the point is here? And so I'd love to give you access to this indicator as well. Or here's Walmart. It's a great example. This is Walmart we're looking at here. And you guys can see that the indicator warned us on the 17th of May. The stock is oversold, but it's still plummeting. Again, told us on the 18th, the 19th, and the 20th of May, said, listen, guys, be careful. Stock is really, really oversold, but it's not yet done. Finally, on the 23rd of May, the arrow disappeared, which tells us that, hey, we're good. The stock is most likely not going to continue dropping at the rate at which it has for the next 1 to 2 weeks. Lo and behold, what did the stock do? It went from 120 to almost 130 over the next 6 trading days. Happy days, right? So again, it's not about making a bet of where the stock is most likely going to go right now and buy a lot, but it's a bet of where it's most likely not going to go. And that completely changes the probabilities and puts the odds in our favor. Here's gold, the GLD. This is a couple months ago, and you can see it gives us an overbought signal. The arrow is right there. It's a bit small to see, GLD. So again, same deal, right? Indicator told us, hey, the stock is overbought. It's not telling us it's time to short it, even though that would have worked well in this case. It told us, listen, the move is extreme. It's likely going to either go lower, sideways, or consolidate. So we sell a call above the market. We buy a protective call against it, take in that credit up front in our broker account, keep the trade open 1 to 2 weeks, close it out, and hopefully have made a profit, or at least with a very high probability. So that is our process. And by the way, this also works for day trading. Now, I don't do credits intraday, but on an intraday basis, I can show you guys this really quickly now. If you'd like, if anyone's a day trader here, just to quickly show you, like this is live right now. This is Zoom, okay? And I'll just quickly show you this. This is Zoom. Today is, what is today, Monday? So we had an overnight overbought, but like last Friday, so a couple of days ago, you can see the stock told us it was overbought, and then it ended up dropping intraday, 3.4%. So tons of ways of using it that way as well on an intraday basis. So the indicator is one that I use for the credit spreads for income, but also just as much for day trading as well. If anyone's a day trader here, just thought I would I'll bring that up. Does that make sense? Again, all we're looking at is a bit of a different way of looking at the market to really put the odds in our favor. Because I think the objective in the market isn't so much to hit a home run every time, but it is to give us the highest probability chance of making money, period. Right? There is also certainly the home run strategies. This is just another strategy in a bit of a different way. So as you've seen, this is a process that I think works really well. I know it works very well. I've done it for many, many years. And so I'd like to introduce you to what's called the Options Income Secrets package, because a lot of you admitted before that you're here to generate you want to generate a bit more steady, positive return, and on a sort of whether that's a month-over-month or quarter-over-quarter basis. So what I'd like to do is introduce you to the Options Income Secrets package. And what we're going to give you here is not only the indicator and scanner, all of which is available on Metastock and other platforms. I'll talk about that more in a minute. But also you're going to get included a course and lifetime members webinars. We do twice every month where we give you a live trade every single time. So you're going to get 2 trades every single month for life, including full access to the indicator and scanner. And the benefit is that you have a repeatable strategy you can use every week, every month, every year to, over time, produce a much steadier stream of positive returns. So I think that's been the case for us. But we also want to give you an edge in the market. So this is not just about education with a bunch of course videos and a bunch of trade alerts. We also give you the indicators. So you have that for life, full access to you to use as well. Now, one question that we always get is, how do you scan for this stuff? Well, scanning is actually super simple, whether you use that on Metastock or some other platforms. It's literally a matter of just clicking a button and we have 2 scans, the overbought stocks and the oversold stocks. So I'll show you what this looks like. Like here, for example, on one of the platforms, you literally have the overbought stocks. You click that one button and it shows the overbought stocks. So it works in a whole bunch of platforms: Thinkorswim, TradeStation, NinjaTrader, TradingView.com, WealthTrends, and of course, Metastock, which is the real focus here today. Now on Metastock, as I showed you all the charts before, this is what it looks like. It tells you exactly when a stock is overbought or oversold, or an ETF or any other asset class for that matter. And scanning is super simple. You literally just open up the platform, you hit the scan function there, and it's going to give you the results right away. And then you click on that, opens the chart, boom, and it looks exactly like we showed you there a minute ago. And I think one of the absolute best parts about the Vertical X Pro, what makes it so great, is that it gives us access to the highest probability credit spread sort of income setups and day trades as well. So we're going to give you a platform here and a foundation that, whether you're new to trading or we've done this for a while now, that you have this strategy, you have this tool that you can really rely on month over month and quarter over quarter, just to create a more steady stream of positive returns, or call it an income. And that's exactly what this does and what the point of it is all is. Now, what we're going to get here is full lifetime access to everything, including, again, there's a video course, lifetime member webinars twice a month. We give you a live actionable trade every single time. So if all you want is a couple trades a month, that's included. And of course, the indicator and scanner, which is also, of course, available on Metastock. We also throw in a cheat sheet as well. Just to quickly show you, some of the people are saying, Dave, for example, said that if you follow the rules that Serge lays out, you can make good, steady income. You can see Jim, great indicator, great strategy. It's my bread and butter strategy, and so on and so forth. I think what I've shown you here so far it probably is pretty self-explanatory. You can see that it works. Who's it not for, real quick? I think for people who are in the market largely for entertainment purposes, this is probably not for them. But I think, if you're serious about making money in the markets, if you can see the point of using a strategy that puts the odds in our favor, where we don't have to be correct all the time in terms of our timing, directionality, and magnitude of the move, this could really be something that could make a huge difference. And so the strategy is all about putting the odds in our favor. The way it breaks down is as follows. If we were to look at this offer just through the course, the video courses, that would be $199. The live market scanning sessions, those are twice a month, every month, live, and we give you a trade alert every time. They also get recorded, so one can get the trade alert within an hour or so as well. The indicator is yours to keep. That's $19.97, and we have a new Iron Condors module as well. That's there. The total package value is $2,693. We're going to make it available here today to you guys here at the MetaStock webinar for only $297. That's not a recurring fee. That's one time, and you're a lifetime member for $297. It's for the first 50 people. You can use PayPal. You can just go to thesteadytrader.com/meta. And I think the link is being typed in. I'll type it in here as well. But it's thesteadytrader.com/meta. When you go to that link, you can then go ahead and either use your credit card or you can choose PayPal as well right there on the page. Now, let me talk a bit more about the member webinars. You can also, by the way, call 401-203-7389. And if you have more questions, you want to talk to someone to order or anything else we can help you with regarding this, we'd be very happy to talk to you. Otherwise, it's thesteadytrader.com/meta. Again, it's $297. That is not a recurring fee. That's not a monthly fee, not an annual fee. It's literally lifetime. That's it. Indicator and scanner is yours to keep for life. You get access to our monthly webinars. We do twice every month. So if with the trade alerts, we give you in those webinars 2 every single month. And by the way, we have an 80% success rate with the trades we give people in the member webinars. That alone. So that alone, I think, is well worth $297 just one time for the rest for a lifetime access. Speaking of those member webinars we do, again, we do them every single month twice. The next one's coming up in early July. We just did one a couple days ago. So if you are joining right now and you want to go check that one out, I'll just quickly show you this. When you get to our members area, you click on indicators, and then what that's going to take you to is this page where you get access to the Vertical X Pro indicator. You can install it there and on different platforms, including, of course, MetaStock. And if you want to watch the past member webinar recordings, we just literally did one last Friday. There's a trade we offered there. Go ahead and check that one out. And then we'll see you also in the next member webinar coming up. Now, as I said before, the indicator and the strategy works for swing trading with the credit spreads. We use this for day trading as well. So if you are a day trader and you like to use this indicator for whether it's for equities, ETFs, or futures, I use it a lot on futures, but also certainly in equities. I showed you the chart of Zoom there a few minutes ago. So it really works on all those different time frames. And the point, particularly for the swing trading bar, for the credit spread, is to put on trades that give us less need to be directionally correct and generate over time a steadier stream of positive returns. So you can get all that at thesteadytrader.com/meta, and or you can call 401-203-7389, and our guys would be happy to talk to you about that. So I hope this has been helpful to give you a bit of a different perspective of and I think a much higher probability kind of trade setup than directional trades. Again, everything that you get access to at the offer here is for life. There's no recurring fee. You never pay anything again. It's just $297. You get full access with the indicator, the scanners, which of course also work on MetaStock, as we talked about and showed you in the charts, and the lifetime webinars. Again, in those webinars we do every month twice, you get a trade alert every single time in the webinar, and it also gets sent out. So if you can't make it live to the webinar, which of course I fully understand, it gets sent to you right away, and you can still do the trade if you like to do it. So that's it, Jeff. I know a few minutes early, but I thought I'd pass it back to you, and I'm happy to address any more questions in the meantime. Otherwise, it's thesteadytrader.com/meta, or again, the phone number, I'll put it up again, is 401-203-7389.
Cool. And I did type both of those in the chat. Let me actually add it to the YouTube chat real quick. 401-203-7389. 389.
Mm-hmm.
All right, there we go. It's on there. All right, Serge. Thanks. Not a lot of questions that you didn't cover. Lori wants to say thank you. Great job.
Thank you.
Appreciate it. All right.
Awesome.
Let me go ahead and you can let me go ahead and say thanks for coming in. Appreciate it, and look forward to seeing you pretty soon.
Thank you, Jeffrey. I appreciate it. See you guys.
All right. Thanks, Serge.
You well.
Okay, let me go ahead and do this. All right. Cool. Oh, I should make myself the presenter and share my screen. Hold on just a sec. All right, very good. So that isn't that particular product. If you want to take advantage of that, you want to go to the studytrader.com/meta. The code works great. The scanning works great. It's a great methodology. It isn't exactly part of the Summit Traders Action Pack, but maybe next time. And we do appreciate Serge and all he does. Great job with that. The Summit Action Pack, though, will include the Go No Go Complete, the CPS 2.0, 3 months of Guy Cohen's OVI Trader, Silas Peters' 3S Code, who's coming up right after I am, and then Unleash the Power of Metastock, the workbook and videos. Normally, if you bought all of those separately, the cost here today would be $3,630. As part of the special that we're running for the Summer Summit, you'll get it for $1,641, and that is basically more than half off. So you can take advantage of that at metastock.com/summit deal. You can give us a call at 800-882-3040, or you can visit us online at metastock.com/saleschat. So I hope you guys are doing well. Let me know. I do have both of the questions up. So if you have questions as we go through the next hour, let me know. I'll be watching them. I'll be asking for feedback. And if you guys have a charts that you particularly want to look at, I don't like to come in with a lot of kind of pre-packaged charts and stuff like that. If there's a specific chart that you want to look at as we do the class next, just type in the symbol and we can go with that. So in any case, before we get started with me, again, thank you for CMT Association for sponsoring the events. They've been sponsoring all of the events since November. CMTassociation.org, or you can call them at 646-652-3300. Whether you are an individual retail trader or an institutional trader, it's a great, they offer great courses and some really, really good accreditation programs that could help you if you are doing it for a career or for a living, well, even if you're doing it for yourself, take your trading to the next level. So, and they're not talking, or Tyler's not talking about CMT Association today, but it's really eye-opening how much getting a CMT accreditation can actually help, particularly if you're doing it as a career. So, of course, we're Metastock. I'm going to talk about Metastock here for about an hour. Basically, we'll get into that, but it's been rated number 1 29 years in a row as the top software for helping you trade. And I'm going to show you some of the reasons for that right here up in the next coming up session. So we are offering an extended trial of Metastock. You can do that at metastock.com/tradersummit 3-for-1. You can, of course, do that as part of the courses here. And I'll talk more about that. So my name is Jeff Gibby. Here's my picture from high school. We only use high school pictures here. But let me, before we kind of get started, I want to kind of just remind you that today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock shall have no liability for any investment decisions based on the use of the software or any trading strategies or any information provided in connection with the company. Thanks, Lori. Appreciate that. If you guys, again, if you guys do have questions as we go, let me know. My name is Jeff Gibby. I've been kind of running the event today. I hope you've been enjoying it. I think all of the presenters have done a fantastic job, and I really, really appreciate that. I hope you guys agree. Some of these guys I've learned so much for over the years of working for Metastock, which, just to kind of give you a little bit of background on me, this year back in March, I celebrated my 25th year anniversary at Metastock, and it's a great company to work for. One of the things that I love is the software. I use it every day to trade. I love to run scans. I love to kind of go in, and for me, I generally feel like sometimes I'm super busy at work and just don't have time to look at the market. But I generally, as long as I can kind of get 15 minutes before the close, I can check my positions, I can run my explorations, I can find those trade setups that I want to do. And I can only do that because Metastock's got such a great scanning engine. It's so well designed. So it's been a great company to work for. When I started, just to kind of give you some context, I started in inside sales. So if you had questions about the software and things like that, there's probably 1 in 6 or 7 chances back then. If you called, you'd be talking to me and I'd be talking to you about like your trading and what you're looking to improve. I love that. I did it, like I said, for about 10 years. After that, I moved over to BD. One of the first person that I made a partnership with, Steve Bigelow. But all of the people that we've talked today, I've worked with over the course of the last couple of years. And, you know, actually just even traveling around with Steve as a good example has allowed me, I'm going to go ahead and take this out. I don't need to wear that right now. Lori, my last name is Gibby. It's like Gibson, but just a little bit shorter, Gibby. So there you go. Actually, very, very similar to your last name, just a few letters off. So, but in any case, after that, I've been doing that. They've expanded my responsibilities to include all of our US-based partners. I do most of our events, and I'm also in charge of our sales team. So in any case, Metastock, when I started, we were owned by Reuters, who then became Thomson Reuters. And we still have a really good partnership with Reuters, but we bought ourselves back from Reuters. Now it's Refinitiv. We bought ourselves back in 2013. So this year we've been an independently owned company for about 9 years now. And but we still have a good relationship with Reuters. I know a lot of you are from India and have been kind of asking about Indian stocks. One of the things that's been very beneficial for us over the years, or for me over the years, is we can go pretty much anywhere in the world. I've done kind of the same demo or the same kind of class I'm going to give you today. I've done it in London, India, and Australia, and Saudi Arabia. And one of the things that's been really, really helpful is we get a lot of really good data from Refinitiv. Refinitiv, if you're not familiar with them, they're a competitor to Bloomberg. They deliver literally institutional quality data, news, and information literally used by brokers and institutions. And but anything I show you today, we can scan any markets that you might be interested in. If you're in London, you want to look at London stocks, you can use Metastock in London. You can do it in India. You can do it in Australia. Just about there. With Reuters, the amount of data that they cover is like 200 plus exchanges. Some of the best news information that's available. A couple 100,000 instruments. Just about anything you want. So there you go. All right, let's go ahead. That's the only other thing I'm going to say. Actually, I need to update this side. It's 29 years in a row. We're grateful. One of the things I'm very, very proud of is for the last 29 years in a row, Metastock's been rated #1 in this price category. 29 years straight. And, you know, it's funny because over the years, we've seen a lot of software come, a lot of software go. And it's really, one of the things about Metastock is all the things that are included in the systems and things like that. It is literally a program that we've been developing for decades now. One of the things that I say, there's a lot of stuff in there. Like if you start up with a Metastock subscription for the first time today, it's complex enough that we'll actually have somebody sit down with you and make sure that everything's installed and walk you through how to scan, how to test trading ideas, and how to do some of the things that we're doing here. And it is a very, very mature program, unlike a lot of the competitors that we have. But one of the other things that I'd add to that is it's not a product that you're going to grow out of. As you learn more and more about technical analysis, the better Metastock's going to work for you. If there's other things that you want to implement or indicators, you know, it's going to work better with you. So we're very, very proud of that. 29 years in a row, it's been rated #1 in its price category. So in any case, today, what I want to talk about is, of course, with Metastock, we are built around trading ideas and trading plans. And I want to talk a little bit about the importance of trading plans, no more than a few minutes. I'm going to actually teach you how the MACD works and how to use it and how to get buy and sell signals. And then we'll test it. We'll test it against some of the other methodologies that are built into Metastock, and I'll even show you how scanning works. So the reason I do MACD is because it's a very popular indicator. In fact, how to use MACD is one of our more popular videos on YouTube. So one of the things that's been surprising to me is like with MACD, it's very, very simple indicator. We're going to go through kind of the nuts and bolts of it. A lot of people use MACD, but not a lot of people understand how it's calculated, kind of some of the different ways you can use it, et cetera, et cetera, et cetera. So anyway, there's where we're going today. Again, if you guys have questions as we go today, post them. I've got the YouTube comments up. I've got the GoToWebinar comments up, and I'll be happy to kind of do my best to at least answer your questions while you're here. Okay. All right. Very good. Let's go ahead and get started then. We're only going to talk for a minute about trading plans, but I do think it's important. And the guy on the screen here is Richard Dennis. I'm going to talk about him in a little bit, but you can look at a trading plan as very much a business plan, you know. And if you were going to, go ahead and start like a business, and that's kind of what you wanted to do, you'd probably kind of get a pretty good idea of what you were going to do with your business. Like what's your product going to be? What's your overhead going to be? What are your costs? How much are you paying for employees? You know, you probably spend a lot of time actually preparing. This is exactly what my business plan is. You'd know what your upside potential is. You'd know what your risks are. You'd have a pretty good understanding of what you wanted to do. Likewise, to kind of mix another metaphor in there, if you're going to build a house, you're going to have full-on blueprints, and you're going to have a really clear understanding of how you wanted to build your house. In other words, you're not going to just take your advice from Uncle Bobby who says, hey, you really should put a bathroom in there or something like that. You're probably going to put a little bit of thought in that before you go in there. And so what surprises me over the years is how many people will just go in and start trading with no idea of how they're going to trade, no idea of where they're going to enter a stock or exit a stock, or they're going to buy and pray, maybe, you know, but or maybe they're going to take advice from like the Redditors on Wall Street Bets or something along those lines. And sometimes that does work out. But generally speaking, when you go into business, you should take it really, really seriously. And one of the things that you can do with technical analysis is you should know why you're trading. You should be able to know when you're getting in. You should be able to know when you're getting out. So let's get back to Richard Dennis. I'm going to try and not meander too much today. But Richard Dennis was a famous technician and trader, very, very successful back in the 80s and the late 70s, I believe. He had generally, and I'm just trying to remember the numbers. I usually write them down before I get started, but generally he started with like a very small amount of money and grew it to a huge amount of money. He had a business partner at the time. His name, Richard Dennis and Bill Eckhart. I had to say them together. Otherwise, I don't remember. But Richard was like, really, really felt like he could teach people how to do what he was doing. His partner, though, Bill Eckhart, said, no. Generally, you can't teach trading. It requires a special risk aptitude. Generally, people wouldn't be able to follow the rules. And as part of this, like they had one of the most famous experiments in history. They did basically the turtle traders, if you've heard of it. Basically, they pulled a bunch of money together. They put out some advertisements, and they ended up recruiting some traders. And they brought them in, and they spent a couple of weeks training them on how to trade. They funded them. They gave everybody between, I think it was $250,000 and $3 million. And if you want details on this story, go to Investopedia.com and just search for turtle traders. But they basically were not successful at this endeavor at all. They were extremely successful. They were able to grow their account and become very, very successful over the next 3 or 4 or 5 years. So, and one of the quotes, you've probably read it, Richard Dennis said, I always say you could publish my rules in a newspaper and no one would follow them. The key to trading is consistency and it's discipline. So I have a question for you guys. I'm going to let you guys answer this question. What do you guys think is the best profession to start with if you want to go into trading? In other words, if you're currently a teacher, is that the best one? maybe it's a doctor, maybe it's a psychologist. What do you think, Lori, Richard, some of you guys that are in here today? What do you guys think is the best profession for trading? I'm curious, and I'll let you answer that real quick as we kind of get going here. So over here in YouTube, it looks like somebody says a psychologist. That's an interesting answer. Lawrence guessed immediately the correct answer. So I don't know if you knew that already or not. Engineer. No, that's not actually the exact right answer. Psychologist is an interesting one. You know, we've worked with a good friend of mine is Jake Bernstein, and he did a lot of psychology work, and then he now traded and trades. So Richard says teacher. Teacher is a good guess. That's one we get. Lori says the best profession to start with trading. And I'm just going to answer somebody who can follow a checklist. Lawrence, you had the right answer. It's an airline pilot. So there you go. And you had even the right reason. And I'm going to go ahead and just send this to the whole group. Someone who can follow a checklist, including a nuclear generator. So, and actually that's kind of interesting too, because let's see, Chuck Hughes, we did an add-on with him a few years ago, and he was an airline pilot too. Greg Morris did a candlestick pattern add-on with us, a good friend of mine out of Georgia. I was going to say Atlanta, but I don't think it's Atlanta, but it is the greater Georgia area. And he was actually a fighter pilot. He went on to kind of manage 19-point-something billion for Stadium Money Management. Great technician. And the reason, and you actually kind of stole, you kind of nailed it right on the head. The reason I believe that airline pilot is such a good profession is because they have a checklist. They have a checklist. They have a lot of discipline, right? When they're taking off, they want to make sure that they follow the checklist. If they're landing, they have a checklist. If there's an emergency, they have a checklist. And they have a very, very disciplined approach to trading. And I believe that's why it is fighter pilot. I do believe that trading discipline is important. Seen it time and time again. Hopefully it hasn't happened to you where you bought a stock, it went against you. That happens to me all the time. But hopefully you knew when to get out and didn't hold on to that and aren't still holding it or whatever, right? So in any case, discipline is important, especially right now when the market's a little bit rough, a little bit more sideways than it's been. It's more important than ever to have good stops. Understand why you're getting into a trade. Understand where that is. There's a lot of opportunity that exists in these markets, and as you know, they can also be a lot more volatile and a lot more choppy. So it's important to have discipline. Okay. In case you don't know who this gentleman that's been staring at you for a few minutes, his name is Gerald Appel, and he's the inventor of the MACD. Gerald created the MACD. I'm going to show you how the MACD is calculated. I'm going to do that in Metastock. If you have any stocks you want to look at, you can just type them in. Well, I'll take the very first one in terms of showing you the MACD on that chart. So, but hurry, I'm going to go ahead and go into Metastock. So the MACD, as we said, or as I said, it's a trend and it's a momentum indicator. So it'll help you identify what the trend of a stock is using the signal line and the MACD value. It'll also help you measure momentum. And my goal here is to kind of give you a thorough idea of how that works. Okay. If anything, I just hope you learn how the MACD works in a couple of different ways you can analyze it. Lori, you got it. It's going to be Apple. Okay. So let's go ahead and go into Metastock real quick. And I've got Amazon up. I'm going to go ahead and do Apple. Let's go ahead and do that. And we'll go ahead and load that up. Here we've got a chart of Apple. This is a daily chart. I'm going to go ahead and just add a couple of indicators to it. The first one I'm going to do is the MACD, and then I'm going to add a couple of moving averages. So let's go ahead and use the new MACD histogram indicator, which is right there. It's going to add both the lines that Gerald Appel actually used, as well as the oscillator underneath it that Cynthia Case actually popularized. Actually, I don't think it was. That's the wrong name. I can't remember who it is offhand that popularized the MACD histogram, but it wasn't Cynthia Case, although she's great too. Okay, I'm going to actually add a couple moving averages to this as well. Now, when Gerald designed this, he actually didn't use whole number exponential moving averages, but 12 exponential and 26 exponential are very, very close. So I'm going to go ahead and add those to the chart, and I'm going to make them a little bit thicker so you can just see them on the chart. Okay, and then we'll zoom in a little bit so we can kind of really focus on kind of what's going on. Right here, what I'm doing is this is the indicator quick list. So if I was to scroll down here, there's a few hundred indicators that are available, and it's just a drag and drop operation. So I'm just going to find the moving average. You go ahead and since it is one of the more recently used indicators, it's put on the top for me. And what I'm going to do is I'm just going to drag that, and I can drop this on the chart. It'll just plot where you would expect it to do. And I'm going to do this as a 26-period exponential moving average. Okay. Now, I wanted to make that a little bit thicker as well. So what I'm going to do is I'm just going to double click on it, and I'm just going to thicken it up. I want you to be able to see what we're talking about here. Okay. So we'll go ahead and apply that. And then I'm going to, in the interest of letting you see what we're talking about as well, I'm going to zoom in a little bit on this chart until I'm kind of just happy with kind of the way that it's looking. What I'm looking here for, just too, is I want to see a bit of an uptrend. We have a bit of a sideways channel, and we have a bit of a downtrend. So this is perfect. This is exactly kind of a view that can allow me to talk about exactly what we're doing. Now, if I wanted to, and I'm actually going to color code these lines, I'm going to take the shorter one, and I'm going to make it blue. So I can refer to it as the blue line and the red line. So, but if I wanted to figure out a MACD, if I wanted to calculate a MACD, the way Gerald Appel actually kind of calculated it, he'll take a shorter term moving average, in this case it's the 12-period exponential, and subtract it from a longer period, the 26-period exponential moving average. Okay, and that's it. So when you're looking at the MACD value, which is this red line, you're just looking at the difference between a shorter term moving average and a longer term moving average, and that's it. Okay. So if we were to take this, the blue line, and subtract it from the red line, we'd have a negative value, and that negative value would be the value of this red line. That's all. You're just comparing two moving averages, a shorter term and a longer term moving average. So Lori asked what, Lori, you've had a lot of great questions. Thank you for all of the questions. What determines the average? So with the way Gerald did actually now, but he, if you kind of look into the help files, and it kind of goes beyond the extent of what we're going to talk about today, but he used an exponential moving average that was a 0.87 and I think a 0.13, but I could be wrong on those. It is in the help file, but those are just the ones that he chose. If you wanted to use your own, you could. You'd, in that case, there's actually a price percent oscillator that you would apply. But the person that determined the moving averages, to make it a short answer, was Gerald Appel. Okay. Okay. And I need to move this a little bit just to see if there's any YouTube questions, which there are not. Okay. So now, if we just wanted to talk a little bit about kind of what that means, since we're looking at the difference between a shorter and a longer term moving average. Well, if we're in an uptrend, right here, as we are, well, let's just draw like a little bit of a trend line here, right? In this area, we're kind of in for the most part, a huge uptrend. There's a bit of a pullback here, but during this uptrend, if we're kind of in a nice uptrend, the value of your shorter term moving average is going to be above the value of your longer term moving average, which is basically, so you're gonna have a positive MACD value when it's going up, okay? If it's going down like it has been recently with just about everything, you're gonna notice that you're gonna have a negative because it's going down, okay? And so that's how we kind of look at it in relationship to momentum. If we have a nice big positive up move like we had right here, you're gonna have a nice positive MACD value. If you have sideways areas like this area right here was pretty sideways compared to kind of this uptrend, and this, you're going to have a much shallower MACD, okay? And then if you have a downtrend, obviously you're going to have more negative MACD values, okay? Now the first thing I want to talk about, so that's just the red line. We've only talked about the red line right now. The dotted blue line is what Gerald called the signal line, okay? And what he would say, okay, and what I'm going to do is I'm actually going to attach an expert advisor to Metastock to kind of help me explain what we're looking at with that. So right here, this tool right here is the Expert Advisor. There's a couple hundred different methodologies that are already built into Metastock. You'll see MACD is one of them. There's also like ones that talk about candlesticks and stochastics and trend analysis. You'll see right there. There's literally a couple hundred different what we call expert advisors. I'm just going to attach the MACD by Metastock here. You go ahead and click on close. And what's going to happen is you'll be able to see right here at the bottom, when the MACD starts to go above its signal line, right here it went above its signal line. And to make that really clear where that happened, right here, it went from down below its signal line to up above its signal line, right there. You'll see that it's actually telling you that the MACD is bullish, okay? When it went back down below its signal line, as you can see right here, okay, the MACD then became bearish, okay? Right here, while it's trading below its signal line, okay, right here it's trading above its signal line, right here it drops down, it goes into a bearish phase. So the first way, oh, wait, before I say that either, the third line, so you've got the signal line, or you've got the MACD, which is the red line here. You've got the signal line here. Oh, it's Linda Radke. You've got the signal line here, which is just a 9-period exponential moving average of the MACD. So an exponential moving average of the difference. It's called the signal line. The final line is actually just the difference between these plotted as a histogram. So Linda Radke, not Cynthia Case, Linda Radke is the person that popularized that. And so if you're looking at the blue line, it's just the difference between the two MACD values, and that's all. Okay. So the first way you can look at MACD is where is it trading in conjunction with its signal line, okay? And if we're trading off of that, you'll notice right here, okay, right here we're trading down below our signal line. Here it pops up above it. We go from a bearish phase in Apple. I'm going to zoom in a little bit more so you can see this a bit better, okay? You go from a bearish phase in Apple to a bullish phase, bearish, bullish, okay? If we're trading based on that, we could take a long position, okay? And that's why it's giving you a buy signal. That's the first way you can look at MACD, okay? Right here, when it crossed down below its signal line, you got a sell signal. It went from a bullish to a bearish phase. You could go short here. That's why it's giving you a sell signal on here, okay? And this one was actually probably the best trade on here, okay? When it crosses back above, you get a buy signal. When it crosses down below, you get a sell signal. And when it just recently crossed above right here, and that's why you got a sell signal on the chart. So that particular method, the only thing you're looking at is where is the MACD in conjunction with its signal line, okay? If the MACD is trading above its signal line, you're going to have a bullish phase, and the MACD will be bullish. So that's how you look at it to read trend, okay? If you anticipate that Apple's going to go up, you could buy here, and you can sell here. You would have made a little bit of money between this buy signal and this sell signal. You would have made a little bit more from this sell signal to this buy signal. That was a really good drop. Here you would have probably lost a little bit of money, and here you would have bought something, okay? And these are all based on the trend. You know, we're not trying to determine if, I don't know, the EU just made Apple go to USB-C, right? And so now that they can't produce their lightning cord in Europe, and is that going to affect their revenue? We're not looking at stuff like that, right? Or maybe, I don't know. But what we're looking at is what is the direction of the trend, okay? And we're trading in the direction of the trend. In this case, we're buying because we have a buy signal on MACD, and we anticipate the price is going to go up. It doesn't always. There are here's a trade we would have lost a little money on. Here's one we would have made a little bit of money on so far, right? But that's how we're looking at it. So that's the first way. Just looking for some questions. It doesn't look like it. Hopefully I'm being clear here. My goal is for clarity above everything else. The second way you can use MACD, so the first is just what is the trend of the MACD? What's it telling you? The second way that you can look at MACD is as an overbought or oversold oscillator. And what I would like to do is actually see if we have any kind of examples of this getting into an overbought or an oversold condition on the chart. And in order to see that, I'm actually just going to real quickly change the colors to just black, so I can kind of see any highlights a little bit clearer from a zoomed out area. So right here you had a little bit of a green area. Here you had a bit of a green area. I'm going to go ahead and scroll back into this. And you notice how right here, there's about 3 bars right here that are just still highlighted green. Okay, we had 3 of them right here as well. And if we go back in time far enough, there will be some red ones. What this is actually denoting to you is overbought, oversold condition. Okay, and let me go ahead and open what we call the expert advisor commentary to kind of give you an idea of how that works. So I just remembered that, okay, this, I think we're on the very last bar. I just remembered that this wasn't working exactly the way that I was anticipating earlier. But let's see if I can kind of get, so that's 627. There should be an arrow. I'm missing my arrow, but they just did a bit of a reinstall of everything, and I think that I'm not moving it, so it's always looking at this current bar. Okay, so that's okay. There's just something a little bit fishy about it, so that happens sometimes. I'll have to get support in here to help me with it. So, but right here we have the overbought, oversold indications. Basically, what it's saying here is we've reached a period. These green bars means that it's oversold. Now, what I like to show the commentary is I think it does a really good job of talking about oversold. And what it says, to paraphrase, is with an oversold condition, what you want to watch for is you want to watch for a confirmation. As we know, we just went through 2021 and 2022, and you know that just because something gets overbought doesn't mean that that trend's just going to keep going up, right? It might keep going. One of my favorite sayings in the markets is the market can be wrong for longer than you can afford to be solvent. Just because something's overbought or oversold by an indicator doesn't mean it's going to not just keep continuing on that trend, and you should always pay attention to that trend. So the way the expert advisor reads is, okay, there's a current, if we looked at this particular day, it would say there's a current overbought, oversold condition that exists on the chart. You should wait for an additional confirmation before you trade based on it. But you'll notice we had an overbought condition here. It lasted for about 3 days. Your confirmation could very well be that buy signal. So the second way, and here we had another overbought. It popped back up, but then it stayed back in that bearish trend. If we go back a little bit here, there was a time where it was oversold. We can be able to see that. You'll see that it got a little bit oversold here, got a little bit oversold there. And when it reaches those oversold conditions, it's actually going to alert you by putting the red highlights or the red markers on the chart. So the second way that you can look at MACD is it overbought or is it oversold? So the first is looking at the trend, whether it's bullish or bearish. The second is looking to see if it's overbought or oversold. Okay. Lori had a question about how candlesticks are constructed, and I will answer that real quick without trying to get too deep into the woods. So let me go ahead and zoom back in here. If you want to, let me go ahead and zoom back in here. Okay. Okay. Wanted to know what the black candlesticks meant. Well, so when they're not color coded by something else, they're just going to be black. Okay, apply. Generally, a black candlestick, I've actually put this in kind of the way the classic Japanese would look at the things. Typically, a black candlestick means the close was below the open. So right now we have a down day when compared to the open. Okay, let me just zoom here. If the close is above the open, so right here, yesterday, Friday, Thursday, we all had hollow days, and that just signifies that the close, it opened and closed higher. If it's a black day, it opened high and closed lower. So that's all it means. Hopefully that helps, Larry. There is a really good candlestick expert in MetaStock that I'd recommend that you play with. It actually kind of identify a lot of the patterns on the chart for you. So, but the third thing that the third way that I'm going to teach you to look at candlesticks is what Dr. Alexander Elder calls the most powerful signal in all of technical analysis. And MetaStock will look to detect this on a chart for you. What I want to do is kind of just illustrate this with the use of a couple of trend lines. So right here, I'm going to draw a trend line here. Oh, grab the trend line tool. And what I'm going to do is I'm going to go from right here to right here. Okay, the bottom with Alex, he's very, very specific about what he wants to look for. We want to cross above 0, and we're doing the troughs. So we go from this trough to this trough, and you'll notice that there's just a little bit of an upward bias here. Okay, just a little bit between this trough and this trough. The angle of this line looks like it's going up just a little bit. Okay, if I look at the corresponding trough to trough action on here, here's a low point in price. Right here's the other low point in price, and what you can see is like this one looks like it's going up a little bit, and this one looks like it's going down. Okay, now looking at the actual values on this, I'm going to say that it actually is, they're both going down a little bit because this is saying it's minus 29.17%, and this is saying it's minus 2.68. So this one looks a lot more horizontal, but it's definitely not poking up. Okay, this one is definitely headed down. If we had a condition where you had this crossover and this was pointing up, let me just make a little change to my settings right here real quick. I don't want it to snap. I just want it so I can basically show you what's going on. If we had something like this where there was definitely a move up while the price is going down, this is what Alex would call breaking the back of the bears. It's a MACD divergence. He calls it one of the most powerful signals in all of technical analysis. And what it just signifies is the bears are running out of steam. Okay, we don't quite have that set up. We're pretty close though. In fact, if I kind of look at it right here from this low, yeah, it's still showing a bit of a lower value. But that's basically what he would call a MACD divergence, or the most powerful signal in all of technical analysis. So if I was looking at Apple today, and again, this isn't a recommendation to buy or sell, but there are a few things that kind of would make me feel like this is a pretty good signal. You had the overbought that's confirmed a few days later by the buy signal. You've got kind of maybe a mini MACD divergence. So Lori says, I'm used to seeing red or green candlesticks. Does color really matter? No, it's personal preference. Actually, the default, what I wanted to be able to show you, the reason I changed it to black and white was so I could show you where these were overbought or oversold. But you can set them up any way you want to, Lori. Thank you for that question. All right. Okay, so those are the 3 ways. Okay. How are we doing on time? We're doing all right. So the first one, just to kind of reiterate, is MACD with its signal line. Is the MACD bullish or bearish? The second one is overbought or oversold in Metastock. That's indicated by these green colors. And then the third one is MACD divergence, with which Dr. Alex's book was called Come Into My Trading Room. And he's such a smart technician. I would recommend you read that book if you haven't already. I highly recommend it. In any case, so those are the 3 methods. With our expert commentary, I'm going to go ahead and open that up again and just kind of show it to you. It's going to show you whether it's bullish or bearish, right? Oh, well, it did actually end up moving to the 22nd. Let's move it back to the end. So right now it's pinned at the very end of the chart. Okay. Right now it's bullish since it's trading above its signal line. I did that for 2 days and it's up 2.5%. Okay. Right now it's not overbought or oversold. And there's not been any divergent signals within the last 5 days. So there you go. That's my MACD class. You're welcome. Now I hope that's helpful for you. Maybe you learned something. Maybe that was just a really a refresher. One of the questions that I get, and with Metastock, over the years, and I've been working here for decades, is it's really easy to kind of talk about what's included with Metastock. It includes a lot. There's a few hundred indicators. There's a few hundred different trading methodologies that you can use. There's scanning. But one of the questions I would get, there's 8 different charting styles. One of the questions I would get over the years from customers is like, I don't know how to use 300 different indicators. We just spent 36 minutes talking about MACD only, right? And the question that we get from a lot, and I told you the reason I use MACD, it's a good indicator, but everybody uses it and they don't really know how it's been calculated or what they're looking for. But a question that I'd get a lot is like, okay, well, if there's a couple hundred methods that are built into Metastock, how can I understand what works well with Apple? Do I want to spend 35 minutes learning about 300 different methods? right? Or how do I actually understand what works? And because all of this is built on objective and not subjective information, it's testable. So if I wanted to actually take every signal on this chart, if I bought here, let's say that we got in on this open, 163, and we sold out on this open, which is 168, we'd be up 5 points. We can figure that out, right? Let's say that we also went short here at 168, and we bought back down here at, let's say, 150. We're up 18 points on that trade, plus the other 5, we're up 23 points, right? And I can very, very objectively go back, and looking at this, I can see where my buy signals are, my sell signals are. I can see when I lost money, how much those losses look like, how many of those were in a row. And because it's objective, I can do that just by looking at the chart. Okay. The other, since it's also objective, I can also have Metastock say, what's the best method? How does MACD work? And before I spend another 40 minutes teaching you about another indicator, which I don't have 40 minutes, I can actually just test it, right? And I can go, okay, and let's just run a test because I am actually needing to move a little quicker. So right here in Metastock, I'm going to open up what we call Power Console. You've got charts. This is just a quote window. You've got a scanner, which I'm going to show you real quickly. We ran some scans earlier this morning. Right here is our system tester, and this is where we're going to go to. Okay, and I just realized I don't have a huge amount of built-in, well, actually, I do have favorites. Okay, we have a forecaster. This is an option viewer. These are all very cool. Obviously, I have to stay in time, and I could spend weeks talking about the tools that are in Metastock. But what I'm going to do real quick is actually start a simulation. So I've got 27 systems that are in here. I'm going to actually go in and select some more. So what I'm going to do here is just come up over here. I'm going to go to PS. I'm going to search for PS. I'm going to select all of these systems. Okay. And the reason, actually, let me go ahead and do this real quick. I'm going to go, hold on just a second. Okay, let me go ahead, try again. PS. Okay. The reason I'm just selecting the performance systems is there's about 81 of them in Metastock. And I want to just be able to select those. I know they're all built into Metastock. And I know for the most part that they do not include a lot of indicator optimization. I'm also going to grab the ACT systems, which are some systems that are included based on the work of John Ehlers. So what I'm going to show you today is we're going to take these 87 methodologies. We're going to test them against Apple, Tesla, IBM. We'll go ahead and throw in Dow and S&P. But I'm just going to test those against 4 or 5 stocks right now. So I want to say, okay, based on these 87 different sets of buy and sell signals, what I want to understand is what is the best performing methodologies. Okay. For trading, I'm going to take long trades. I'm going to take short trades. So I'm going to do both long and short trades. Okay. I'm going to go back about 500 days because I'm doing daily. I'm going about 500 records, which is just short of 2 years. Okay. Now with the data that we get from Refinitiv, you can go back to the 80s. If you're doing stocks, if you're doing futures, you can go to the 70s. But just for the purpose of running this test real quick and showing you kind of what the results look like, I'm just going to do the last 2 years. So let me go ahead and click on, in terms of trade options, I'm going to start with, it looks like I'm going to start with 50,000. In terms of trading, I could say, okay, I want to trade 20 shares at a time. That would be right there. Okay, I want to trade based on a transaction cost of, let's say, $2,000. Or what I can do is I can do percent of available equity. I'm going to do that. I'll take half of my trading equity and buy. And when I sell, I'm going to take half of my trading equity. And just because the math's a little bit easier for me, I'm going to start with $10,000. So my first trade is always going to be $5,000. If I grow my account to 20,000, when it trades, it's going to trade half of that $20,000. It's going to be 10,000. Okay. In terms of broker, I'm not going to put any points. You can add points if you're still paying commissions. In terms of trade execution, I'm going to have it tried on the open of the following bar. So that's kind of the way that I've got the system set up. You can go ahead and start the system test. And while we wait, it's going to run 435 simulations. So if you pay attention right here, right now it's doing a Shande forecast oscillator. It's doing cycle projection. It's going to do a Bollinger Band system. It's going to do momentum, pattern trading systems, all kinds of methodologies that come in the program. Now, what I'm trying to answer is, what are these methodologies? If I want to trade Apple, what works best on Apple? If I want to trade IBM, what works best on IBM? Obviously, I want stuff that's going to be profitable. So this is the way a system test report would look like. And what I'm going to do is I'm going to sort this based on the average net profit. So out of those basket that I gave it Apple and IBM and I think Microsoft, whatever. I typed in a bunch of symbols, you saw me. Out of those, these green systems are systems that produced a positive return, and these red ones produced a negative return. So if I want to focus on what works well in the market, I want to focus on what works best, right? So if I'm looking at this, the best performing system comes up on this list a lot. It's the PS pattern trading system #1, okay? On average, because there's more than one stock in the basket that I test, it made about 18%, okay? Its best performing was 2600, so about 26%. The worst profit was 0, so it actually did pretty well when it didn't trade. It made $0 instead of losing money, okay? Average trades, it on average traded about 51 times. So looking at that from about 2-year perspective, that's about 26 trades, about 26, 25 and a half trades per year, or about 2 a month. Yeah, about 2 a month, 2 trades a month, okay? On average, for every winning trade we have, our average winning trade was 31.8, our average loser was 19.6. The average profit versus average loss was 1.0. Okay. And when I talk about this, I talk about it as finding something that you're comfortable with. And I don't use it, I would never recommend that you use this as a way to bypass your education. In other words, if I want to start trading the fractal trading system, well, we're going to go figure out what's involved in the trading system. We're going to go look a little bit closer. But this allows me to focus on what that system is doing, which is very, very helpful. Okay. On the next performing system was the PS volatility stop. It made about 15%, which is a little bit underperforming the average percent gain of the pattern trading system #1. Its best performing profit was made about $6,000. Its worst performing was about $680, but it only traded 15 times over 2 years. So I'd say that's probably about a trade every other month or so, roughly. It's about 15 trades, 2 years. Yeah, a little bit more than one every other month. Okay, its average profit versus average loss was 10.6 versus 5.2. It actually lost more money on its average profit, but it had more winners. Okay, so what I kind of evaluate here is how often are we trading? Are you like me where you want to be able to kind of make all your decisions and not be in too many positions at once because you can't follow it during the day? If so, this might be a better system for you to use. The stochastic oscillator, you can kind of get an idea. I've traded about 56 times over the last bit of time. Once I kind of look at it from this view, let's say we want to kind of look at it a little bit closer because there's more than one stock in there, right? What I'm going to do is I'm going to actually click on view right here, okay? And what we're going to see here is kind of how those instruments actually performed using that system. So our best performing system using pattern trading system, the best performing stock was Apple. It did a very, very good job of helping us trade. 26% gain. It was the best performing, 62 trades. Our trade profit versus our trade loss, 38 winning trades, 24 losing trades. Average profit versus average loss was about 97 cents. Okay. I can drill in a little bit further. I really like those numbers. It trades a little bit more than what I'd want to. That's about 31 trades a year per instrument that you're interested in. But let's go ahead and take a look at it anyway, a little bit closer anyway. So our profit here was 26.3. Okay, that's an annualized performance of about 13.25. If we would have bought and held Apple for the course of that year, we'd actually be up about the same. So right now, it's actually underperforming buy and hold by just a little bit, -2%. Okay, our profit loss index is a measurement of how our total win versus our total loss. It goes from +100 to -100. Plus 100 is really good, -100 is catastrophic. 35 actually kind of sucks. I'd probably keep looking, okay? Reward risk is the same measurement. It goes from -100 to +100. but it measures open position profit versus open position loss, total potential risk versus total potential reward. Okay. If I wanted to kind of get an idea here, we had about 38 trades total. Our average profit on each of those trades was only about $197, while our highest one was about $650. Okay. Our total unprofitable trades, there was 24 of those, and we, like we knew we were going to, we actually outperformed on our losers compared to our winners. Okay. Most consecutive, I won 6 winning trades in a row in this backtest right here. Okay. Most consecutive losers, about 3. Okay. There's all kinds of other information. One of the things that's really helpful about Metastock is if you have any, we're obviously not going to go through all these numbers. It gets a little bit boring. But if you have any questions about how these are calculated or how you should read them, you can click on help, and it's going to give you basically all the metrics and what you're looking for all of these values. Our printed help file is actually, when we used to print it, it's about a 700-page manual. And it talks about all the indicators that are included with Metastock, how they're calculated. In fact, when I initially prepared this webinar, and it's been a few years, I've been talking about MACD for a while, I actually referred mostly to the help files to actually kind of tell you how it's calculated. Pulled it right out of there. So it's a great reference, and it'll tell you anything you need to know. The one thing I do want to look at before I actually kind of show this on a chart is the equity line. So right here, we had actually a pretty good equity line right until here. And we've actually been underperforming that lately, okay? And that makes sense. I know just because of what I'm about to show you that the PS pattern system is actually a long-only system. And based on that, we'd probably be underperforming since Apple started to go down, okay? We did have a bit of a pullback. Aside from this last little 6 months or a year, this has actually been performing pretty well. So if I want to learn about it, if I want to learn what indicators are in there, I'm going to go ahead and plot this on the chart. Okay. I'm going to go ahead and click on close. And what we're going to do is we can actually then see, this is that same equity graph that we saw before, but we can see where all the buy and sells came in. I'm going to actually just take that MACD sell signals off of the chart. So let me detach that real quick. You can see once I do that, I didn't do it. Expert properties. No. Expert advisor. Detach. Okay. You can see exactly where we would have bought, where we would have sold, et cetera, et cetera, et cetera. So right here, we would have taken a long position. Here we would have got out. Here we would have taken a long position. Here we would have gotten out. You can kind of see that on the chart, and it can kind of make sense for you. Okay. Now, remember, I don't want you to use this to skip your education. What we talked about the very, very first was discipline's important. Remember the airplane pilot. I think part of the reason that you can have a discipline in the market is if you understand why you're trading, you understand what your losses are going to look like, and you understand what indicators you're using. And by testing this, we know that it underperforms in a bearish market. We can see that. We would have right here with our equity curve, we went up to about 13.8, and now we're down to about 12.5. So we can see that on the chart. But if we understand why we're trading, I believe that's also going to help you with your discipline. So if I wanted to understand this system, this system that we tested was the PS pattern trading system #1. Okay. If I want to understand what rules are involved in that, I can attach the matching expert advisor. And remember, I said there's a ton of those expert advisors built into the program. So if I wanted to come in here, I'm going to go ahead and go into the expert advisor again, just like we did with MACD. And what I'm going to do is I'm going to come to the PS pattern trading system #1. Okay. I'm going to attach that to the chart. I'm going to go ahead and click on close. And it's going to show me, actually, we just got out of a long position today. That was an alert. The Metastock program will pop up an alert when you need to do something, when you attach the expert advisor to the chart. You notice that we were in a trade for a couple of days. That actually was a pretty good trade. Here we were in a trade that was pretty good. Here we lost. We've tested this. We know that it's going to work well over time. But I want to understand, and what I want you to understand is how it's kind of looking at the rules. So to do that, we're going to go back into that expert advisor commentary. So right here, I'm going to expert advisor. I'm going to go to commentary. There's the signal I've been waiting for. Now I can show you that this does move maybe. If we go back a little bit right here, you see right here that says enter a long position with a market on close order. That's because you got that buy signal. Okay. Now, let's talk a little bit about what this is. So this system is designed to use stocks and stock indexes. So we're not recommending using this with futures or ETFs or coins. It's primarily for stocks, and it's saying that straight up front. It relies on inherent upward bias typically seen in stocks and stock indexes. It follows the philosophy that any up movement becomes an enter long signal, and any down movement becomes a valid any down movement following a valid up movement becomes a valid exit signal. While this is an extremely fast system, it can be an extremely profitable one since the upward bias is already accounted for. It has no short positions. Okay, so and while it can be very good at capturing profits on a large number of trades, no real protection mechanism has been actually put into place to help you against stop trades. So you should use stop losses. So all of this is actually telling you basically like what this is looking for is it's looking for 2 upward days. It's going to buy. If after that you get a downward movement, it's going to go ahead and exit. It's a very, very fast system. It's also telling you that you should use a stop loss. Okay. Now, what I would recommend is if you like this system, go in and test it with a stop loss, because you can go in there and check mark the stops you want to use and actually say, okay, well, how does it perform if I use this stop and compare it to if I use this stop? And I would say that if you're going to be using stops, you should test them. And with Metastock, it's really, really easy to do. You just check mark the stops that you want to use. So there you go. There you go. All right. Let me go ahead and then the last thing that I want to show you before we kind of talk about the offer today is the scanner. If this is something that you like let's say you find a system that really, really works well for you and you want to find the signals. Obviously with Apple, we could get out of a trade, but obviously one of the things that I like to use is the scanner. So if I come in here to the Power Console again, I'm going to go basically to the scan options. And I'm just going to basically do a little bit of, that was the fractal trading system. You can go ahead and look for that. Okay, there's the fractal trading signal system number 1. I'm going to go ahead and click that. I'm going to go ahead and define a scan list. So right here, I'm going to come to index constituents. I'm going to have it run a list against the Dow Industrials. Okay, and notice we have all kinds of market coverage. I typically do the Dow, the S&P, and then the NASDAQ 100. Okay, in there, there's about 535. I actually we'll have it run go, no go second. We're gonna have it run the fractal trading system. So I'll go ahead and start that as a scan. It's gonna go through and like you see, I accidentally set up it to run 2 explorations, but it'll run the first and then we can look at that and then it'll run a second. So you can run as many scans as you want at the same time. Right now, it's going through the S&P 500, the NASDAQ, and the S&P 500. That's about 529 stocks because there's a lot of overlap between those characters. It's rejecting about 96% of the stocks. So for me, that's a credible thing because for me, what I want to be able to do, and Price Headley, another person that I very much respect, says skip the opportunities, look for the opportunities, skip the small opportunities, focus on what works really well. And I think with the ability to test and find the methodologies that work and then be able to find the stocks, the scanning, they really allow you to focus on what works. So in this particular case, if I was looking for long positions on the trading system, I believe we had 18 results instead of 529. These are the stocks that I could look at, and I could open up these 18 charts. I could plot them on a chart, and I could say, okay, out of these 18, here's the ones that I'm eliminating. Here's the ones I want to look for. And just save myself looking at 511 stocks just by doing that. So there you go. Pretty cool. Anyway, let's go ahead and go back in here. Okay. I hope that was helpful for you. Hopefully we didn't get too far into the woods. I try and kind of just, hopefully it was useful. If you have a comment, like Lori, and some of the other comment, I can only see Lori right now. If you think that was too easy or too basic or too advanced, let me know. I try and keep it to hit the widest group possible. But hopefully you learned a little bit about the MACD and how you can use it, and the importance of trading with a plan. If you've only learned that, I hope it's helpful for you. So we do have, again, with Metastock, it's been rated #1 in its price category 29 years straight. I love it. I wouldn't trade without it. I'm very proud of the fact that we've been rated so highly for so many years. So we have two versions. We have our real-time version, which is $250 per month. It'll include Zenith real-time. It's going to include one of the best news services. I'm totally unbiased, right? No, I'm totally biased. I worked for Metastock for 26 years, but it's literally the same news that is subscribed to from like your institutions and your hedge funds. Supported by Reuters, they have a couple thousand reporters and a couple hundred different news bureaus around the world. Very, very institutional grade news, information, and data. They'll cover just about anything in the world. It's only $250 per month, and that includes that real-time data. It includes the news. It doesn't include some exchange fees. Like, so for example, if you want to get real-time data from New York Stock Exchange, it's a few extra bucks, and you have to pay that. And it's money that goes to the New York Stock Exchange to provide them real-time data. Each of the exchanges have their own fees, depending on if you're real-time. If you don't pay for that, you'll get delayed data. Okay, but it's only $250 per month, which is a fraction of what you've been paying for it for the same data and news and Metastock as an institutional customer. Okay, the other version that we have is Metastock DC. Metastock DC stands for end of day. So if your main interest is kind of building that business plan, scanning, testing, pretty much what we talked about today, you can do this. It'll still work well for you. It's $69 per month. That's going to include the data that you need. It's also going to include the Metastock platform, everything you need to get started. So $69 per month. What we're doing here is what we call an extended trial, or a 3-month trial. Basically, if you pay for a month, we're going to give you the second and third month for free. So for real time, it's going to cost you less than $100, and for end of day, it's going to cost you less than $20 per month. Okay, so you pay for that first month, we'll give you the second and third month for free. You'll get access to the software that's literally been rated #1 29 years straight. Okay, that'll include Metastock, that'll include your data. I said earlier, like if you, when you sign up for a new Metastock, we actually can set up a white glove installation support where we'll have somebody in a 2-hour dedicated block help you with any questions you have, walk you through the program, help you install it if you want. Just make sure that you're kind of taking advantage of Metastock. And for us, we started doing that several years ago, but we know that if you start using Metastock and it becomes something that's helping you, it's going to be something you're going to have no problem paying for. So we'll include that white glove. We're also going to include the Unleash the Power of Metastock, which is a training CD that's going to go through scanning and testing and forecasting and all of the stuff that we really can't talk about. Wow, I'm going to tie this up right in time, that we just don't have the time. So to take advantage of that, you can give us a call, 800-882-3040. You can visit us online at metastock.com/saleschat. You can also add that to the Summit deal. And I've been talking about the Summit deal all day, but one of the things that I've absolutely enjoyed is working with all these different market experts to kind of automate the scanning and the signals and get everything running. Today, what we've got as part of the Summit Action Pack is probably the most popular add-ons that we've got this year, starting with the Go No Go Complete. That's been really well received. It was rated really highly by Barbara Starr. Oh, actually, that's not out yet. Pretty soon, there's going to be a review out from Stocks and Commodities. It's a very good review from Barbara Starr. I think it is the June issue, or maybe the July issue. Anyway, it's going to include the Candle Profit Systems 2.0, one of our most popular add-ons. That by itself has been reviewed twice by Stocks and Commodities magazine, and I love scanning for those doji patterns, doji at the top, doji at the bottom, but all of the patterns are included in there. You're going to get 3 months of the OVI Trader. Silas, right after we get done, is going to talk about 3S Code. 3S Code is a very classic pattern that we just got done with his add-on, and it looks great. It's just going to look for like I think of them, and Silas can correct me if I'm wrong about this, but I think of them as a W bottom, but it's a 1-2-3 pattern. He calls it a 1-2-3 pattern, or a 1-2-3 top, an M top. Okay, that add-on's just brand new. We just released it, and people really, really like it so far. As part of this package, we'll also give you 3 months of the 3S Code. We'll give you Unleash the Power of Metastock workbook. So to take advantage of that, metastock.com/summit deal, 800-882-3040, or metastock.com/saleschat. Anyway, so there's my little speech. I hope you're enjoying the session today. I really do. Hope you've learned something. Let's get on to some of the better speakers. All right. Before we do that, I'm going to say thank you to CMT Association, again, for sponsoring today's event. They've been sponsoring them all since November. CMTassociation.org if you want to learn more about that. And it's getting warm in this room. Again, 29 years in a row. Find out why. Try it out. It's less than $20 a month. All right. Our next presenter is Silas Peters. Silas has now done quite a number of presentations with us. He took part in our big conference like a month or two ago. We just put the finishing touches on his Metastack add-on that I'm going to show you when he's done. It's really cool. I love the 1, 2, 3 classic pattern approach that he looks at for trading. He does such a great job at talking about it and explaining them and all that kind of stuff. So Silas, let's go ahead and bring you on here. How you doing?
Hey, Jeffrey, good to see you again virtually.
Well, welcome. Let's go ahead and make the presenter you. So let's see.
Sounds good. Give me one moment and I'll get situated. Let's see here. Okay, how about now?
Sound good, and I can see you. I mean, I can see your chart anyway.
Okay, great. Well, thanks for having me on again. I really appreciate it, and I know the attendees have had a great time here today, learning from a lot of folks. Let me know whenever I'm good to go, and I'll get started.
I'll get out of the way. You go.
Okay, sounds good. Well, thank you, Jeff Gibby and the Metastock team again for having me back. As he said, I've been on here a handful of times, always enjoy it, always a great crowd. And really, most importantly, it's because I enjoy speaking about what I'm going to share with you today. In fact, anything that I ever talk about, I certainly don't like to listen to myself talk, but I get very excited, very passionate about the topics that I share, especially this one today, because it is my bread and butter strategy. In fact, it's probably the first, if not the second, pattern / setup that I learned in my journey, learning to trade and invest almost 20 years ago. I, like probably a lot of you, I put it to the side, chasing the elusive Holy Grail. And guess what? I went back to it because it worked, and it works now, and it will continue to work because all it is price action. So I'm very excited. If a handful of you guys can let me know that you can hear me and at least see my screen, we'll go ahead and get started. My name is Silas Peters from Trades Trending, a seasonal swing trader. You are here to see 3-point price action formula to spot market reversals to trade this current market volatility. And that subheader there could be a little misleading. This is not just a market volatility type strategy. In fact, it works in all markets, normal market environments, volatile market environments, all time frames, styles, you name it, and I will cover that immensely as we go forward. Looks like the audio and visuals are good. If there's any point that you have a question or a comment and feedback during the course of the presentation, I'm not ignoring you. I want to get to the meat of this, actually teach you something actionable, something that you can start using immediately. I will then get back into the at the end of the workshop and go through everybody's questions. So let's go ahead and get started. We must first begin with the risk disclaimer as required by the regulatory governing bodies and our attorneys. We know that past performance is not indicative of future results. There is substantial risk of loss associated with trading. Only risk capital should be used to trade. Always, always, always consult your financial or tax advisor before applying real capital in the markets. Now, let me quickly introduce myself. Again, my name is Silas Peters. I'm a husband, a father. These are my beautiful blonde hair, blue-eyed beauties on the left here, standing in front of my alma mater at the University of Alabama. And 3 days after I graduated, I sold my car, I packed up my belongings, and I headed north, straight north to the great Windy City, or Chicago. And it's here where I cut my teeth in the commodity markets, working at the Chicago Board of Trade. I was bitten by the trading bug and never really looked back. While there, I helped run a global trading desk, placing and managing books of trades across the Americas, Asia, and European sessions, primarily working with large block order flow for hedge funds, banks, commodity trading advisors. Also been a part of building and managing several futures and equity brokerages, managing operations, trading, back office sales, and support. Worked as a private family office investment consultant, hold or have held these various futures and securities licenses. And in 2016, I launched Seasonal Swing Trader. And then just a couple years ago, we launched our RIA Blue Marlin Advisors, where I'm a co-founder and COO. Now, let's talk about my journey. My journey was not easy, was not always easy. There was a learning curve. In fact, several obstacles and hurdles on the path to where I am today. The first step was obviously learning. School does not, cannot teach real life experience of the markets. In the beginning, I made money. In fact, I made a substantial amount of money. Was I lucky? No. But ignorance and greed cost me my profits. I blew up an account and several others and what I like to call revenge trading. I finally settled down, went back to my roots, worked my process to find overall consistency. Now, enough about me. Let's talk about you. Does anybody's trading desk look like this? Does anybody's trading desk look like this? I certainly hope not. This is a bad joke I found on the internet. Thought it was funny at the time because I feel like it's what those on the outside looking in think this is what trading is all about. Now, we're all sitting around surrounded by dozens of monitors, staring at Bloomberg, CNBC, etc., but certainly not the case. Now, my desk did look like this in Chicago for obvious reasons, but I've since pared back to just a handful of monitors for trading, operational, and day-to-day activities. Now, all this right here is completely unnecessary. In fact, it leads to paralysis analysis. So who here has or is a victim of paralysis analysis? I'm raising my digital hand. I've been there, done that, got the t-shirt. Per Wikipedia, it's a state of overanalyzing or overthinking a situation so that a decision or action is never taken, in effect, paralyzing the outcome. So I see a lot of you have been there, and it's no fun. Who here has done all the research they thought they possibly could? They've crossed the T's, dotted the I's. They got their finger on the mouse, getting ready to pull the trigger, and then what? This line crosses this line. So-and-so on CNBC said that you should be buying instead of selling, thus negating your overall decision-making process. So a lot of you are in this boat, and my goal today is to help you get rid of paralysis analysis. So I appreciate everybody's interaction up to this point. Let me know what you're trading. I like to see what kind of audience I have here. You trade stocks, options, futures, FX, even cryptocurrency. I trade all these actively: stocks, options, futures, and FX. Don't trade crypto actively. I do have various crypto accounts across the World Wide Web. I view it more as a lottery ticket, but I do trade all of these actively. So we've got a lot of stocks and options traders in here, some futures, a little bit of futures and FX, all of the above, weekly options, you name it. And that's awesome. And that's awesome because what I'm going to share with you today works in all of those markets. It's highly accurate, works in all time frames. It's 99% mechanical, and most importantly, it's simple. So I want you to remember today that we're not here to teach rocket surgery today. We're going to keep things very simple. In fact, I have an agenda and a promise for you. We're going to learn a simple mechanical setup together that is repeatable regardless of the market or time frame. So at some point during the course of the presentation, I'm going to ask, have I fulfilled my promise? And I hope to see a lot of yeses. And if I haven't, you need to let me know that too. But I think the most powerful thing that can be done is show proof. As they say, proof is in the pudding. Let's look at this chart of GE. Would it be helpful for you to have been able to identify this move here in GE for a 36% move, or turn around and be a seller of GE for a 26% move? How about Barnes Group? What about a 21% move to the downside, followed by a 63% move to the upside? Bank of America. I'm going to show you exactly how and why you'd have looked to have been a seller there for a 28% move to the downside and be a buyer here for a 60% move to the downside. Works in futures just like it does in any kind of equity or ETFs. 240-minute or 4-hour chart of gold futures. This is $1,800 a contract, followed by $900 a contract. 5-minute chart of the E-mini S&P. Are you a futures trader? We've got 8 points, 2.5 points, 6 points, 4 points to the upside. This is a single day of trading, and this happens every day. This is not something, not some anomaly out of thin air. Happens every day. Forex traders, Aussie yen. How about a 150-point move to the downside, followed by a 450-point move to the upside, followed by a 160-point move to the downside. These are just to target one projections, and they continue to even further in most cases. So with all of these examples I just showed you, can it be too simple? Well, we know trading is not easy. In fact, it's not easy at all, but it can be simple. You see, when I got started, I was probably a lot like you, sifting through hundreds of different strategies, systems, setups, getting all kinds of junk mail about penny stocks, you name it. I tried and looked at all kinds of stuff, and most of it was garbage. But the single most important part of this journey is when I learned to keep it simple. Once I got rid of the clutter, the fancy blinking gizmos and indicators, and started focusing on price action, following one simple pattern, that's when it all started clicking. So if you are sitting here as a new trader or a struggling trader or maybe even an experienced trader, I'm about to teach you my foundational go-to strategy that got me from a struggling trader to a winning trader. And I'm telling you right here, right now, that this is a simple mechanical setup that anybody can learn. And you will keep this in your trading arsenal for years to come. And in the end of today's workshop, I'm going to make you an offer you can't refuse. How you can join my team with a specific set of tools and a plan that will help shortcut not only your learning curve, but also the time you need to spend looking for quality setups. So let's get right to it. The price action pattern we're going to be discussing today is, drum roll please, the 1, 2, 3 pattern. Now, Mr. Jeff Gibby from Metastock already spoiled what the pattern was. I'm just kidding, giving him a hard time. But let me know if you have heard of the 1, 2, 3 pattern. Sometimes referred to as the 1, 2, 3 top, 1, 2, 3 bottom. Probably a lot of you. I see a lot of yeses, couple of nos. But this is one of the most fundamental technical patterns in the textbooks. We're talking technical analysis 101, but highly, and I mean highly, overlooked by most traders. And when I get done showing you what I'm about to show you, you're going to be kicking yourself going, why haven't I been using this technical analysis 101 pattern? Let's talk about the setup. The setup is price action based. The pattern is comprised of a low, a higher high, and a higher low, and a break of that higher high in the case that we're going long. Same pattern applies, but inverse to the short side. Anticipates a change in trend from up to down on a break below the 2 or B point. Anticipates a change in trend from down to up on a break above the 2 or B point. The strategy usually occurs at the end of trends and swings, can be an indication of a change in trend, can also be found within a trading range. And we'll stress it works extremely well when the pattern sets up as significant areas of support and resistance. Other high probability technical patterns such as tops and bottoms, double tops, double bottoms, and more. Let's take a look at the basic mechanics. So with the 1, 2, 3 top pattern, we are looking for a short example, a short trade. To get short, we're bearish when we see this pattern. So point 1 here is when price trades up, finds the highest peak, finds resistance, and then moves or starts to retrace to the downside. Once we stop printing these higher lows and pull back, we get our number 2. And once we stop printing these lower highs and pull back down, we get our number 3. 1, 2, 3. Prices could have traded up as high as here as long as we don't take out that number 1. We have a 1, 2, 3, and a 1, 2, 3 top trader knows that we're looking to get short on breaks or closes below the number 2. For a 1, 2, 3 bottom, same rules apply. Same rules apply, only in inverse. So here we have the market trading lower. We find our lowest low or support and retrace higher. That gives us our number 1. Once the market trades up, and retraces back down, stops printing these higher lows. We get our number 2. Market comes down. Once we stop printing these lows and pull up, we get a 3. 1, 2, 3. So this is a bullish setup. We're looking to get long. And 1, 2, 3 bottom traders know that we're looking to get long on breaks or closes above the number 2. Now, we don't know what happened in this example, but that's where we'd be looking to get long. Now let's look at some chart examples. Let's start with the 1, 2, 3 top. Now this is a daily chart of the Aussie, the Australian dollar futures. If you don't trade futures, you can look at FXA, the ETF that tracks the Aussie. Forex traders can trade or look at the Aussie USD cross pair in Forex. You're going to see the exact same pattern, exact same setup. So on a daily chart, we primarily like to focus on a 52-week high or 52-week low. That's not an absolute rule. Nothing's set in stone here. But for these example purposes, we're going to look at 52-week highs or 52-week lows. So you'll see on this chart, we have a red 1 circle. Why? It's a 52-week high. So we start our count. We have a 1. The market pulls down, pulls back up, and then pulls back down. 1, 2, 3. Now, again, the market could have retraced all the way up here. As long as we didn't take out that number 1, we have a valid 1, 2, 3. So now you know pretty much all the rules of the system. You know what the setup looks like. You know that you're looking to get short on breaks or closes below the number 2. But what about the other important ingredients of the recipe? Like, where's my risk? Where am I taking profits? All that good stuff. Very good questions. So our initial risk is going to be above the high of the number 1. Above the high of the number 1, our initial target is a distance between the high of the 1 measured to the low of the 2 measured down. So we measure from the high of the 1 down to the low of the 2 measured down, and that is about 225 ticks or $2,200 per contract in this example. So you're going to see right off the bat that we have a 1-to-1 risk-reward ratio because our risk is up here, our targets are down here, but we'll talk about ways later where you can quickly cut that risk. It's very important to let the market breathe, let the market move in its anticipated direction. So as we start to break down, taking out these lows, where's the next logical place to move our stop? Above the number 3 high. So we move our risk from here to here, and we quickly cut our risk by 50, 60, or even 70%. So another example, daily chart of Walmart, WMT. We have a number 1 here. Why? Because it's a 52-week high. We have a 1, 2, 3 top, looking to get short on breaks or closes below the number 2. We know days, if not weeks in advance, where every other trader is struggling. Well, where am I going to get it? Where's my risk? Where am I taking profits? We know that in advance. We know we're looking to get short on breaks or closes below the number 2. We know our initial risk is going above the high of the 1. We know our initial target is that this is between the high of the 1 measured to the low of the 2 measured down, which is about $5 in this example. Let's look at 1, 2, 3 bottom examples. This is a 15-minute chart of the E-mini S&P. Now, on an intraday chart, whether it's a tick, 5, 10, 15 minute, does it make sense to look for a 52-week high or 52-week low? No. So on an intraday chart, how do we define what the low or high is? Well, we define it as a session high or session low. What the heck is a session high or session low? Well, if you're not familiar, futures and Forex are trading virtually around the clock. So they're opening up on Sunday afternoon in Globex, trading into the Asian session, into the European session, into the New York session, shutting down briefly in the afternoon, reopening, rinse and repeat through Friday afternoon. So wherever you start your trading day, you're looking for new highs or new lows. So if you're starting your trading day in the Asian session, you're looking for new highs or new lows. If it's the 3 a.m. European session, we're looking for new highs or new lows. If you sit down at your desk around 6 or 6:30 like I do, I'm looking for new highs or new lows. If it's the last hour of the day, you're looking for new highs or new lows. Pretty simple. So let's talk about entries. So this is a session low. We have a 1, 2, 3. Let's talk about entries. Aggressive traders may work a buy stop, a tick or two above the number 2 high, where you're triggered immediately on the break. Now, an alternative or more conservative entry is to either A, wait for the market to come back and retest that breakout area, or wait for the market to give what I call a second pass or a hook. What does that mean? The market comes down, hooks back up through that original breakout area where we're now able to get in on what I call the second pass. So we broke through once, we let the market jiggle and jangle, and we came back and we trade to the upside. So a couple things are going to happen. If you're using this entry technique, sometimes the market will zip up and hit your profit target, leave you at the train station. We don't cry, we don't get our feelings hurt. There's plenty of other market opportunities. But what else is this gonna, what is this method gonna do? Sometimes the market will come up, roll back down, and give you a false breakout. So this method will sometimes help you or prevent a false breakout. Now let's look at a 1, 2, 3 bottom in a weekly chart of Apple. Hell of a way to catch some longer term type moves. Here we have a multi-week low. We also have what? A double bottom, 1, 2, 3, high probability double bottom. We get a large bullish breakout above the number 2. We go sideways for a few weeks. We come back down and hook back up. That's our confirmation to get long Apple. How? We buy Apple stock, we buy calls, we buy call spreads, we sell bull put credit spreads. Whatever your flavor or style is, there's no excuse not to be able to take advantage of these moves. Trade CFDs if you want. So that's how we trade a weekly chart to catch some really longer term position type moves. Failed trades. All you holy grail chasers out there, they don't all work. There's no holy grail in trading or life, but I know we're all big boys and girls. You already knew that. But this is a trade I probably took in my live account. We had a vertical move to the upside, new session high, 1, 2, 3. That aggressive trader may have gotten short on the initial break, or if you waited for the hook method, you're short here. Maybe you're up by 1 or 2 points right here. If you exercise any type of money management, you moved your risk from 1 to above the 3, and you're stopped out when the market came higher. If you sat on your hands and didn't do anything, you're stopped out above the number 1 high. But look at what we get. We actually get a new setup. 1, 2, 3, because this high is greater than that high, we get another opportunity to short, which ended up being a profitable trade. Now, this is what I call a voided or no trigger trade. It's neither good, bad, nor ugly. It is what it is. I'll tell you why I like this setup. So here we have a 1, 2, 3 bottom. We're looking to get long above the number 2. What happens? Market breaks down, takes out that number 1 low. We start to count over. 1, 2, 3, looking to get long here. Market rolls over, takes out that number 1 low. We start to count over. 1, 2, 3, finally able to get long in this third attempt. Does anybody know what is likely going on in this situation right now? Anybody want to guess or take a stab at what's going on? We've got price making lower lows, but we're likely having, say, an oscillator making higher lows. Higher lows. What do we call that? Price making lower lows, oscillator making higher lows. We call that big bad divergence. So I love when we have divergence with these patterns. Those are some very high probability opportunities. Let's talk about 1, 2, 3 pattern trade management. Again, the confirmation of entries on a break above the 2 or B point for a long, or a break or close below the 2 or B point for a short. Exit strategies. If you're only trading one contract, whether that's a futures contract, currency pair, one option contract, one share of stock, I would say go for the distance between the 1 and 2 as your initial target. It's uncanny how more often than not the market will come tag that often to a tick and then reverse. But if you have the flexibility to where you're able to scale and scale out, I'd say, hey, take a third, half, 2/3 off at that initial distance between the 1 and 2, and then manage or trail your balance using any style that works for you. They come a dime a dozen, followed by trend line, 2 to 3 bar candles, moving averages, parse R. I like to use good old-fashioned structure, good old-fashioned trend line, nothing too fancy. You got to figure out what works best for you. Now, I've showed you that this setup works in any market, whether you trade pips and Forex, Pepsi stock, pot or potash, pork bellies, or the Polish zloty. I've also showed you that this setup works on any time frame, whether you trade tick, 5, 10, 15, 30-minute, hourly, daily, weekly, and more, and on any style. Let me know what everybody's style is. Are you a position trader, swing, day, scalper, tick trader? What is everybody's trading style? Got a lot of swing, day and swing, probably even match. Looks like swing stocks and swing options are winning out right now. Scalper, anything that works. That's awesome. Yeah. And really the point of all that is that you have to figure out what your bread and butter is. You have to figure out what works for you, because I'm not going to tell you that this works best on a 5-minute chart. This works best on a weekly chart. This works best on a 233 tick chart. It works on all time frames and all markets and all styles. But you have to figure out what works best for you. We've got some people that trade this with a 9 to 5. Some people that are retired and don't have any care about looking at a chart all day. Some people that don't care about holding positions overnight and only want a day trade. These are some of my favorite setups right here on these markets. I also like the 233 and the 610 tick chart. They work very well, but these are my different and favorite styles, okay? So you've seen the proof. Not to say what we looked at were fake examples, but let's look at some positions, or not positions, some examples that I've utilized in some of our services. So let's first start with crude oil. Everybody's familiar with crude, whether you trade CL futures, USO, other energy stocks, or leverage ETFs. I'm going to focus on the chart and work my way from left to right. You guys and gals can read all this text over here on the right. So here we have a 52-week high, as indicated by this one. It's a daily chart of crude. So again, we've identified a 1, 2, 3. We know in advance where we're looking to get short, where our initial risk is, and where our initial target is. So we break down below the number 2 point, we get a couple of retests, and we quickly meet our $3 or $3,000 per contract price objective. Then we go sideways. So I love when people say, Silas, does this method or setup work in sideways or consolidating markets? Well, the answer is that it does. Remember, I'm looking for new highs or new lows, but if you want to trade range bound 1, 2, 3s, you certainly can. Here we have a nice 1, 2, 3 inside a range, and there's a nice move to the upside. But remember, I'm looking for new highs on this daily chart, which is what we get right here. This high is greater than this high, so we get a new 1, 2, 3 count. And let me tell you why I was licking my chart here, licking my chops at this particular setup. Well, one, because of the high probability nature of the 1, 2, 3 top pattern. But secondly, we're at a time of the year from a seasonal perspective where crude and energy stocks in general tend to gravitate to the downside. So we had this 1, 2, 3 top setting up at a favorably seasonal time of the year to short the market. We had this little trend line break, and we got short. So we got short here. If you were out gardening or playing golf or whatever it is you're doing, you had 1, 2, 3, 4 days or so opportunity to get into the short side. So we sold off. We met our $4,000 per contract price objective. We move our stops to break even, and then we ride the pony until we either get stopped out or we get a reversal. And all we're doing now is looking for a potential 1, 2, 3 bottom. The market's making new lows. We have a potential 1, 2, 3 here. Market decides to take out lows. We have a potential 1, 2, 3 here. I love this setup right here because now we're at a period of the year where energy markets and crude tend to go to the upside. Plus, we have a beautiful triangle pattern. I was certain that we were going to break out to the upside here, but what happens? My emotions stay on the sidelines. Market decides to take out this number 1 low and trade lower. So this is a $20,000 move. After we consolidated here, it looked like we were going to go higher. We actually broke down, sold off another $10,000 a contract before we finally got our last 1, 2, 3 bottom for a $5 or $5,000 move to the upside. Now, I want you to remember this chart and the subsequent charts, but I'll show you something really special here in the end. Now, if you look at this chart, I don't know if you can see the dates like 2018, 2019, when I put this first slide together. You say, Silas, that's hindsight. That's rubbish. How does it work in today's current market environment? Well, this is how it works in today's current market environment. This is a $5.80 move to the downside. This is a $4.75 move to the downside in current market environments. Let's look at another example here in gold. Everybody loves to talk about gold. They subscribe to a bunch of overseas newsletters that talk about gold's going to go here, gold's going to go there. Who cares? Follow the price action. So here, this is a daily chart of GLD that actually tracks gold futures. So here we have a 1, 2, 3 top. Looking at short on breaks below the 2, we reach our $4 profit objective. Here we flip to the long side. 1, 2, 3, double bottom. We break above the number 2. We reach our $2 profit objective. Now, we're back in that range bound mode. Remember, I'm looking for new highs or new lows. If you want to trade the range bound 1, 2, 3s, help yourself. Here's a nice 1, 2, 3 right. Oops, 1, 2, 3 right here. Trades the upside. Here's a nice 1, 2, 3 to the downside. Okay, but now we start making lows. These lows right here are lower than these lows, so we're starting to get new 1, 2, 3 counts. All right here. This is a potential 1, 2, 3 right here. But this guy gaps lower, takes out that low. So we get a new 1, 2, 3. You can see we get gaps 2 days higher. This is because it's GLD. If it was a gold futures, we wouldn't see those gaps, but that's okay. Now we come back, retest, also get a trend line retest, hook back up. That's our confirmation to get long gold. Buy gold futures, GLD calls, call options, call spreads, sell bull put credit spreads, minis, micros, whatever you want to do, and we trade to the upside. Okay, Silas, this is a chart of 2019. I can't believe you're showing these old charts. Well, here's a chart in today's current market environment. I think everybody can go back and find these 1, 2, 3 tops and bottoms that occur over and over again. Delta Airlines, DAL. Everybody's familiar with Delta Airlines. This is becoming redundant by now, but I'm trying to hit home the fact that these occur over and over again. 1, 2, 3 bottom, trace to the upside. Here we have a 1, 2, 3 top. This one gaps down below the number 2. I personally don't trade those gaps, but I've got members and students that will aggressively start buying puts here. Here we get another chance to short Delta, because this high is greater than this high. 1, 2, 3. We break down below the number 2. We get a small retest right here. We're able to jump in for an $8 move to the downside. Then we flip to the long side. 1, 2, 3. Market trades higher, pulls back, then rips up $8 plus. What does it look like in today's market environment? Here you go. 1, 2, 3 bottom to the long side, 1, 2, 3 bottom to the long side, 1, 2, 3 bottom to the long side, 1, 2, 3 top to the short side. Forex traders, CAD Swissy. Forex traders in the CAD Swissy. Here we are. We have a multi-session low, 1, 2, 3, also a little double bottom here. Remember, those aggressive traders are getting long on that initial breakout. If you wait for that retest and hook back up, you're getting long here. When you reach your 70 pip profit objective. Now what? We don't care. We're just looking for a reversal pattern. Here we have a potential 1, 2, nope. 1, 2, nope. 1, 2, nope. Finally get a last 1, 2, 3 confirmation. Trades down, retraces, hooks back down for a 40 pip profit objective. Here's a 4-hour chart of the CAD Swissy. 80 pips, 70 pips, 35 pips, 70 pips, 55 pips, and going. Okay? Day traders, 5-minute chart of the NASDAQ, 5-minute chart of the NASDAQ. Session low, 1, 2, 3. We break above, hook back above. We reach our 13-point profit objective. 1, 2, 3. Here we get a breakdown below the number 2. We go sideways, pop a Tums or 2. Finally breaks down, reaches our 20-point profit objective. Get a last 1, 2, 3 bottom for the day. 1, 2, 3 bottom, we break above the number 2. If you're lucky enough to get long on that retest right there, you're filling your 30-point profit objective in about 2 bars. current market environment. 137 ticks to the upside, 60 ticks to the upside, 91 ticks to the upside. These happen over and over and over again every single day. So why are you here? You're here to learn a mechanical, done-for-you strategy for all markets and all time frames. Have I shown you enough proof? This is the part of the presentation where I'm going to ask, have I fulfilled my promise? So please type something in the chat. Let me know, have I fulfilled my promise up to this point? Because honestly, I just don't know if I can break it down any easier. If I can, I would be happy to. But it really is as simple as that. So looks like everybody up to this point is on board. Now, I'm going to say, but wait. But wait, there's more. What if the strategy I just showed you was automated? Remember the case studies we went over, crude, gold, Delta, NASDAQ, and so on? What if the strategy could be plotted onto your chart for you? What if the trigger entry and the targets were drawn for you? And what if your platform could scan the markets for you and tell you when there's a pending setup? Well, I don't know about you, but that would make my life a lot easier, and I think it would be pretty friggin' awesome. So remember the charts I just showed you? Let's take a look at it. What do we have now? We have a bunch of colorful arrows and colorful lines. Well, you guys are smart. I'm sure you figured it out. The green arrow is your number 1. The red arrow is your number 2. The blue arrow is your number 3. 1, 2, 3. Now, what about these white chevron things? What are these? These are not buy signals. These are not sell signals. These are visual aids waving at you saying, hey, we've broken below the number 2 or we've broken above the number 2. So if and only if we break below that number 2, which we did on this candle, or if and only if we break above the number 2, which we did on this candle, we get these beautiful line plots. Well, what the heck are these? The blue line is that breakout or entry level. Your red line is your risk or stop. Your lime green line is TP1 or profit objective 1. And your dark green is TP2 or profit objective 2. So remember, TP1 is measured from the high of the 1 down to the low of the 2 measured down. And TP2 is simply 2 times the distance of TP1. Okay. Oh, let's go back. What about all these green arrows? Why do we keep seeing these? Because the market is making new lows. It's saying we're making new lows. We're getting ready for a potential new 1, 2, 3 bottom. Here we have that potential 1, 2, 3 right here. But the market takes out that number 1 low, hence no chevron, hence no lines. Here's this other one. I was getting ready to go long. But the market rolled back over, took out that low. We started the count over. Okay? GLD. Here we have a 1, 2, 3. Once we break above, we get our targets and our entry and our risk plots. Okay? We don't get anything in this area because we're looking for new highs or new lows, which we start to get right here. We start to get new number 1 counts because they're lower than these lows back here. Here's that last one right here. 1, 2, 3. Market just peaks up above the number 2. Gap, gap, comes back and retests. His TP1, his TP2. And we're looking for a new 1, 2, 3 top over here on the right-hand side. No repainting. Here we have a 1, 2, 3 to the long side. 1, 2, 3 short side. 1, 2, 3 to the short side. 1, 2, 3 to the long side. 5-minute NASDAQ futures. New session high right here, or session high. 1, 2, 3. We break down. We reach TP1. We reach TP2. TP2 happens to be a new session low, so we start a new 1, 2, 3 count. 1, 2, 3. Here we peak above, we hook back up, we hit TP1. Don't quite hit TP2, but it's close enough for government work. You shouldn't have lost any money. And then we get a new count. These lows are lower than these lows. 1, 2, 3. We peak above, we retrace, and then we come back up. We hit TP1. And then while we're waiting for TP2, notice this, new session highs. This clues us in that we may need to get ready to flip to the short side. Here we get a 1, 2, 3 top. We break down, we break below the 2, retrace, and then we hook back down, hit TP1, and then hit TP2. Okay? So is this training for you? Is this training for you? If you are new to the markets and want to jumpstart your success, if you're an experienced trader and want to add another arrow to your trading quiver, if you're tired of all the noise, the indicator overload, the paralysis analysis, if you simply want to just make your process easier, or maybe you're successful and want to add a new strategy to your toolbox, or if you need a specific step-by-step plan and want to avoid learning it on your own time, this strategy could be for you. And this is something that anybody can do part-time. Now, when I had this built out, one of my tests was to show my 2 daughters and my wife. Now, my 2 daughters and my wife don't know a flipping thing about the markets. They don't even know what I do. But I told them to come down and let me show them what I'm showing you today. And after they got around all the colors and the candles and this and that, they got it. And my point is that if they can get it, they can understand it, then you certainly can too. If you know how to count to 3 and we know our primary colors, this is a strategy that anybody can implement. Just like these setups in Cardinal. We have 2 long examples in Cardinal Health right here, followed by a short example. And these are non-repainting. Google, perfect for swing traders. I personally love to sell options with these setups. I will sell bear call spreads. I will sell bear call spreads. 4-hour chart of the Canadian dollar. Here we have, I love the hourly and 4-hour charts on futures and FX markets. 233 tick chart on the E-mini S&P. If you love to scalp and you love action, these work excellent on the 233 and 610 tick charts. I love S&P, crude, bonds, euro, anything that's moving. Now, why do all the work when you can let scanners and technology do the work for you? This is where I'm running a scan, looking for 1, 2, 3 tops across the Russell 1000, only stocks that are optionable. $20 a share or greater. I hit the green scan button and voila. I am running multiple scans across multiple assets, across multiple time frames every single day. So we've been looking at various charts across Metastock, Thinkorswim. This is what it looks like on TradeStation, NinjaTrader 8, wealth charts, of course, Metastock that we've been looking at, TradingView, and MetaTrader 4. Now, we know there's no real crystal ball in the markets, but I view this as one that provides me with a consistent process each and every day. I'm letting the technology, my platforms locate the setups, scanning the markets. I'm going to my platform to enter the market and then exiting the trade each and every day. And you can do so now, starting with what I call the 3S code. So here's the offer you simply cannot refuse. With the 3S code, you are going to get the 3S code indicator, the 3S code scanner, the 3S code optimizer, access to member bonus scan sessions, and my private Telegram room access. We're also going to throw in 3 bonuses: my 25 top option strategy guide, chart pattern principle guide, and trading the 3S code quick start guides. You can get access to all of this, all platforms, for a one-time lifetime fee of $397. And the offer link is metastock.com/code. I just put that into the chat box for you. And if you want to be one of those that call in and speak to a real live human being, you can call 800-882-3040. Okay. Now, with the 3S code, you're going to get access to the following platforms: Metastock, Thinkorswim, TradeStation, Ninja 8, TradingView, MT4, and Wealth Charts. As of right now, we've got the scanner built for Metastock, Thinkorswim, TradeStation, Ninja, and Trader 4 and Wealth Charts. This is the only platform right here that does not have a scanner. So you're going to get scanner access to all with exception of TradingView. Okay, metastock.com/code. Lifetime access. We've added a PayPal option. I know a lot of folks like to use the PayPal option. It's convenient. It's nice. You can click on the order form, metastock.com/code. You'll see that option on the order form. Now, we're also going to have a 3S Code Masterclass this week, June 29th at 10 a.m. Eastern. I cover my top setups, day swing trading with the 3S Code, how we use it for trade options, trading minis, micros, ETFs, adding conflows, and much, much more. Now, I want to cover what the indicator and scanner includes. So there's absolutely no questions. You're going to get a visual plot of the 1, 2, 3 top and bottom reversal areas that include the entry, exit, stop, and target levels. All of these settings are customizable. If you want more setups or less setups, you can change the look back periods. You can scan for setups only, trigger only, or both. You can scan for tops or bottoms or both. You can scan for intraday setups or swing setups or both. Totally customizable. You're also going to get the 3S Optimizer. You can now take a mechanical 1, 2, 3 top and bottom strategy and now create and run multiple back tests across various inputs and settings to find the best optimization parameters that fit your trading style. So this is where I'm running a back test here in crude oil. Crude oil right here. You can see it spits out all of the results for you. This is the back tester or 3S Optimizer in TradingView. This is what it looks like in TradeStation and then NinjaTrader 8. So you can edit and add different variables such as different EMAs, EMA crosses, trend EMAs, minimum bar and percentage requirements, and much, much more, okay? Now, the 3 bonuses that you're also going to get, first one is my chart pattern principle trading manual and guide, 90+ page PDF, learning how to identify trend and range markets. There's additional strategies, chart patterns, how we use this to trade seasonality, and much, much more. Bonus 2, my 25 top option strategy guide, literally strategies for all account sizes, whether you're just learning to trade calls and puts to condors, verticals, butterflies, diagonals, and more. Bonus 3, access to my private Telegram room channel. This is each week I'm posting live charts across stocks, ETFs, indices, futures, and commodities. And guys, here's just unsolicited testimonials of people taking action using the 3S code, and the same can happen for you only if you take action. Nothing's going to happen unless you take action. So who is ready? Who's ready to get started? We've limited this to 25 spots because we provide white glove service to those that need help installing, those that need help with questions, anything and everything. We are here to help you. You can email us at support@tradestrending.com. We've got folks standing by. We're here to help you. And if you need help installing this on any of the platforms, we can do a remote session and get you set up. So here is a complete offer again. Metastock.com/code, or you can call 800-882-3040. So I'm going to stop for a second here and answer everybody's questions. Let me pause and take a swig of water. ABC, D, and Forex, are they similar? Yes, they're somewhat similar. I don't refer to them as ABCD in any of my training. We have different modules inside the members area. All of our monthly member sessions that we have are also recorded and archived, but it's really important that you watch those, you view those, you see us, you see how I am viewing, how we're trading the market in a real live market environment, how we're qualifying trades, how we scan for trades, and much more. Because in the end, everybody's got different styles. Everybody has different preferences of what they want to trade and how they want to trade it, and we cover all of that. Trading's just stocks, end of day, and long only. What is the win rate of the strategy? If you have several stocks to enter, how do you select the ones to trade? Great question. So the win rate ultimately depends on how you trade the setup. As you saw, there are two targets, target 1 and target 2. So people's win rates will differ on whether they're going for target 1 or target 2. We also have different qualifiers, as you saw with those optimization settings. If you require trend, if you require other things to happen for that setup, like we teach in our monthly member sessions, everybody's trade management, entries, exits will differ. Therefore, win rates will also differ. If you trade options, like I do, I prefer options to swing trade equities and commodities. Now, I'll also day trade futures as well. But depending on what trades you're taking, like we might get multiple setups a day, might get multiple setups on a tick chart. We only might get 2 or 3 setups on a 5-minute chart. Everybody's win rate will differ because I'm not going to take every single trade. And also, if you are in a trade, how are you managing that risk? Are you managing your risk when you say get up to a key level and you're 99% away to your profit objective? Maybe you're 60% of your profit objective. The point is that there's too many there's thousands of different variables. I'm not sure, Teresa. You can email the Metastock support team or our support team, support@tradestrending.com, and we'll be happy to try and get that recording over to you.
I can answer that one for you. Yeah. So everybody that has come, good day, Teresa. Thanks for joining us from Australia. We will send you a recording within 1 hour of the end of today.
Okay, awesome. That's pretty timely there. Excellent. This is not a renewal. There's no subscription. If you don't want to have any more contact with myself or my team, you don't have to. I mean, I hope you do. I hope you stay in touch. But if you want to move on to bigger and brighter things, then I wish you the best of luck in your trading. But you have access to the members area. You have access to me. I will personally reply to you. We've got a full support team that can help you with any password login issues, getting remote installed. Yes, you can load it on multiple platforms. We've got several students. I mean, I, for one, have this loaded on every platform. You don't need any special single license or multi-license access. You get access to it all. How does the scanner work? Great question. I mean, I get this question a lot, honestly, but the scanner works like any scanner. There's nothing fancy to it. You're going to load whatever watch list that you want to scan against. So if you have a list of stocks or a basket of futures, whatever it is you want to scan, and then that time frame, and then if you want to put in your parameters, say, you know, $50 a share or greater, I want 100,000 shares of stocks or more traded, yada, 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 you'll get your different results, okay? So here, I just kind of wanted to pull up the S&P here. This is a daily chart of Amazon. So let me pull up the E-mini S&P because it is my one of my favorite markets. I like to trade throughout the day. So you can see the setups that we had going on here. This is a daily. Yeah, let me go to a 5-minute. Really great trading here in the S&P. Again, the volatility has been our friend rather than our foe. You know, volatility is obviously can be a double-edged sword, but this provides some absolutely incredible setups. You can see these non-repainting setups here, and we have different ways that parameters, if you will, or variables that will allow you to get more or less setups depending on your preferences. Hence, that's another reason it's impossible to answer what rates are, because I don't know how you're going to trade or how you're going to manage a position. Plus, there's a way for you, the user, to manipulate all kinds of stuff in here based on what exactly you want to see. Like if you want to see at least a certain number of bars, let's say this is a single bar, see it 1, 2, 3. We've got some people that changed. I want to see only, you know, it's got to have 2 bars or 3 bars or 5 bars between the 1 and the 3, or I want a minimum X% of retracement. So that's what I mean by that. But if you have any questions on that, please feel free to reach out. We'll be happy to help you. It looks like I am out of time. So I want to say thanks to Mr. Gibby and the Metastock team. Always a pleasure to come on the show. Really am humbled to be asked back and always get good feedback. This looks so sexy on Metastock. Make sure you get a copy of it, and I look forward to working with everybody. So everybody take care and have a great afternoon. Thanks.
Thank you, Silas. Good to have you. We go ahead and do this real quick. And let me go ahead and take over the presentation. So I want to talk a little bit, since we do have just a few minutes before John's going to start. Let me go ahead and change the presenter here and just show you how easy this scan is to run. So you should be able to see my Metastock platform. I'm looking over here like there's a camera or something. And I'm just going to go ahead and just show you the 3SC scans and show you what they mean. So you've got long position management. What that's going to do is that you run that against your list, and it'll show you everything that's in any type of a long trade. You've got the long setup, and you've got the long signal. Okay, and then you have custom versions of that. So if you go in and customize like the amount of retracement or the bars between bars or the days between bars or that kind of stuff, you'll use a custom one instead. But the signal is going to give you anything that's come down and formed that third pattern but hasn't broke out on a signal yet. If you want to find something, or I'm sorry, the signal is actually broke out the setup, but it's just showing you stuff between 2 and 3. So if I wanted to run a long setup, for example, just choose a scan that you want to run. Coming down here, the world is your oyster. Like literally, you can choose anything you want to run. So if we're, I don't know, hypothetically wanting to find something in the Australian stock exchange, we could come in here, grab, well, we probably wouldn't want to grab all of the Asian stocks, but we could grab all the Asian ASE stocks and even the ETFs, and then very quickly just run our scan against that. Likewise, if you want to run it against something that's like the S&P 500, the Dow, we have a list of index constituents. If you're trading options, one of the things I really like in here is there is a list of optional stocks. So if I just want to scan against all the 5,500 US optional stocks, I can do that. So once you kind of narrow down your list, and I'll just do the index constituents again real quick, because there's about, the list that I've got is the Dow 30, the S&P 500, and the NASDAQ 100. I can run that scan, and it's just going to go and eliminate all of those stocks that don't have an entry and very, very quickly give me the ones that do. And by doing that, it's going to eliminate 90% plus of the stocks that I don't need to look at and just allow me to focus on the ones that have an opportunity. So there you go. It's that easy. One of the things I like, and he is correct. It looks beautiful. I do like the fact that you do get the 1, 2, 3s all plotted out there for you. Here's your entry price. This is USO. It just finished a 1, 2, 3 bottom pattern or top pattern today. You've got, if it comes down here below this trigger line, it's going to go ahead and get short. Here's your stop loss. Here's your first and second profit targets. And those are very, very easy to find. Right here, you'll see right here, we had a 1, 2, 3 pattern. It hit its target, at least the first level, and then timed out. So all of this stuff is very, very automatic. You can look at anything that you want to. It also features commentary, so you can open up the commentary and kind of take a look at what's going on. So I love I love the way that we that Silas helped us put this together. I love the fact that it draws the patterns on there for you. It gives you that initial entry price, the targets, the stop loss, all of that. And I love the fact that it's customizable as well. So with it, like I said, you're going to get the expert advisor that's going to give you in plain English everything that the system and setup is doing, and look at the scanning as well. So in addition, you're going to get all that stuff that he talked about, where the private Telegram room, the futures of Forex markets, the user-defined parameters, the courses that he talked about, the monthly support session, support from either Silas or our own support team is really, really good at kind of answering questions. In fact, they're awesome. So all of that's going to be available for you. If you don't have Metastock, you can get a free trial of Metastock with your purchase. And what we're doing here is as a kind of the summit special, the launch special, if you would, we're doing a $100 discount, $397. Give us a call, 800-882-3040 or metastock.com/saleschat. It is also part of that big Summit Action Pack, the Summit Traders Pack, whatever you want to call it, that includes Go, No, Go Complete, Steve Bigelow's Candle Profit Systems, the 3 months of that OVI Traders, the 3S Code, 3 months of LearnMetastock.com, the Unleash the Power of Metastock workbook and training. Normally, all of that separately would be $3,630 here. We're going to give you a huge discount, $1,641. We're going to back most of that with a money back guarantee. Give us a call, 800-882-3040. If you have questions, if you want to see some charts, if you anything, chat online with one of our guys here at metastock.com/sales-chat, or you can also go to metastock.com/summit-deal. So get in touch, 800-882-3040 or metastock.com/sales-chat. Find out. Some of these are the most popular add-ons that we've got for what's been rated the #1 platform in its price category for 29 years in a row. So there you go. 800-882-3040. Real quickly, we're going to say thanks to Stocks and Commodities Magazine for sponsoring the event, sponsoring all of our events for the last decade. They're great. If you haven't claimed with that 2-year subscription, or with that Traders Action Pack, we're actually going to give you, they're going to give you 2 years of Stocks and Commodities for free. It's part of their sponsorship. So, and if you want to, if you're watching on YouTube, you haven't registered yet, go to metastock.com/tradersummit. All of the speakers today are giving away free gifts, and Stocks and Commodities is giving away a free subscription to their magazine. So there you go. You guys have been a great audience today. Lots of questions. Our next speaker is actually has a very, we had somebody from Australia just a minute ago that wanted the recordings. John Seville has a very, very cool Australian accent. I absolutely love it. I remember working with him with his Acorn strategies, and they're very, very good. The smart money techniques, the Acorn strategies that he uses. He does such a good job when we invite him in and kind of have him speak, and we're happy to have him. So John, let's go ahead and get you talking.
Terrific. Can you hear me loud and clear?
I can, yeah. Let's go ahead and make you the presenter. Yes. Okay. You should have the notification. And yeah, you're coming in good. I can see you now too. Are you down? Where are you exactly right now? Are you up in Canada or are you down in Australia? I can't keep track of where you're at.
Yeah, we're actually on an RV trip across Canada at the moment. We're in Kelowna. So I'm actually sitting here in my accountant's office, who happens to live here.
Nice. Awesome.
Thankfully, utilizing his quiet office space.
Cool. All right. Let's see. Let's go ahead and get a screen share up.
Okay,
make sure everything's working well for you. I'm about to go on an RV trip next week.
I think in all the travels I've done, sitting at a campsite in an RV is just the tops. That's my favorite thing to do in life. Yeah.
That's probably why we get along, John. John, we can see you, we can hear you, and I'll let you go.
Excellent. Well, thank you so much. Yes, it is an absolute pleasure to work with everyone at Metastock, and Jeff Gibby. What a gem. So Jeff doesn't know this, but we actually, as of about an hour ago, have something brand new that I've been talking about with Jeffrey for a while now, and we were fortunate enough to have a new feature released in Metastock as of about an hour ago, and I'll show it to you here in today's presentation. But we put our noses to the grindstone to have something special for you today, so I'm very excited about that. But let's get started. Of course, today's presentation is all about powerful patterns and probabilities. In this kind of market environment that we're in, it's so important to have a way to make confident decisions. And there is a lot of noise out there which is going to distract us. The news, what the Fed's saying, what the 1,000 people in the chat room think about it. When you're looking at stock twits and things like that. So I want to try and bring some order to that chaos so that you can harness that big moves up and down that we're seeing. 10% up, 10% down. I mean, that's volatility where you can make a lot of money if you're in the right place. But so we're going to kind of try to answer some of those missing pieces and give you some order to this chaos today. This is for educational purposes only, not a recommendation to buy or sell any securities discussed. Acorn Wealth is not a financial advisor in any jurisdiction or province. And of course, any positions discussed today may be being held by myself, Acorn Wealth, or the employees and contractors of Acorn Wealth and Smart Money Trading. And of course, past returns discussed do not guarantee future results. So, I mean, I think a lot of you have probably been to one of our presentations before. Just a quick show of hands, though, is anyone here new to Acorn Wealth and Smart Money Trading? Anyone meeting together for the first time today? Put a 1 in the chat box if you're brand new. For those of you that may be brand new, we've been around since 2007, started Acorn right before the global financial crisis. In fact, that's around the same time we started working with Metastock. It's been a great journey. And one of the things that we really do well is tracking, as Jeffrey said, the smart money, right? Trying to keep it simple and focus on the few things, the 3 things really, that move the needle the most, that will add the most to our bottom line from a trading perspective. And those things are really patterns, insiders following what the smart money is doing, and then setting and forgetting our execution, having predetermined stop losses and targets. And so incorporating this 3-step process, looking at the pattern and what the smart money is doing behind the scenes, has really put us on the map with some of our big market calls. This was a comment earlier on in this year. We called this drop of 2022 back in December of last year. We said we're going for another big downward trend. Again, so this was actually from January, where Vasali emailed and said, thank you for the weekly updates on the smart money indicators and how to use technical analysis in the decision-making process in managing our investments. I would have drowned if I was not a member of Acorn Wealth with impulsive investment decisions. That was the beginning of the drop. Of course, it went a lot further than that, as we've seen over these last few months. But that crash began with some very high probability sell signals. Actually, in October of last year is when the very clear sell signals started to come up. So we're going to get to talk about how we look for these signals and so forth here in today's presentation. But yeah, so that's going to be a big part. And of course, the set and forget. As I probably alluded to here in the introduction, I love traveling. It's why I got into trading. I wanted to be able to have something that I could do from anywhere in the world. I wanted to be able to, just be able to pack my business up into my laptop and shoot off if I wanted to. And so, if that's something that resonates with you, if trading is something where you don't want to have to spend all day long stuck to a computer screen in order to do it. If you got into investing and trading to have more time, more freedom versus committing to a day trading type of routine, then you might find this particularly resonates for you, because that's what we've created everything in the image of. And of course, in order to do that, you do have to have a system. You do have to have rules. Who here would agree that the number one thing they want out of a strategy, out of your trading, is consistency? Put a 5 in the chat box if consistency is the most important thing to you. If it's something different, feel free to share it in the chat box along with that. For me, again, systems are so very important. The problem with my trading when I first started 20 plus years ago was that I had too many inputs, too many indicators, too many TV shows I was watching, too many news sources. It was analysis paralysis, far too much information, not enough insight, right? And that's a problem in general, isn't it? There's too much information, not enough insight. So when I first met my Warren Buffett, right, Strath Curtis was his name, and he took me under his wing. This is a photo from when we first met. He took me under his wing and he said, "Johnny boy, you're trading like a retail trader. This is not how big money makes decisions." And he said, "And if you want to make big money, if you really want to make a lot of money in your trading career, you need to be figuring out what the big money is doing and mimic that instead of following the retail traders. Strath had 60 years in the market. He was 88 years old when he passed away recently, but he was my Warren Buffett, and he is the reason I'm still here today. Because if I had have continued on the path I was on, which was bright shiny objects and analysis paralysis and spending all day long doing it, I probably wouldn't still be here today talking to you about trading. I would have given up, as most traders do. But by getting rid of all that clutter and going back to the basics, getting rid of all the things that was sucking away the attention and time, going back to basics was a game changer. And the big thing, the big aha moment for me that really moved the needle the most was focusing on the patterns. We'll talk about some of the other things here later, but patterns are, in my opinion, the absolute most important thing that you should be looking at before anything else when you're going to determine a potential trade, right? So all of the fancy whiz-bang, bright, shiny objects and stuff aside, the most important thing, the simplest but most powerful tool is understanding the price action. Who here would agree? Who here would agree that the pattern, the price action is important? Because just remember that if talking about big money, smart money, 80 to 95% of the volume every single day in the market comes from algorithms, comes from computerized trading. They don't think. They're not looking at what the news is. They're not looking at the opinions and things like that. They're dealing with black and white patterns, where to buy, where to sell, and they're following those algorithms. So to me, it makes perfect sense that if, let's just say 90% of the volume in the market is coming from pattern-driven decision-making, we want to understand those patterns. We want to be able to anticipate what the fingerprint is that causes 90% of the volume to go from selling to buying, like that. If we can anticipate that moment, then we can tag along with it and go for the ride. So the number one golden rule that we're going to talk about today is understanding the basics of those patterns and how smart money makes decisions. So number two is then doubling down on the insiders. So I talked about keeping it simple and the things that move the needle most. Once we have a very high probability pattern in play, the next thing that I like to do is to look at the fundamentals. Not the fundamentals as most people do by looking at the news and reading the quarterly reports and doing all the time-intensive research on what the company may or may not be doing and whether it's any good. When I do fundamental research, I like to do it in an efficient way. I like to go to the CEO, the CFO, the chief medical officer, whoever's running the company, and ask them what they think of their own company. Because at the end of the day, they are the only experts that actually know, aren't they? They're the best experts out there. They run the company. So even Warren Buffett doesn't know as much as the CEO of the stock that you're looking at investing or trading. So how do we ask the CEO, CFO, board of directors, the people that actually know what's going on? How do we ask them about the fundamentals? Well, we look at what they're doing with their own money. If we see the CEO's just bought 500% more stock yesterday in his own company and put $6 million of his own cold hard cash in to buy that 500% more, I'm very interested. You would assume that means that something fundamentally is going very well with the company. So from the pattern gives us the technicals. The pattern gives us the probability of success. The pattern gives us the when to buy, when to get out, where to put our stop loss to protect if it doesn't go the right way. And then the insiders, the smart money, gives us the extra secret sauce, the extra X factor of not only having a great technically and well-timed trade, but having very strong and potentially exciting things happening in the company that we're not aware of. Okay, and then number three is to automate it. Number three is once we know what we're looking for and we've found it, we should know where our targets are, right? You may have heard some of the previous speakers talk about that. Targets are important. It's how we manage risk and make sure the risk-reward ratios are on our side. So the beautiful thing about having a powerful pattern is the pattern tells you where to get in, where to get out. That shouldn't any longer be an unknown factor for you when you're trading with high probability patterns in your sales. So let's dive into where this all stems from, which is rule number one, right? It's not personal, it's patterns. And this is why, you know, for a lot of people, their technical analysis doesn't work. And they struggle with patterns, thinking that they're subjective. And I can promise you they're not. Patterns are not subjective. There is a right way and a wrong way to do it. And so I'm going to show you some of these foundational rules that will really bring those charts to life a lot more than perhaps what you're currently doing. So this is the golden rule. So prepare to write this down. Grab a pen and a paper or whatever you would use to make notes with. And this is the golden rule that for the last 16 years of teaching, this has been a aha moment for students of all levels of experience. People who've spent tens of thousands of dollars on education sometimes have told me that they weren't even taught this properly. So here's one of the a big aha moment in my journey early on that I'd like to share with you here. The golden rule is that when you look at a chart, when you look at a stock, Forex, S&P index, whatever it is, when you're looking at that chart, the stock or index or vehicle will not change direction unless it hits one of the three following things. So I actually printed this out and had it on my wall for 5 years after I met Strathy, reminding myself to come back to this simple but powerful thing, right? When you're looking at a stock, you're looking at that chart, that stock will not change direction unless it hits one of the following three things: horizontal support and resistance, trend line resistance, or moving averages. So when you are looking at a potential trading setup, right, your job is to figure out which of these three things is in control. Okay. So looking for those levels of support and resistance. And the way that I like to think about this is imagine if you were to go and get on an elevator, right? If you were to get on the elevator at the ground floor, and you wanted to go up to the first floor, right? Where's that elevator going to go? It's either going to go to the first floor or it's not. It's going to go down to the parking garage. One of the two, right? It's not going to go up half a floor and turn around. It's not going to go up 2/3 of a floor, right? The elevator moves between floors, right? The first, the second, the third, or potentially down. And it's the same thing with stocks. Whether you're trading options on those or whether you're buying the stock outright, stocks move between the levels of support and resistance. Very, very rarely do they not respect these levels, right? So, and then when you get into a trade, how quickly do you know whether you're wrong or not? Well, same with an elevator. If you get in on the ground floor hoping to go up, and that elevator starts to go down just the smallest bit, you know that you're going the wrong way. You don't need to, you wouldn't, if you could jump off, you would. You don't need to wait all the way down to the parking garage to know that the elevator is moving in the wrong direction. And this is the way that we look at stocks. We want to clearly understand where these powerful levels are, and then everything else in between those levels becomes noise, right? And then if we can incorporate the understanding of high probability patterns with big insider buying complementing that pattern, then maybe we can get in on the ground floor and go all the way to the penthouse, right? And so this is the concept of treating charts from a price action forward type of perspective. And so this leads into the different types of cycles that we can then see in the chart. Okay, so there's just like there is 3 types of support and resistance that we can hit, right? Horizontal, diagonal, or moving averages. There's also then different cycles that the market or a stock can be in. And there's really 2 core cycles that a stock can be in. Number 1, oscillation. Okay, an oscillating cycle, an oscillating pattern is where the stock is bouncing back and forth between fixed lines. So in this example, the stock is bouncing back and forth between 2 parallel, right, straight lines that are pointing down. That is the system that's in control, right? Momentum is a totally black and white different type of pattern. If we are in a momentum scenario, the system that is in control is not the straight lines. It's not the horizontal levels. It's the moving averages. The moving averages now become the system that's driving that stock up or down, right? And moving averages now become our focus of understanding what they're doing. So that's a 30,000-foot view. So before we go into more detail, I'd just like to ask everyone in the audience what your comfort level is between these 2 systems, because the way we enter, the way we exit, the way we manage risk, the probability, the indicators we use, they are absolutely categorically different. Black and white, chalk and cheese, from how we treat an oscillating trade to how we treat a momentum trade. So by indication in the chat box, if you can throw a 5 in the chat box if you're really familiar with the differences between the 2, and a 10 in the chat box if you're not. And that will give me a gauge of how much time to spend on this topic. So a 5 in the chat box if you're really familiar with the differences between oscillation and momentum, and a 10 if you are not. Okay, so let's look at the situation of a few ones. All right, so let me go through how this actually works at a deeper level. If you are in oscillation, this means that as we said, the system that's in control are the straight lines. Now, one way to really quickly tell, kind of a cheat sheet, if you will, is to look to see if the moving averages work. So if we're looking at this example, notice how the stock goes up through the moving averages, down through the moving averages, up through the moving averages, down through the moving averages, up through the moving averages, down through the moving averages, up through the moving averages, down through the moving averages. It cuts, it slices back and forth through the moving averages like a hot knife through butter. They slice through the moving averages as if the moving averages aren't even there. And that's because they're not. They don't matter. If you are in an oscillating pattern and you're buying when the stock breaks above moving averages and selling when it breaks back below the moving averages, you're going to go broke. And you're going to wonder what you're doing wrong. You're going to say, damn it, I've seen so many traders talk about the importance of moving averages, but every time I use them, I lose money. Who here's in that boat? Who here's gotten frustrated using moving averages on their trades recently because they enter and only to be stopped out days or even a week later? It's probably because you're using momentum strategies in an oscillating scenario. So when we look at oscillation, we don't use moving averages at all. You can actually take them off the chart. What really matters is where those static lines are. That dictates the shape of the pattern and also where you should get in and out of. So let's talk about that. If we are in an oscillating pattern, right, just like momentum, we still buy support and sell resistance. In oscillation, the support and resistance that matter are the straight lines. So when you're going long in a pattern such as this, you want to be buying on the way down. you want to be buying support. So just like in a momentum scenario, you might buy as the stock crosses the moving average. In oscillation, we want to buy as the stock falls to support. Right? We want to get as close to that price as possible, which means pre-programming that if the stock hits this price, buy it. Okay? Now, the stock is oscillating. So as the stock rallies, when it hits resistance, what is it most likely going to do? If something is oscillating, right, when it rallies and hits that resistance above it, what is the most likely, highest probability outcome of what's going to happen next? It's going to oscillate, right? So when we get in, we're pre-programming that entry. And when we get out, we're pre-programming to sell on the way up. So buying on the way down when you're feeling most uncomfortable, but that's the best rules to follow. And selling when you're feeling most confident, selling on the way up to grab that chunk in the middle and not get greedy. Does that make sense, guys? Okay. So, and then if we break out, there's another entry. And again, we sell on the way up when we hit the channel target. So all of our trades are done this way, whether it's an oscillation pattern or head and shoulders or a momentum system. We're always looking at what the rules of the pattern are and applying it appropriately, rather than saying one rule fits all when it doesn't, right? So momentum, of course, is a different animal. Momentum, the algorithm, the high frequency trading, the smart money that governs 80 to 95% of the daily volume. We need to understand that. And so if we are in a momentum system, what we're being told by the market is that the market makers, the algorithms are in a momentum pattern. That's what's driving this. And so you can see this evolve when the stock starts to respect the moving averages, like you see here. Look at how the stock in every single day, right from here to here, every bit of its movement was explained by the moving average. Every time it went up, it hit the 5-day exponential or the 9-day exponential and rejected back down again. Its whole journey was walking upside down underneath that moving average, like a caterpillar, if that makes sense. I like to teach with analogies, as you may have been able to tell. But can everyone see that happening here? Just put a 1 in the chat box if you can see the difference between the two examples, how in this situation, the stock doesn't cut through the moving averages. So we know it's in bearish momentum. And so are we going to buy on the way down? Absolutely not. Because while we're underneath those moving averages, that system is in control, and any support that we think is there, right, as we fall towards a Fibonacci support level, or when we fall towards a horizontal gap down support level, or whatever kind of support you look for in your trading, as if you're under momentum, you do not buy that support because it's not in charge, right? If you are oscillating, you would, because the straight lines are in control. And you would respect where those horizontal levels are or trend line levels are. In momentum, moving averages are in control. The momentum will take those areas out. So we need to wait until the stock is above those moving averages. That's where we buy. So in oscillation, we buy on the way down. In momentum, we buy on the way up. We're still buying support, but we're doing it in the appropriate way. And so once we've then bought a momentum setup, then we can hold as long as that condition is still intact and the momentum is still in play. We can hold that. So as the stock continues to rally, we don't exit until it actually closes below and crosses below back those moving averages one more time. So the presence, and this is why I say the indicators are so different. Right, in momentum, you're using moving averages, you're using MACD, you're using RSI crossing above 30, things like that. But in oscillation, you're not using any of those. You do not use moving averages. You're not looking for RSI to cross above 30 or 50. You're not looking at stochastics the same way. You're not looking at MACD, if I didn't say that already. In oscillation, you're looking at Keltner channels, Bollinger Bands, where the support and resistance is, like if you're an indicator person. So, but for me, the most important thing is the pattern. It tells me the probability of success, where to get in, where to get out. And when you bring it back to those simple things, it can be really exciting. If trading is actually fun again, imagine that. And that's the message I want to really kind of sit with you, is that you don't need to make trading complicated. You don't need a million different tools to make money. And you definitely don't need to be spending all day doing it. So with the simplicity in mind, just remember this: algorithms, what's driving the market, what's accounting for 90% of the volume, doesn't see this noise. All it sees is levels, right? Just like the elevator in the building. Where is support? Where is resistance? And just take that chunk in the middle and do it over and over and over again. It's the ability to keep it simple like that, and that is the key to making money consistently. It's being able, that the hard part is disengaging from your emotions that wants to keep leading you off track, that wants to tempt you to break your rules and go big or go home, that kind of attitude. But if you can keep it simple and keep discipline, then trading can actually be very profitable on a consistent basis. The next part to this is to then pick your perfect pattern, because you don't want to just go out there and start trading any old pattern. There's 140 odd different patterns that exist. For example, many people, I'm sure, have heard of a double bottom, but did you know that a double bottom can look like this? That's called an Adam and Adam double bottom. It can look like this, which is called an Adam and Eve. It can look like this, which is an Eve and Adam. And it can look like this, which is an Eve and Eve, right? Now, just in this example, it shows us that a double bottom is not just a double bottom. In fact, using the ranking system that we follow, an Adam and Adam double bottom ranks 14 out of 100, one being the best, right? 14 out of 100. The Eve and Eve ranks 49. So would we ever trade an Eve and Eve double bottom? Absolutely not. Why would you? You are knowingly putting yourself behind the 8 ball. You're knowingly increasing the probability that you're wrong, right? It's like someone who sits at Vegas and has I don't play cards much, but like, what's a bad hand? A 6-2 offsuit, in blackjack or something like that. The people that go all in on that hand are doing so because they think, well, it's a bad hand. I'm probably going to lose, but I'll gamble anyway. This is what bad traders do in the stock market. They don't understand the probability, or they do understand the probability and ignore it, right? Now you know right now that this is a low probability pattern. Why would you ever trade it again? So this is the idea of patterns and probabilities. We eliminate the ones with low probabilities and focus on the ones with the high probabilities, the ones that over hundreds of thousands of times they've happened before, consistently win more than they lose. That's how you put probability in your favor. This is the simple things. These are the simple things that to me are so very important, and why I enjoy trading so much, because the rules are black and white as to what to do if you know them. So that the trick is to focus on, excuse me, frog in my throat. The trick is to focus on the highest probability patterns and ignore the others, right? Stay in your lane, in other words. Just like a hardware store doesn't sell bread and milk, they stay in their lane, right? If the hardware store started selling groceries, the milk would go bad, the bread would get moldy, and they'd probably go out of business because they're not specializing anymore. As a trader, another big aha moment for me as I went down this path of patterns was to realize that I needed to focus not on how to trade 143 different patterns, but which ones were the best, and to really focus on those. And so this is what took up the first 5 years of my trading career. Once I got rid of those bad habits, for the first 5 years, what I did spend all my time doing was really, really understanding patterns at an intimate level, if I can use that terminology, at a very deep level, and figure out which ones, where should I spend my time developing strategies around. That's where time is well spent. It's not spending all day long staring at the market and watching paint dry, watching stocks go up and down on the 5-minute chart. I get it, it's exciting, it's an adrenaline rush, and some people make money at it, most don't, right? For me, time well spent is working on the strategy, sharpening the axe. And so the 5 years of research I spent, myself and the team that I hired, was going through and looking at which of the patterns were best. The 4 best patterns out of 143 we looked at was momentum patterns, momentum breakouts, so they're called fallen angels, flag formations, very, very, very good, especially in these markets because they move quick. They're usually about a 1 to 2 week hold. The average move is about 20 to 30%. And if you're wrong, you usually get stopped out within the first couple of days. So the time you hold a flag is so short, which is great in markets like this when time is your enemy, right? You don't know where the market's going to be 3 weeks from now, let alone 3 months from now. So flags, very, very good for these kind of market conditions. Head and shoulders, the #1 highest probability bearish pattern when a market is topping. And channel breakouts, also very, very effective. So this is the Acorn Fab 4. And if you follow our alerts and ideas, you'll find that almost every single trade we alert to you falls into one of these categories. Right now, a lot of flags. So that's what the stay in your lane is about. It's about focusing on those systems that we can then really get to know. Just like a restaurant that only cooks 4 things, right? Because they're the best at it, versus the restaurant that has 143 things on its menu. Where are you going to go eat? I pick the one that does 4 things the best. And so that's what we do. We focus on, we're not going to teach you how to trade iron condors, even though we do options trading on our ideas. Our focus at Acorn is to find the highest probability patterns with the biggest amount of insider buying, and from there we can leverage, which does bring up the second point. But just before we go into this, I just want to get a show of hands. Is that making sense so far? Am I explaining it clearly enough? Just give me a 1 in the chat box. Great, awesome. Okay, so part 2 is then how we leverage this even further, right? Because again, in the idea of probability, especially in this kind of market, you want to have everything behind your back that you possibly can. So if we can add probability to a trade by doing something simple, why wouldn't we? And I think that the lowest hanging fruit of how to put a lot of extra probability behind your trades and investments is by incorporating the insiders. So again, they are the only expert that knows. They know. Insiders know what products are coming out, mergers or acquisitions, litigation or court cases that may have been resolved. In the case of a biotech company, the chief medical officer knows whether it's working or not. They know whether their test subjects are coming back cured or not before this goes into FDA approval. I mean, this to me is the most overlooked pot of gold, so to speak, in the market, because this allows us to tap in to an extremely valuable wealth of knowledge that you couldn't possibly have by doing the research yourself. Even the experts so-called experts don't know as much as these guys do. And if there's one thing that I trust, it's people's greed, right? I trust that. If I see people loading up with massive amounts of money across the board, multiple people, not just one, but multiple people, all buying big amounts, huge percentages, huge dollar figures, all at the same time, I'm going to bet that that's something that's good that's going on behind the scenes, and that's probably a safe place for me to put a trade, especially if the timing is right from the pattern. And I mean, all the research has been done on this. You probably see me talk about this in other presentations. You know, the insiders have a persistent edge. That they make exceptional profits when trading before big market events. That there's no better tip-off to the probable success of the stock. I mean, this has all been done over years. That insiders have this edge. It's no surprise why. So when we can double down using this technique, now we've actually got a system. We're incorporating technicals, timing, probabilities, backed with strong fundamentals as indicated by the insider action. And so now all that's left is then to automate it, to take the rules of the pattern and execute. And that is the system. That now is a strategy. There's an old saying of, if you don't know where you're going, any road will take you there. Most people don't know why they should get in, why they should get out. They don't understand the simple but powerful things such as the patterns, even basic patterns, which are a game changer, right? And so we rely on the quick fixes and things like that instead of actually putting our time into really understanding what truly moves the market. And so when we do know what we're looking for and we know why we would get in, why we would get out based on rules, we can set and forget it. And that's when trading, I mean, that is what I signed up for when I was a young man, reading Rich Dad Poor Dad on the train to work. These were the ideas that were being planted as seeds in my mind that led me to investing as a career. Was the idea that it does provide you a better life, more time, more freedom. If anything we've learned in the last few years is how quickly freedom can be taken away, and to the point where you're not even allowed to leave your own house, right? And so that's why I thank my blessings that I went down this path where my life is in my hands. I can leave and move to another country, or jump in an RV like we did when COVID hit. We rented an RV for 3 months and we just hightailed it into the forest and camped by lakes. The RV cost us $70 a day. Food cost us $35 a day for hot dogs and a couple of Budweisers. $110 a day, let's call it, to live like a king. And that to me was what this is all about. It's not about the millions of dollars you can make in the Ferraris and mansions. Trading consistently profitable, and what this type of strategy can provide is the ability to make money from anywhere on your schedule. And this is what I loved about this trip, was that it reminded me that, hey, as long as I can make $110 a day, I can be living like a king anywhere in the world I want to be. $110 a day, right? And that's, if you think of it that way, that's where the seeds start to be planted of where the importance of consistency is, and the importance of being able to set and forget and remove the emotions, right? So when the market began to crash in 2021, this again was the same tools that I've been talking about. We looked at the S&P. We saw that the S&P 500 was in a head and shoulder pattern. Okay. So we looked at the pattern. We saw that there was a head and shoulders. We looked at the insiders, and we saw that insiders were selling significant amounts compared to hardly any buying, right? Insiders were dumping their stock across the entire market going into the end of last year. Significantly higher amounts of selling compared to buying. That's a ratio that we track every day. By the way, that swung back to buying for the last 3 weeks. It's a very, very interesting market right now. But just to keep it simple, the pattern was there, the insiders were selling, and now I'm going to introduce the new tool that I'm very excited about. I didn't know if we were going to have it ready for today. I'm so excited that we do. There is an indicator which we developed about 2 years ago, and we have been using it internally only for those 2 years. We don't release anything until we've been using it in real markets and real trades ourselves for at least 2 years. We really take this stuff seriously if we're going to release something new. It is unbelievable. And what this indicator does is focused on smart money. And what it does is it tracks the algorithms behind the stock and looks for powerful divergence, right? Where a stock is rallying, but the smart money is dumping behind the scenes. Or when a stock is going down, but smart money is loading up as it goes down. This is, again, in the essence of smart money, is so important, so valuable, so we developed this indicator, which gives us very specific buy and sell signals when it detects the powerful divergence is happening. And as of today, as of an hour and 15 minutes ago, this is now available in Wealth Charts. So I'm very, very excited about that. There's a few other platforms we have it for as well, but Wealth Charts Metastock is now added to the library, and we're thrilled to be able to include it in today's offer. So again, you can see that smart money sell signal right at the top. This was from in Trading View, as we only had it in that at that time, and that's beautiful right there. And that's where the market then continued to plummet from that head and shoulders. Again, this allowed us to anticipate the drop, to buy shorts, to protect our longs, and it all comes back to powerful patterns combined with smart money. So this is I want to show you how this now looks over some other trades we've alerted. So if you are a Metastock user, I hope you are. Such a great, powerful platform. You can see here how this appears. You actually get these red and green arrows. And I've got a large resolution on this screenshot, but hopefully you can see those there. There's the green buy signals. What those are telling us, whenever we get a buy signal, for example, this is Amazon, sell signal, buy signal, buy signal. That's telling us that massive accumulation is occurring while the stock is moving in the opposite direction, and we could be nearing an ideal entry point. So this is what is now available as offering as part of our package today in Metastock. VIRT. You can see again, this is actually a full disclosure. This is an active short alert that we made to our students, and this is a beautiful pattern here, where you get an upward channel, it breaks to the upside, and then rolls over. And when it starts to roll over, that's one of the most powerful bearish momentum signals you can get. And again, so we had the pattern confirmation, we had the sell signal right at the top, like we did on the stock market, and the thing dived. SBTX. So VIRT is a short that has since dropped from $34 to $23 it is today. Beautiful short, right? Very high probability pattern, going down while the market was going up. All right, and that's what you want out of a short, something that goes down even if the market goes up. Compare that to SBTX, which is a recent and still active long alert that we made to our students. SBTX is the pattern I just showed you in the bullish formation. Okay, downward channel. That's that dipped to the downside and then scooped up, and that was a long we alerted here, from just above $3, now at $4.45, right? And once again, high probability pattern. Smart money divergence indicator gives us a buy, and insiders were buying. All three factors that we're looking for. So when you're looking at these kind of crazy market conditions, you know, these are the types of setups that we're scanning for. I'll show you a few more. NOW, head and shoulders pattern, right? Beautiful head and shoulders pattern as the market topped. Smart money indicator, right? Smart money indicator, as the head and shoulders was created, the smart money indicator gave us our sell signal, confirming the presence of algorithmic selling as well as the pattern. A beautiful 1-2 punch. And then finally, the insiders, right? We've got the pattern. We're confirmed with the smart money divergence indicator. And then on top of that, 8 insiders sold $47 million worth, with the CFO selling 75% of their position. And so what I know, I give away way more than just one idea in these workshops, but I want to show you how it's a full picture. It's a strategy where there's multiple steps that just continue to stack probability on probability on probability, and then give you no doubt as to what the correct trade is, where the entry is, where the sell is, by having this kind of pinpoint type of strategy with these clear levels confirming each other. And then again, the last step is just to set and forget, to execute. All of our alerts come with a pre-programmed entry signal, target, stop loss, right? Insider research. And of course, now you have the capability of putting this indicator onto your platform, which is a tool we've used internally to find our trades for the last 2 years, and now are very excited to share that with all of you. So now, as Dave says in Australia, Eureka. Dave blew up a lot of accounts. He was trying to day trade in Australia, which is impossible because you have to stay up from 12:30 till 6 in the morning if you want to watch the market. And then he would go off and go to his career, his day job. No wonder he was blowing up accounts. By having this type of set and forget mentality now, he does his scans at 8 o'clock at night, programs his trades in, sets them, forgets them, and then when he wakes up in the morning, he gets to see how much money he's made, or how his trades have done. This is where money is actually working for you, instead of exchanging your time for money. Dave's been with us for 6 years, I think now. We caught up with him in Australia last year when I was flying through Sydney. That's obviously me and my lovely partner Leanne and Dave. And that's the thing about our students' relationships, and I would love to have one with you as well, is that they're long term. They're long term because there is consistency throughout what we do. We don't just have one great month and then 10 bad ones. We're not trying to get rich overnight with these types of trades. We're looking for consistency where you can automate these things, have your time back, and be able to start looking at trading as more of a business that's making you money versus something where you're exchanging a lot of time for it. And again, with this new indicator combined with the powerful patterns, it's made that job much easier. Again, here's NVEE. We talked about Adam and Adam double tops earlier, right? So here's a great example of that. Adam and Adam double top. Also, that double top slightly lower, which is something which we teach you in the course, but slightly lower top is really an extra bonus for an Adam and Adam double top. This is the best possible Adam and Adam top you can get. So this actually was one that came up in our smart money scan. Once again, we then look at our smart money indicator, right? Sell signal. We look back on this stock, and every time we've had a sell signal, it dropped every single time. The accuracy of this, even on the buy side, right? Up, down. It's been incredibly accurate. So when we got that Adam and Adam top, and we had the smart money divergence signal saying that as the stock was rallying, smart money was flooding out the back door. That's an extra confirmation. And we saw the president, COO, executive vice president, general counsel, chairman of the board, CEO sell $5 million. And then on the next run up, as it was rallying up to that level again, CEO, chairman of the board, executive vice president, director, general counsel sold $5 million more. I mean, everything's aligning, and we have our perfect storm. And so this is the 1, 2, 3 execute strategy that we teach, that I trade, that we're doing this for ourselves every day as well. And by following the strategy, the playbook, dare I say, this is when, again, trading starts to become exciting. It starts to become where, again, you can look at this as a business where money is truly working for you instead of exchanging time for money on a consistent day trading type of schedule. Now, I've got nothing against day trading, but that's not what I signed up for. I wanted to be able to have money work hard for me. And that's what smart money trading does. Now, I know I've talked about a lot today, and so sometimes it's a bit like a kid in the candy store trying to stuff it all in and figure out, okay, well, what do I do with this now? So we've put together a very, very, very special offer today in part of a celebration of the release of this new indicator. We've included it as part of your Smart Money Trading Ultimate Bundle. But this covers everything you're going to need. It is first and foremost, what you're going to get is you're going to get our Smart Money Trading course. Now, I think that probably anyone who's been with us in the past has done this course, right? Past and future and present clients, everyone has done this course. It is really important. It's the foundations of everything we do. So we are including this course absolutely complimentary. It's normally $19.97. You're not paying for it. If you've done it before, no problems. We are including this complimentary just to make sure everybody going through this workshop and following our alerts is on the same page. You're going to get all 4 modules on demand, which so you can go through as many times as you want. And this is going to show you how the smart money trading works, the differences between Atom and Atom tops, why we focus on those particularly 4 patterns versus all the other ones out there, bar charts, candlestick analysis. Like it goes through the whole foundation of everything you're going to see moving forward. And where it finishes is it teaches you actually how to start scanning for these ideas, searching for powerful insider buying or selling, right? We teach you our insider long and short scan. That's included as well. And you have lifetime access to the course and the scans. There's no monthly fee you have to pay to use the scans. It's all included in the package. It's really, really awesome. You don't need any special software. We set you up with everything. So that's $19.97. That's included, complimentary. The Smart Money Alerts, you're going to get 3 months of alerts. Every week, we send out about, on average, 5 ideas. We break down the market, what's happening in the market, where the insiders are going, and then our 5 favorite trades with options as well. Some of them, not all of them are optionable, but most are, especially with shorts. Entry price, sell price, multiple targets if we have more than one. Stop loss, the insider research, what institutions are buying. It's everything you need. It's really awesome. Those videos are about 10 to 15 minutes long, once a week, where we break down the trades we're going to program in for the week ahead. You'll also, on top of those 5 alerts every week, the ones that we're looking for our own portfolios, we'll also be doing a live trading room every Tuesday, Thursday, where you can come and ask questions. That is also included for 3 months, and we dive deep into the markets there. You'll have your own one-on-one coach. So for the 3 months you're going through this process, if you have any questions at all, you can call us, Skype us, text us, email us, screen share with us. We'll jump on the phone with you. You can, any way you want to communicate, we're here for you. You'll have your own personal coach that'll hold your hand through the whole 3 months. You don't get passed around. One point of contact to help you throughout the whole journey, which is awesome. That's included. And I kind of let the cat out of the bag earlier, but one of the things we're also going to be launching today, right now, is the Smart Money Divergence Indicator. And as part of today's offer, today only, this is we're going to give you lifetime access to it. Lifetime access to the new Smart Money Divergence Indicator. We very, very, very rarely launch new things until we've tested it in and out to make sure that we can't live without it. And this indicator has made my life much, much, much easier because it just finds things in the chart, in the data, because it's tracking volume, how much the stock's moved, its daily range, where it's closing, what volume happens on different days with different price action. It takes all of that into account, oversold, overbought levels, all of that, takes all of it into account to find when powerful divergent signals are happening. It's incredible. And so it tracks money flow as well, by the way. All of that is inside the indicator. And so it's available as of now on Metastock, which is incredibly exciting. And we've also can offer it for those of you who are on Wealth Charts, TradingView, Thinkorswim, and TradeStation. So very, very exciting. And as a special for today, we are going to get all of that for only $3.97. Incredible, right? So yeah, that's again, you can go to acornwealthcorp.com/meta. acornwealthcorp.com/meta. I'm just looking at the time. I know that Jeffrey put me on last because he knows I like to. I always end up going 5 minutes late. I swear to God. But that's what the offer is. Again, we're very excited. It's just released on Metastock. Literally, our developer finished an hour ago. I've tested it. I went over it with him. It's perfect. So just to recap, Smart Money course and learning to scan for insider buying and selling. That's where all of our ideas I've talked to you about today came from. You'll learn it all. If the why behind the what is important to you, that's exactly what's covered in the course. And this is, again, many of you may have done that course before. It's an excellent course. We provide it for free, included with this package, just to make sure everyone is on the same page, so we leave no trader behind. 3 months of alerts included. That's normally $3.97 on its own, as well as the Tuesday, Thursday trading room. It's 2 live sessions every week. So that's what, 2, 4, 6, 8, 8. So you're dealing with 24 sessions, 24 hours of live training over the next 3 months. In these markets, that's invaluable. Those are recorded as well and uploaded to the portal. One-on-one coaching, and access to our smart money indicators, which again, $9.97 in value there for lifetime access. So there you go. All of that's on the screen here. It's $3.97 for everything. acornwealthcorp.com/meta. It's okay. So questions, throw them in the chat box. Jeffrey, feel free to cut me off whenever you need to.
Oh, you're doing great, John.
Awesome. Okay.
We have let's see. John wants to know if you can see the dark pools. I don't know if that's a camping reference. No, I'm kidding.
The dark pools. Yeah, so dark pool capital, I mean, there's a lot of services out there that talk about tracking that. Really, to me, that's an overcomplication. You know, I even started going down the track of looking at institutional buying and things like that. And there's a sweet spot where the simplicity of something is what makes it so effective. And that was this is one of the ways I actually blew up an account 20 years ago, was I started adding too much. I had one strategy, one pattern that I traded for the first couple of years, and it was just killer. Like it was going at about, I think it was 78% accuracy. 78% of the trades won, and the average performance was 12% in 15 days. So 3 weeks, 15 market days. So 80% success rate, doing 15% every 3 weeks. Why would I change it? But I thought, oh, well, I'll add more. I can be even smarter. The more I add, the smarter I'll sound at the dinner table, kind of thing. And the more I added, the profits eroded. And so for me, the pattern is, I saw a comment in the chat box from an earlier speaker that indicators are lagging. Most are. And that's why I love the patterns, because it is the most powerful leading indicator out there. A pattern tells you what's going to happen next. So when we're taking into account the pattern, that's accommodating what the dark pool and institutions are doing already. We're taking into account where they're going to drive that the volume next by incorporating the pattern. And then when we look at the insiders, that's when we get that fundamental essence. So I haven't found it necessary to add more than that, and I think you actually run the risk of taking away from the simplicity of it. I hope that answers your question, John. So we could if we wanted to. We don't though. What are the rest? What the ref 2 males on the bottom or top? Sorry, Laurie, I don't understand the question.
I was afraid to ask it. So
what's that, Jeffrey?
I didn't understand that one either. So
Okay, so what's the ref? All right, maybe if you can rephrase that, Laura. I apologize for that. Yeah, so this very, very exciting on the bonus smart money divergence. Jeffrey, you know how much I've been trying to get this on Metastock, so I was like, yes, we managed to get it in time.
yeah, good job, good work.
Yeah, I was very happy. I was sitting at the top of we went to a friend's wedding in the RV on the weekend, and there was no cell reception. There was black bears walking through the camp, and no cell reception. And I literally had to climb up to the top of a mountain to text my developer and say, "Is it ready?" And he said, "Yes." I'm like, "Great, you'll love it. It's such a cool indicator." We will be selling it for $997 standalone without anything else. So that's it really is a great offer to be able to nab it today for Metastock and those other supported programs. There at that link, acornwealthcorp.com/meta for $397 lifetime access. Okay.
Very good.
All right. If there's not any other questions, then I will pass things back over to Jeffrey there.
All right. Thanks, John. Appreciate it.
Thanks very much. Absolute pleasure.
Have a good one. And that is acornwealthcorp.com/meta. You heard it today. All right. Thanks, John. Okay. We'll just wrap up here. I hope you enjoyed that. Let me go make me the presenter. I'll share my screen. We'll just wrap up real quick. We had a good time today. Wanted to remind you, of course, last time, you can get all of the add-ons, well, with the exception of John's. We don't have that one in our catalog yet, but we'll be looking at that. You can get the Go No Go complete. You can get Steve Bigelow's CPS 2.0, 3 months of Guy Cohen's OVI, the 3S code add-on with the 1, 2, 3 tops, 1, 2, 3 bottoms, 3 months of LearnMetastock.com, Unleash the Power of Metastock training. All of that would normally be $3,630. But we're going to give it to you today for $1,641. We're going to give you money back guarantee on all but the 2 monthly subscriptions. So you're going to get the huge risk reward there. You get a very good reward, very little risk. Give it a go. You can take advantage of that if you go to metastock.com/summit deal. You can call 800-882-3040, or you can visit us online at metastock.com/saleschat. So I want to say thank you for everybody for coming today. Want to do one last thank you to the sponsor, Stocks and Commodities Magazine, CMT Association. We really appreciate that, our support. Lori says, great day of webinars, thanks. Thank you. I'm glad you came. I'm glad you enjoyed it. So give us a call, 800-882-3040. Hit us up online at metastock.com/saleschat. We can help you get set up. Thanks for coming today. I hope you learned something. I hope it was good for you. And I hope we see you at the next one. Thanks for coming, guys.
Hi there, Greg Lewis, Metastock Software. As the marketing director, I get asked all the time, what is Metastock? How can I help my trades? Well, stick around for about 3 minutes and I'll tell you. Metastock is an award-winning software and data package that has been helping traders for over 35 years. Simply put, Metastock is a tool for traders like you to analyze the markets. Metastock helps you take the guesswork out of trading by offering a methodical, systematic approach to some key questions all traders come up against. Questions like, how do I decide which securities to trade when there are literally thousands to choose from? Which strategy should I use, and how do I test that strategy before spending my first trading dollar? When should I enter and exit a trade? How can I effectively manage the securities I'm interested in? And of course, how do I know where prices will go next? At the core of Metastock are the Power Tools. The Power Tools give professional-grade analysis tools to private traders like you and me. You can scan the market with the Metastock Explorer to filter and sort securities that show buy and sell signals based on your criteria. The Metastock System Tester lets you test most strategies through a process called backtesting, which allows you to see how your strategy would have performed over time. You can easily manage and monitor the securities you are interested in with Quote Center. Quote Center lets you sort on a variety of criteria to view the data that's important to you. Then just double-click on a security if you want to see its chart. With the Metastock Forecaster, you can even take advantage of patented technology to view probable future prices. If you're an options trader, you're going to love Metastock's OptionScope. OptionScope puts all the critical info at your fingertips, displaying sortable, customizable, color-coded options data, including the Greeks. And Metastock has solutions for traders of all levels and interests. If you're just getting into trading, you will appreciate the education offered by our many built-in systems. In addition to pointing out buy and sell signals, Metastock explains how they work in an easy-to-follow commentary window. Metastock has built-in systems based on popular strategies like MACD, Bollinger Bands, turtle trading, candlesticks, and many more. Metastock even has the very popular and exclusive Rahul Mohindar Oscillator System, or simply known as the RMO. And as you become a more experienced trader, Metastock grows with you. Advanced analysts will enjoy the comprehensive list of trading systems and indicators and the ability to build their own systems. And if you're a day trader, you can't do better than Zenith, the real-time news, data, and analysis package offered by Refinitiv, a world leader in market data. Add on the world-class support, and it's not hard to see why Metastock has won the Stocks and Commodities Reader's Choice Award for 26 consecutive years. To find out more about Metastock and how it can help your trading, visit metastock.com or contact a product professional via phone, email, or chat.